Yeah, good morning, everyone. How are you all doing? Fine, just fine, just fine. Feeling tensed? No, you are great students here. Exams are approaching and you don't have any tense and all, huh? No, zero tense. How come? How come you are so brave? How come you are so not tensed? You should be right. Not required, no? Yes, definitely not required. Provided if we are perfect in putting all our efforts. Yes or no? So I do wish that you guys are all putting your efforts in a proper manner and you're making a proper utilization of all your time which is available for you for the upcoming examination. And let us wish and hope for the good and great things to happen. Okay, you're not able to see me there, but you're able to see me here, no? Right. See, whatever I'm writing, that will be fine. Okay, we'll ask them to set the things up in the meantime. But you're all able to see me here, right? Yeah. So you can manage, no? So just whatever I write that you will be able to see, that will be enough. Fine. So what is the purpose of our gathering here early morning? Generally, you don't get up at this time. Do you? Do you? Really? But I'm not used to. Right. So yeah, fine. So the purpose why we all have assembled here is to get a good revision of RCA into audit. So the exams are around the corner. We have a short span of time left. And at this point of time, than preparing the new content, the most important thing which you are supposed to do is revise the content which you have already prepared. So that is what the most important thing which you should be supposed to do. And I know how better you do the revision on your own, that I know it much better. Right. So I wanted to do some value addition from my side, which will be helping you for your preparation as well. So that's what has been the whole objective here. So we have 2 days of time. Today and tomorrow we have. And as you have been informed about the timings from morning 9 a.m. to 7 p.m. If situations permit and if you permit, I might extend also, provided if you permit me, only if required. Okay, right, fine. Yeah, so let us properly make the utilization of this time, whatever we have on today and tomorrow. So we will be trying to revise the concepts in a very much detailed manner. And I will make sure that after this, you will be very thorough with your preparation and things and all. Yeah. So having said that, let me directly jump into this discussion. Let me directly jump into the marathon and revision things. So before I go there, a few things I have to mention here. So the material which I'm going to use here, you'll be able to find it. I think they might have already shared it with you. If not, you can download it from my websites and all. You'll be able to find the links in any of my YouTube videos description. So just visit there. You'll be able to get the things and all to download. So you can download it from my website, you can download it from my app and all. So this material you can download it. Along with that, whatever notes which we use, and here and there we'll be making use of some charts and all that notes, this running notes, this charts, whatever I'm going to use throughout this revision, everything will be uploaded at the respective places that will be informed to you. I will show you also at the end of this thing. So from there you can download. And I want this class to be completely interactive. This revision has to be interactive. It should not be a one-way communication where I'm speaking, I'm barking, and you're just staring at me and you're just watching at me. So that is not the way I expect the things to happen. So I do expect you to participate. Okay. So will you participate? You have to. You have no option. You have to participate. So either you participate voluntarily or I will make you participate. So better you choose the option which is more suitable for you. So let us have the interactive session, whatever 2 days of time we have. So let us have an interactive session. It should not be a one-way communication. It should be a two-way communication. The better you participate, the more rigorously I will be covering the concepts. Fine. Right. Okay. So let us jump into the revision now. So we have many chapters to cover. So if you follow my index, this is actually my material. You can trust this material. I can say it with 100% confidence because I did not use any brain here for adding new content. So just what I have done is whatever content which is there in the study material, I have organized it, divided into certain chapters, divided into chapters in a proper way. And I have arrange the content. That's all. That's what I have done. I did not add any new content. I did not delete any content. Just some rearrangement has taken place for better flow. So we have done only that. So this material we are going to see throughout this session. And as you could see, we have a total of 16 chapters. As and when the time permits, as many as we could, that many things we'll try to cover up. Yeah, fine. All right. So, so as many things as we could, we'll be covering. Fine. So having said that, let me start revising the first and foremost chapter, which is going to be Introduction to Audit. So this chapter, I will not say that important from the examination perspective, but in order to have a better understanding of the subsequent chapters, in order to remember the concept of the subsequent chapters, we should have a strong foundational understanding of the basic concepts. So that's why we will spend some amount of time, not a lot of time. We'll try to spend some amount of time so that we will make our foundation clear. We will make our basic terms clear, so that later on in this from the subsequent chapters, when we start building concepts, the things will start to sink in. So that's why we'll spend some time and try to understand the basic terminology which will be used in the chapter, which will be used throughout the subject audit. So this is going to be something like a foundation for the entire subject of the GST. Okay. So what is the paper we are going to deal with? Sorry, audit. Right. So it has been just I have completed some other thing regarding GST and have come here. So that's why. Sorry. Please do correct me if I'm saying like this. Okay. Fine. Right. So introduction to the audit. So what is the title of our subject? What is the title of our paper? Auditing and assurance. So basically, we are trying to cover two concepts, right? Auditing and no. What is the title of our subject? You told auditing and assurance, no? No, you told auditing and ethics only. So I am only wrong. Fine. Yeah. So we have two concepts, auditing and ethics. So what do you think is the proportion? How much is the content of auditing? How much is the content of ethics? Just for namesake, they have kept ethics. Just for namesake, they have kept the term ethics actually. But frankly speaking, we hardly have, I will say 5%, less than 5% of the content we have in the form of ethics. Mainly the content, whatever we are having is audit. So ethics is for just namesake they have included, and we have only one chapter which is there, which is talking about the ethics and all. So apart from that one chapter, remaining what and all content, what and all chapters we have, everything, each and every chapter is relating to a concept called audit. So it becomes necessary for us to understand what is the definition of the term audit. So you might have all experienced it. You might have all got to know about it. But let me put the technical definition. So you all might be aware of the technical definition of the audit, and even I have it here before you for the purpose of your quick recap. So tell me how the term audit has been defined. This is something the definition which has been given in the standards on audit. So how the term audit has been defined? An audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. Right. So you all are very familiar. I could see it. So now, in order to understand this definition in a much better manner, were you all able to understand the things which I am speaking? Are you all able to relate to it? Able to understand? Am I audible clearly? Any confusion in my communication? Any confusion in my delivery? I don't think any. You're all able. You're all with me. You're all able to relate with me. Whatever I'm trying to say. Is my voice clear and comfortable? It is not so sweet. It need not be also, because I'm not going to sing any song here, right? So, but I think it is pleasant enough for your ears to listen. Okay, right. Fine. So this is how the term audit has been defined. So audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. So now here I have already marked some important terms in this definition. So what are the important terms in this definition? So number one, they say independent examination. Then they say something called financial information. Then they're talking about profit orientation and form of the entity. Then finally, ultimately, they say you have to express an opinion. So let us get familiar with these terms. So when I say you are supposed to do an audit, just imagine that you have completed your chartered accountancy. Imagine, no, free of cost. No one is going to charge from you. So you have completed your chartered accountancy, you have become a CA, chartered accountant, you have become ACA, FCA, ACA, you have become. So someone is calling, I'm your client. Say, imagine you're sitting in your office. I came to your office and I told, boss, I'm a businessman. I want you to do the audit. So definitely you will accept. Because why? Because I'll pay you the fee, no? So I'll pay you the fee, you will accept. So when I say you are supposed to do audit of my entity, what exactly you think you're going to do there? When I say audit, what exactly happens in the audit? What is the main thing which is coming to your mind? What I do in the audit? Examination, not going and writing the exam. So what do you mean by examination? Verification, checking, scrutinizing. So when I say you are supposed to do an audit, you are required to do some verification, some inspection, some examination, some scrutinizing you're supposed to do. And that examination is not a normal examination. That verification is not a normal verification. That is a what kind of verification? Independent verification. That should be a what? Independent verification. So what do you mean by independent? Independent means free from influence. So we should not be influenced by others. We should not fall under the influence of others. If you feel something as right, we should be able to say it is right. If you feel something as wrong, we should be able to say that as wrong. We should not change our decision according to what other person wishes. So if you are required to express an opinion, but before that, if you are required to say something, for example, you found something wrong, you are required to say this is wrong. But before saying your opinion, you have a thought in your mind. If I say this is wrong, what the other person will think about? What the other person will face the consequences? The moment this thought comes to your mind, are you independent there? Definitely not. So that ability to take decision without any influence, not coming under anybody's influence, that quality, that characteristic of a person, we call it as independent. So we are all supposed to be independent. When we go and when we complete our qualification, when we go and start offering services to the society, we are all supposed to be independent. We should be free from influence. Without any influence, we are supposed to do the examination. So what actually happens in the audit? Tell me. Examination is going to happen. How that examination is going to happen? In an independent manner, it is going to happen. Okay, one thing got cleared. Now, what is the thing which you are going to examine? Financial information you are going to examine. So what do you mean by this financial information? Exactly. So we often hear the term financial statements. So what do you mean by financial statements? Financial statements is an inclusive definition. So we have two kinds of definitions: exhaustive, inclusive. The audit definition, whatever you see here, that is an example of exhaustive definition. They did not say what is included in the audit. In fact, they have mentioned what exactly is audit. But however, we have some categories of definitions which will not say what is the exact meaning of the term. Instead, they say what is included in the meaning of the term. So financial statements is an inclusive definition which includes balance sheet, statement of P&L, cash flow statement, statement of changes in equity, and notes to accounts. This is what included in the financial statements. So as an auditor, I am saying you are required to independently examine the financial information. That means, are you going to examine the financial statements? Does the term financial statements and financial information both mean one and the same? No. So to this financial statements, we have to add the source. What is the source on which you have prepared these financial statements? Books of accounts. So that books of accounts along with the financial statements both put together, that collective information, we are going to call it as financial information, and that is what you are going to independently examine. So if I am asking you to do the audit, you are supposed to come and independently examine my books of accounts and financial statements. The next part of the definition says irrespective of its size or legal form, which means it doesn't matter. Size of your client doesn't matter. And also legal form of your client doesn't matter. It doesn't change the significance. It doesn't significantly change the scope of the audit. So what do you mean by irrespective of size? Which means size of the client doesn't matter. Say for example, you are conducting audit of a company which is doing some thousands and lakhs and crores of turnover of the company, biggest conglomerate of India, Reliance, Adani, etc. For these entities, if you are doing audit, what you are supposed to do there? If those entities have appointed you as an auditor, what you are supposed to do there? independently examine their financial information. I'm a small entity, I'm a small company. Take for example, I'm a small company, X Limited. I have started one small company. I hardly make a turnover of 1 CR for the entire year. If I'm asking you to do the audit for me, what you will do for me? Independently examine the financial information. So you tell me, because of the size of the client, whatever you are going to do, is that changing? No. See, volume of your work will increase, but wherever it is, you are required to do the same thing. So whether you do it for the big entity, whether you do it for the small entity, you are required to do the same thing, but volume of your work will get increased. That's it. Similarly, even legal form, irrespective of the legal form, they say, which means even legal form of your client also doesn't matter. What do you mean by legal form? Legal structure, how your entity is legally recognized. So if you want to start a business, you can give different kinds of legal structure to it. You can start it as a sole proprietor. If you want to join your partners, you can start it as a partnership firm. If you want to join, if you want to go on a bigger scale, you can create it as a company. So even that also doesn't matter. Size doesn't matter. Legal form doesn't matter. If I'm conducting audit of a company, they will maintain books of accounts, financial statements. They will prepare financial statements as per Schedule 3 format and all. I will go and independently examine that. If I'm conducting audit of a sole proprietor, that sole proprietor also will maintain books of accounts. He will also prepare the financial statements. Might not be as per Schedule 3, but he will have that T format of the balance sheet and P&L that I'm going to independently examine and express my opinion. So size of the entity doesn't matter, legal form of the entity doesn't matter. But one more thing we have missed out here, even whether profit oriented or not. Whether the entity whose financial information you are verifying, whether that entity is a profit making entity or is it a non-profit making entity, will that matter or doesn't matter? Will that significantly change my audit or will that not significantly change my audit? That is not going to significantly change whatever I'm supposed to do in my audit. So if it is a profit making entity, say for example, I'm running a business, I'm a profit making entity, I will maintain books of accounts, I will prepare financial statements, I will prepare the balance sheet, I will prepare the P&L. Some trustee is there, some charitable institution is there, some religious institute is there. They are also organizations, but non-profit organizations. But they maintain books of accounts. They will have collections, donations they will have. For that, they will maintain receipts book. They will spend the money. They will have the assets. They will have their liabilities. They will also prepare their financials, but they will not call it as P&L. Instead, they will call it as receipts and payments account, income and expenditure account, balance sheet will be there. So if I have been called by some charitable institution, I have been called by some religious institution and asked me to do the audit, what I will do there? I will independently examine those books of accounts. I will independently examine that financial statements. Even profit orientation also doesn't matter. So three things doesn't matter for audit. What are they? Profit orientation of the client, size of the client, legal form of the client. Any of these three doesn't significantly change my scope of audit. Everything, in all the cases, everything is going to remain the same. My ultimate objective will remain the same. I'm going to independently examine the financial information. See, when we are putting some effort, see, we are here also we are putting the effort by way of independently examining the financial information, that is financial statements and books of accounts. Definitely I'm putting effort. Effort will be useless unless you have an outcome. Definitely, right? This applies for everything. So whatever efforts you are putting, that will become useless unless you have an proper outcome. So by way of doing audit, we are also putting efforts. We are doing independent examination of the financial information. There should be some ultimate outcome of it. If without any outcome we are doing it, there is no purpose of that. So what is that ultimate outcome of the entire process of the audit? What is the ultimate objective? That is addressed in the last part of the definition, which says what? The ultimate objective is to express an opinion thereon. On what? Exactly. What you are verifying? Financial information. On what you are supposed to express your opinion? So whatever information that you have verified, on that only you are required to express your opinion. Clear and comfortable, everybody? See, you take any opinion in this world. You take any opinion in this world regarding any person, any object, anything, any place, anything, any tangible, intangible thing. If I ask you to express an opinion, that opinion will fall under any of the two categories. What are they? Either a good opinion, you can say, bad opinion, you can say. Either you can say a positive opinion or you can say a negative opinion. So even in audit also, there is no exception. Even audit is also not an exception for these opinions. Even in audit also, when I have to express my opinion on the financial information, it will broadly fall under any of the two categories. Either a positive opinion or a negative opinion. If you are required to give a comment on a person, So whether that person is a good person or a bad person, you have only two options. Either you will say he's a good person, or he or she is a good person, or he or she is a bad person, either a positive opinion or a negative opinion. Similarly, if I ask you to share your in opinion on the financial information, if you find that financial information is good, it is correct, it is giving a true and fair view, then you will give a positive opinion. On the other hand, if you find that whatever financial information that you have verified, it is not giving a true and fair view, some mistake is there, something is wrong, might be profit is calculated wrongly, expenses are overstated, incomes are understated, assets are overstated, assets are understated, even balance in the notes to accounts some wrong disclosures are there, whatever it is, you don't want to say financial statements are giving true and fair view because there is something wrong with the financial statements. Then you will say what, these financial statements are not giving true and fair view. That opinion we call it as negative opinion. So either we have a positive opinion or we have a negative opinion. That only in audit terminology we call it as positive opinion. Other name for that is what? Unmodified opinion. We call it as unmodified opinion. And whatever negative opinion we have, for that we have a name called modified opinion. The logic behind these names I will tell you later in the audit reporting chapter, but just for the time being now, I want you all to be familiar with the terminology. So positive opinion, when I say financial statements give a true and fair view, so I'm giving a positive opinion. So that in the audit terminology, we are going to call it as a unmodified opinion. I want to say something is wrong with the financial statements, then that opinion will be a negative. I will comment in a negative way on the financial information. That opinion is a modified opinion. Comfortable? So this is what the entire definition of the audit. So we will independently examine financial information, we will examine profit orientation doesn't matter, size doesn't matter, legal form doesn't matter, and my ultimate outcome is to express an opinion. Very good. Next. So what are the objectives of the audit, or what are the objectives of the auditor? Right. So I have already told you the ultimate objective of the auditor is to express an opinion. That is on a broader term. That opinion, when I talk in very specific terms, the auditor is required to express opinion specifically relating to two things. Specifically relating to two things. What are that two things? So the auditor is required to express an opinion whether financial statements are free from material misstatements and whether the financial statements are prepared as per applicable financial reporting framework. So these are the two objectives. So tell me, what are the two objectives? Whether the financial statements are free from material misstatements and whether the financial statements are prepared as per applicable financial reporting framework. Good. So we have a few terms to understand here. Something they say material misstatement, then they say something called applicable financial reporting framework. Let us first get familiar with these two terms. First, I will be concentrating on the second objective. What do you mean by this applicable financial reporting framework? Okay, so applicable financial reporting framework. It is a combination of many terms actually. So we'll try to understand in a phased manner. First of all, what do you mean by framework? A set of rules and regulations. Basically, if I give you some rules, say for example, if I told if you have to come and sit in this class, if you have to come and participate in this class, so you have to follow a framework. Like for example, I told you have to pay the fee, you have to come on time, you have to come in formals. I did not say it because I only did not come here, right? So if I give certain rules and all, so that rules you are required to comply, that rules and regulations you are required to comply in order to come and sit here. That I will say it as a framework. That is a framework for this class, I will say. So like that, some rules and regulations which you are required to follow in order to perform an activity, in order to do an activity, that we call it as framework. Then what is this financial reporting? So financial reporting is just an other name for accounting. So here we call it as accounting. But on a when you get older, I'm not talking in the sense of age and all. So when you get older in the sense from your qualification and all. So when you go to the industry and all. So normal accountants will call it as accounting. That function normal accountants and not so financially literate people, so they will call it as accounting. We are all having ultimate levels of financial literacy, no? After our qualification. So no, just for namesake, nod your heads here, right? See, society is believing it. Let them believe. Okay. So whether you are financially literate or not, let us keep it aside just for namesake. Okay. For the belief of the society, please nod your heads that we all are going to become financially literate after our qualification and a high level of high level of expertise we are going to have it on finance. So then when you have high level of expertise in finance, also you are working in the accounting department of some company, and someone comes and says, boss, what are you doing? You can't say I'm doing accounting. He will say, I also have an accountant, I pay him 10,000 rupees per month. Right? So they try to relate you with a normal accountant. So we should confuse them. Whatever we are doing accounting only. But we should make them feel that I'm doing something else apart from accounting, which matches with my qualification. So what you will go and say, I work in the financial reporting department of a company. I do financial reporting services also, you can say. So what is this financial reporting? Just another name for accounts only. Just another name for accounts only. See, even ICA is also very much aware of it. CA inter level, they have kept a subject, advanced accounts and all. CA final, financial reporting. Same content only, accounting only, accounts rules only. You will learn Ind AS. Here you learn AS and all. There you learn Ind AS. Here also double entry system of accounting. There also double entry system of accounting only. Everything will remain the same. Some advanced rules we will learn, but we call it there financial reporting. Why? Because even ICA is also expecting from you that you become financially very much literate. Okay, so financial reporting is just an other name for accounting. Don't write all these things in the examination, right? So financial reporting is just another name for accounting. If I have to technically define that, they say that the process of preparation and presentation of financial statements. That process I call it as financial reporting. Basically, maintaining books of accounts, recording journal entries, preparing ledgers, preparing the trial balance, preparing the balance sheet, preparing the P&L. This entire process collectively you are going to call it as financial reporting. So all the hard work, whatever you have put now in learning the journal entries, ledgers, trial balance, balance sheet, P&L and all, don't be amazed. You are not going to use it anywhere. You are not at all going to use anywhere in the today's environment. You will just know how to use the accounting software, how to pass a journal entry. That anyhow you will not do. No company will pay you 1 lakh rupees of salary to pass an accounting entry. For them, they will hire basic accountants and all. So normal BCom graduates and all will be there in the finance teams of the companies where they will pass the journal entries. So then what you will do? Prepare the ledger, trial balance, balance sheet and all. That all software will do. You are not required in the market for doing all that. So your part comes actually at the analysis. So reporting we do. So some interpretations we do out of that data, we do the analysis where something is going wrong. That decision making, that is where a chartered accountant will add a value addition. Fine. So whatever it is, what do you mean by financial reporting? The process of preparation and presentation of financial statements, that we call it as financial reporting. Then they say applicable financial reporting framework. What do you mean by this applicable financial reporting framework? First of all, it is whose responsibility to prepare and present the financial statements? It is always and always the responsibility of management to prepare the financial statements, not with the auditor. Even though practically you do it, but it is not. So always the responsibility for preparation and presentation of financial statements rest with management of an organization. So now the management, when preparing and presenting their financial statements, keeping in mind the nature of the organization, keeping in mind the purpose of the financial statements, they will choose which rules and regulations they have to follow in the preparation of the financial statements. Who will choose? Who will adopt? Actually, the perfect terminology there is who will adopt. So who is required to prepare financial statements? So they only should decide, no. Keeping what in mind, they have to decide nature of their organization, purpose of the financial statements. They have to decide which set of rules and regulations they have to follow in the preparation of financial statements. That chosen rules and regulations, that chosen framework by the management, that we call it as applicable financial reporting framework. So once again, who will adopt applicable financial reporting framework? Management, not auditor. What auditor should do? Whether really the financial statements are prepared as per applicable financial reporting framework. Say, for example, a company like Infosys, the management, while preparing the financial statements, keeping in mind the nature of the organization, which is a company, keeping in mind the purpose, these are for the everybody's use. They decided that they will follow Schedule 3 and accounting standards for preparing their company's financial statements. Now, Schedule 3 and accounting standards will become applicable financial reporting framework for Infosys. So take for example some banking company, S Bank is there. While preparing the financial statements of the S Bank, the management thought that keeping in mind the nature of the organization, which is a banking company, and purpose of the financial statements, they have chosen Banking Regulation Act for preparation of financial statements. That becomes their applicable financial reporting framework. So management will adopt applicable financial reporting framework. Then what is auditor's objective? So now if you come to the second objective again, that will become clear now. So you are required to express an opinion whether really financial statements are prepared as per applicable financial reporting framework. So if I am conducting audit of Infosys company has already chosen Schedule 3 and accounting standards as their applicable financial reporting framework. What is my responsibility? I will go and check their financial statements whether they have really prepared it as per Schedule 3, accounting standards, balance sheet format and all is proper or not, disclosures they have given or not, all the accounting standard related rules they have followed or not, that I will go and check. I am required to express an opinion whether financial statements are prepared as per applicable financial reporting framework which has been adopted by. Perfect, excellent. Now, we need to understand what are different types of financial reporting frameworks that we have to understand. Very, very important discussion. This discussion is going to help us out in our subsequent chapters. So there are different kinds of framework. So we can divide the financial reporting frameworks on the basis of purpose. So on the basis of purpose, I can divide the frameworks into two categories. One is a general purpose framework and the other one is a special purpose framework. So what is a general purpose framework? What is a special purpose framework? Very simple. The framework which fulfills financial information needs of various users of the financial statements. Basically, if I put it in very simple terms, very layman terms, if I have to put it, if you follow certain rules and regulations and prepare financial statements, that financial statements will fulfill information needs of various users. You follow one set of rules and regulations, many users will be satisfied. That framework, I call it as what? General purpose framework. But first we need to understand who and all are various users of the financial statements. Tell me everyone, management will prepare financial statements, but who will use the financial statements? Shareholders. They could be existing shareholders or they could be prospective shareholders. Who else? Bankers. For what purposes? To determine your credit worthiness. Who else? Government authorities, I can say, to determine whether you are making a prompt payment of taxes, whether you are correctly discharging your tax liabilities or not. For that, they want to use it. Who else? Creditors, once again to determine your credit worthiness, whether to give credit to you or not. Who else? Debtors, whether they can have a long-term relationship with you or not. So like that, even management themselves will prepare, they will also use it for the decision making purposes. So basically there are going to be multiple users of the financial statements. Everyone will have their own dedicated purpose. They have their own dedicated purpose. For their own purposes, they will prepare the financial statements. They will use the financial statements. Now, say for example, Infosys company, shareholders are having some information requirements, bankers are having some information requirements, government is having some information requirements. Do you think for each and every user they will prepare financial statements according to different rules and regulations? No. So if you pay close attention, they will release one financial statement after the closure of the financial year following accounting standards and schedule 3, which will fulfill the requirements of every user. So if the company prepares financial statements as per Schedule 3 and accounting standards, any user can download it from the Infosys website and they can use it for their decision making purposes. And that framework is fulfilling the requirements of every user simultaneously. So that framework I call it as what? General purpose framework. So Schedule 3 and accounting standards, basically I call it as a general purpose framework. So then what is the meaning of special purpose framework? General purpose framework fulfills information requirements of various users. What will be the special purpose framework? Those frameworks which will fulfill information requirements of a specific user, only one or two specific users. For them, I am following a different set of rules and regulations altogether. So that frameworks I call it as what? Special purpose framework. One popular example which we often use, banks. Sometimes a bank might ask you to prepare the financial statements on cash basis to determine your loan repaying capability. Why? Because your loan repaying capability will not be determined on the basis of your book profits. It will be determined on the basis of your cash profits. So the banker is asking you to prepare the financial statements on cash basis. You prepared on cash basis. Generally in Schedule 3 and accounting standards, we follow accrual basis. But banker is specifically asking me to prepare the financial statements on cash basis. I prepared, gave it to the banker satisfied, he gave me the loan. If I take this copy of the financial statements which are prepared on cash basis, go and give it to the government and say I will pay tax according to this only, what the government will do? Tomorrow you will have a notice. So what this financial statements, whatever you have prepared, that is fulfilling requirements of only specific user. So that will be considered as a special purpose framework. If I have to give you one more example, say one company is there, X Limited. So there is another entity, Y Limited. They want to acquire X Limited. They want to acquire X Limited. So now when they want to acquire X Limited, they need to determine purchase consideration. For the purpose of determining purchase consideration, we know it will be determined on the basis of balance sheet. But this acquirer doesn't want to determine purchase consideration as per the general purpose financial statements. He gave specific instructions. Value the assets on this basis, value the liabilities on this basis. He gave clear set of instructions. Only those instructions are required to be followed in the preparation of balance sheet. Don't follow accounting standard. Don't follow whatever accounting standard say. Don't follow whatever schedule 3 says. This acquirer told, I will give you standard set of rules. Prepare the financial statement as per that rules only. So this entity has prepared the financial statements according to that given set of instructions. That will fulfill information requirements of only Y Limited, acquirer. If I go and give that copy of the financial statements to shareholders, will they accept? If I go and give it to the banker, will they accept? Well, if I go and give it to the government, will they accept? No. Here also I have followed one framework which is fulfilling information requirements of only specific user. This is also an example of special purpose framework. Understood? Right. So now if the general purpose framework is required to satisfy various users, I told general purpose framework is required to fulfill information needs of various users. If it has to fulfill information requirements of various users, it need to have certain characteristics. So what are that characteristics of general purpose framework? They say it should be following generally accepted accounting principles. They should follow generally accepted accounting principles. Number two, it should be prepared periodically for a specific duration. They will be prepared. So what will be that specific duration? Generally in India we have year. Yearly financial statements will be prepared, and in India we have a financial year which is starting from April and it will end on March. And similarly it will be following accounting standards. So like this, it should have a certain characteristics. So only when the general purpose framework has these characteristics, that's why we say it will fulfill information requirements of various users of the financial statements. So this is what the types of frameworks on the basis of purpose. What are they? General purpose, special purpose. Now there is one more category of framework. It is going to be very, very important, which is on the basis of presentation. So on the basis of presentation, we can divide the frameworks into further two categories. One is a compliance framework and the other one is a fair presentation framework. Everybody, are you all with me? Right. So on the basis of presentation, how many types of frameworks are there? Two types. What are they? Compliance framework and fair presentation framework. So what do you mean by this compliance framework? First, we will try to understand the compliance framework. So they have defined the compliance framework like this. So they say that compliance framework refers to such a framework where the financial statements are prepared as per the requirements of such framework without any deviation. That means, for example, if you are required to prepare financial statements according to some rules, and if I say you are required to strictly follow the rules, whether by following that rules you get a true and fair view or not doesn't matter, but you are required to strictly follow the rules whatever I am giving. Deviation is not permitted no matter whatever happens, whether you get a true and fair view, whether you don't get a true and fair view, whether your profit is getting inflated, profit is getting reduced, all that doesn't matter. If there is a framework which asks you to follow the rules strictly with zero deviation, no matter whatever happens, you are not permitted to deviate at all. So such frameworks, I call them as what? Compliance framework. Without any deviation. Deviation will not be permitted at all. Like in the previous case, the banker has asked us to prepare the financial statements on cash basis. We know if we prepare the financial statements on cash basis, that will not give a true and fair view of my profit. That will not give me a true and fair view of my financial position. But I have followed strictly without any deviation, because if I have to get a loan, I have to follow. So where a deviation is not permitted, that we call it as compliance framework. Then what is a fair presentation framework? So for fair presentation framework, they say that it also refers to a framework in which financial statements are prepared according to the requirements of such framework. Here also, we will follow whatever requirements of the framework are there. When you are preparing financial statements, we will try to follow whatever rules which have mentioned. But here we will have a freedom. Here we will have a freedom, little freedom we will have. What freedom we will have? Either we can deviate or yeah, let me put it this way. Either we can provide additional disclosures beyond the requirements of the framework, or we may even deviate from the requirements of such framework for the objective to achieve fair presentation. See, the names itself will bifurcate. Compliance follows strictly. Fair presentation, here the emphasis, here the focus has not been put on following the rules, but instead the focus has been kept on achieving fair presentation. So if we analyze this definition in a detailed manner, if it is a fair presentation framework, there also, to the extent possible, we will try to prepare the financial statements by following rules. But here we have a little freedom. What we can do, we can provide additional disclosure, which means what? We can add an extra explanation beyond the requirements. Even though not mentioned in the framework, we can give extra information, extra disclosures I can give. Or even sometimes I can deviate. What do you mean by deviating? Ignore whatever has been mentioned in the framework, follow something else altogether. So either you may provide additional disclosures or you may deviate from the requirements. But with what objective you are given the permission? To achieve fair presentation. It doesn't mean in whatever manner you want, you can deviate. In whatever manner you want, you can provide additional disclosure. You are permitted to do it only when you have a objective to achieve fair presentation. If you believe by giving extra disclosure, if you believe by deviating, I will have a better presentation, fair presentation, but the financial statements will give fair results. If you have that conviction, then only you are supposed to deviate, or then only you are supposed to provide an additional disclosure. So one simple example which we often use in our regular classes, the same example we'll try to use it here, that will simplify the things a lot. So say for example, a company has purchased a plant and machinery amounting to 10 lakh rupees. So now, as per the Schedule 3 and accounting standards, we have two methods of depreciation. Either we are required to follow SLM or we are required to follow WDV. Even the rates of depreciation are also given in the Companies Act itself. They have given the rates of depreciation also. Say for example, under SLM method they are saying 15% depreciation. Under WDV method they are saying 20% of depreciation. So if I have to strictly follow the framework, what I should do? I should charge a depreciation either of 1,50,000 rupees, assuming the terminal value to be 0. Don't come and argue, sir, 5% residual value as per the Companies Act. For the simplification, we are ignoring it. So if I have to follow SLM, I have to charge 1,50,000. If I have to follow WDV, I have to charge a depreciation of 2 lakh rupees. If it is a compliance framework, if the framework which I am following is a compliance framework, either my depreciation should be 1.5 lakh rupees or my depreciation should be 2 lakh rupees. No deviation is permitted. Now, if I give you some extra information regarding the usage of this plant and machinery, this plant and machinery has been designed to exactly produce 10,000 units. After 10,000 units, it will stop working. And in year one, in the first year of purchase, I have used it for manufacturing 2,500 units. I have used it for 2,500 units. Now, looking at the pattern of consumption of this plant and machinery, some other method of depreciation sounds even more reasonable. What is that? Production units method. So if I follow production units method, if I go by that logic, 25% of the machinery I have already used in the year one. So my depreciation should have been 2,50,000. Which one is a fair presentation? Why it is a fair presentation? Because the depreciation method should reflect actual consumption pattern. You tell me, is 1,50,000 or 2 lakh or 2,50,000 is a much better presentation of the consumption pattern? 2,50,000 betterly reflects the consumption pattern. So if I follow a compliance framework, once again I am telling, if I am following a compliance framework, what is reflecting the consumption pattern? I will not worry. I will charge a depreciation as either 1.5 lakh rupees or 2 lakh rupees. But say the framework which I am following is a fair presentation framework. Here I have a freedom. What freedom I can do? So either provide extra disclosure. Sir, how can I provide extra disclosure? So how can you provide the extra disclosure is, so 1,50,000, 2 lakh. So what you can say is, in the statement of P&L, you will charge the depreciation as either 1.5 lakh rupees or 2 lakh rupees. But I will add a note, which is not required. The accounting standard schedule 3 did not ask me to add that note, but on my own choice, I will add a note. In that note, I will say I have charged the depreciation as 1.5 lakh as per the provisions of the Companies Act. But looking at the consumption pattern, some other method of depreciation is more appropriate. If I would have followed production units method, my depreciation would have been 2,50,000. My profit would have been this much. This extra disclosure I am giving, is it required as per the framework? But still I am doing. Why I am doing it? So that if a user reads this point, he will have a better understanding. That will result in even more fair presentation. If that freedom is there, I will do that. Or sometimes what I can do is I can altogether deviate. So what do you mean by deviating here is in my statement of P&L, I will neither charge 1.5 lakhs or 2 lakhs as depreciation. I will directly charge 2.5 lakhs as my depreciation. Here what I have done, I have ignored whatever has been told in the framework. I have ignored. I have followed something else. What is my whole objective of doing this? To achieve that fair presentation. Clear? Able to understand? So if the framework is giving you that freedom to either provide additional disclosure beyond the requirements of the framework or deviate altogether from the requirements of framework with an objective of achieving fair presentation, that frameworks we call them as fair presentation framework. Okay. Now I have a question for you. See, the companies are there. Today we have listed companies. What do you mean by listed companies? Which are listed on a recognized stock exchange. See, on all these listed companies, there is a mandatory requirement. They have to prepare the financial statements and they have to upload that financial statements in their website, and also you'll be able to find it in the stock exchanges. Yes or no? Right. So you'll be able to find them. Those financial statements which you find in the company's website. Now also if you go and visit any website, don't check it now. So check it later. If you visit any official website of the company, there will be something called investor relations. A tab will be there. One thing you will be able to find in their website, investor section or investor relations, you will be able to find. If you go and check there, you can download the financial statements. So you are all downloading, assume you have downloaded the financial statements. Are they general purpose framework or they special purpose framework? They are all general purpose framework. Why? Because that information is getting used by everybody. Shareholder also will download from there, creditors also will download from there, debtors also will download from there. Even if the government wants, they will not download. You only have to go and give it, because you can't say the government, if the income tax department is sending the notice, please submit your financial statement, you can't say go and download in my website. So you have to submit a copy of the financial statements, but there also you will submit the same copy, whatever is uploaded on the website. So that is a general purpose financial statements. Why? Because that will fulfill information needs of various users. Is that a compliance framework? Is that a special purpose framework? Understood what you told? It is a general purpose framework. On the basis of purpose, you are all clear. Now they have followed rules, no? They have followed some framework, no? If we categorize on the basis of presentation, are those financial statements prepared by the companies, is it a compliance framework or is it a fair presentation framework? Not compliance, not fair presentation, fair presentation. Why not compliance? They are following, no? Infosys company, let us take an example of Infosys company. They have prepared the financial statements, uploaded them on their website. Don't you think they would not have followed from schedule? They have not have followed Schedule 3 and accounting standards. Are the companies permitted to deviate from the Schedule 3 and accounting standards? Then it should be compliance framework, no? Very good. So let me clarify that point for you. See, yes, companies will follow Schedule 3 and accounting standards. So actually, sections of the Companies Act will talk about it. So if you go to the respective section of the Companies Act, which is talking about financial statements, if you read that section, they say the company shall prepare the financial statements as per Schedule 3 and accounting standards and achieve a fair presentation, they will say. So they are putting an emphasis, even though the sections of the Companies Act say you are required to follow Schedule 3 and accounting standards, but they keep more emphasis on they should give a true and fair. But still, some people will fight with me. Sir, even though they are telling true and fair view, but still they are saying follow Schedule 3 and accounting standards. No, I will treat it as compliance framework. No. If you dig deeper into that sections, you'll be able to find one subsection which says, in case if you want to deviate from the accounting standards, give a disclosure. Why you have deviated, give a disclosure. That they are telling in the section itself. In the section which talks about the preparation of the financial statements, in the same section they have told this. If you want to deviate from the accounting standards, deviate, but give a disclosure. That means indirectly they are giving a permission for you to deviate from the requirements of accounting standards. If you believe that, that will achieve a fair presentation. Understood? So Companies Act will permit us to deviate from the requirements of Schedule 3 and accounting standards. So that's why whatever financial statements you see today of all the listed companies on their websites, on the stock exchanges, all those are fair presentation framework, and on the basis of purpose, they are all general purpose financial statements. Understood? In general purpose and compliance, in fair presentation and compliance, where true and fair view is always guaranteed. In the fair presentation framework, the true and fair view is always guaranteed. What about compliance framework? May be there, may not be there. We can't say it. So it could be there, it could not be there. And most of the special purpose financial statements are prepared as per compliance framework, and most of general purpose financial statements are prepared as per fair presentation framework. Understood? So what we have discussed till now, we are talking about the purposes with different types of framework on the basis of purpose too, on the basis of presentation too. What has driven us till here? Where our discussion started, where we are. So we have discussed what is the definition of audit. Then we have discussed objectives of audit. We have seen two objectives: whether financial statements are free from material misstatements, whether they are prepared as per applicable financial reporting framework. So we understood what is an applicable financial reporting framework. Then we have understood various types of framework. Okay, so once again, if we go back to the objective, what is the objective of the auditor? To express an opinion whether financial statements are prepared as second objective. We'll come to the first later. Till now, we have covered only second objective. So we are required to express an opinion whether financial statements are prepared as per applicable financial reporting framework. Comfortable, right? So now, if you come to the first objective. So what is the first objective? Whether the financial statements are free from material misstatement. Whether the financial statements are free from material misstatement. So here also they have given two terms. Let us try to break it up. First, we will try to understand misstatement. What is the meaning of the term misstatement? In simple terms, in layman terms, if I have to put it, statement means what? Stating something. You are making a statement. You are trying to convey something about some object or something. Misstatement means what? You are conveying the information in a wrong manner. Misstatement in the financial statements means what? You are trying to convey some wrong information in the financial statements. Who is trying to convey? Management. So if the management is trying to say something wrongly in the financial statements, that I call it as misstatement. If I put it in simple norms, can I call it as simply a mistake? A mistake in the financial statements, that I call it as what? Misstatement. Simple things. But simple things don't work in audit. Basically, in exams, it will not work. In all other subjects also. Right. So we have to complicate it. See, so this I always say, we professional make money first by complicating the simple things. One simple thing will be there. We will complicate. So once again, that we won't the complicated thing. We only will simplify. So we have to make money. No, that's why you are coming, sitting here, putting all the efforts, learning, going through all the struggle and all. Yes or no? Right. So let us complicate this. ICA thought, not ICA. Sorry, standards on auditing, standards board. Right. So these are all standards from international organizations. So we have basically adopted that international standards only. So in that standards, they try to complicate in such a way by giving one complex definition. They have told that if there is a difference between amount, classification, presentation, disclosure, which is there in reported financial statements, and amount, classification, presentation, disclosure required as per applicable financial reporting framework. If there is a mismatch between the two, that difference only we call it as misstatement. So how did they define a difference in amount, classification, presentation, disclosure, which is there in reported financial statements, and amount, classification, presentation, disclosure required as per applicable financial reporting framework. That difference only we call it as what? Misstatement. If I put it in simple terms, say for example, as per some accounting standard, fixed assets are required to be recognized at 10 lakh rupees. But the company, the management, the financial statements, whatever they have already reported, in that they have shown the fixed assets as only 8 lakh rupees. There is a difference in amount which is there in the reported financial statements and the amount which is required as per applicable financial reporting framework. This difference we call it as what? Misstatement. Or sometimes there could be a difference in classification. As per some accounting standard, you are required to treat certain item as capital expenditure, but in the financial statements prepared by the management, they have treated it as revenue expenditure. Difference in classification. This also can come under misstatement. Or there could be a difference in presentation. Schedule 3 asks you to prepare the financial statements in a vertical format. The management has prepared it in a horizontal format or T format. Difference in presentation. Or even a difference could be there in disclosure. What do you mean by disclosure? Notes to accounts. Whenever I say disclosure, I'm talking about notes to accounts. One of the most ignored aspect of the financial statements. When we say financial statements, we always imagine numbers. We are all numbers people, no? So people generally treat us like that. When we say chart accountant, you are good at math. When I ask you to do some simple calculation also, you will take the calculator. But they all feel that we are excellent in our math. But we are actually very poor in math. Basic math we can't do. Even we don't have any advanced math to use also. Hey, what math you will do in entire accounting here? Addition, subtraction, multiplication, moves to complex division. Yes or no? No algebra, no calculus, no derivatives, that nothing. You are all not going to use this. So when we say financial statements also, even we financial background people also, when we say financial statements, the thing which will come to our mind is numbers. Profit figure, balance sheet figure, assets figure, turnover figure. Only we think about in terms of numerical figures only. But financial statements contain one more important information. That thing will not come to our mind only. Why? Because we have to read. No, we have to read. Numbers we can absorb quickly. That's why audit paper also you ignore. No, because you did not solve. You have to read. That's why this is a trouble for you. So wherever you have to read, that is a trouble for you. So, but notes to accounts is a very important aspect of the financial statements and a very ignored aspect of the financial statements. So, what information will be there in the notes to account? Tell me, yeah. I know you will not read. At least you have an idea, no? What will be there in the notes to account? It will contain all the significant accounting policies. How they have valued the fixed assets, how they have charged the depreciation, what revenue recognition policy they have followed, how they have valued assets, how they have valued employee benefit expenses. So basically, whatever accounting policies they have followed, everything will be explained. On the face of the balance sheet, on the face of the P&L, there are various items. If you want to know the breakup, you have to go and watch it at the notes to accounts. When I say breakup, what here? Your faces are becoming dull. Huh? So don't go into the personal things and all. Okay. So when I say breakup, I'm talking about details. Okay. So no going back and digging your past and all. Okay. Gone is gone. Stay in the present. Fine. So if you want to know the breakup of the details which are there on the face of the balance sheet and P&L, so you have to go and find it where? In notes to accounts only. So notes to accounts is a very important information. So we often, when I say a mistake in the financial statements, what you are imagining, what came to your mind immediately? Profit has been overstated, assets has been understated. This is the thing which has come to your mind. But when I say misstatement need not always be in numericals only. Misstatement could be even in descriptive explanation. If I put it in other terminology, misstatement need not always be quantitative. Misstatement can be qualitative. Misstatement need not always happen only in P&L, balance sheet, statement of cash flows, or statement of changes in equity. Misstatement can even happen in notes to accounts also. Next time, when I say misstatement in the financial statements, even the notes to accounts also should come to your mind. If the management tries to explain wrong accounting treatment, they are following something else. If I have to put in very simple terms, SLM method they are charging depreciation, but in the notes to accounts they have told they are following WDV method for depreciation. Misstatement, not just a misstatement, blunder misstatement. I will say, I will give adverse opinion if I am there. Yes or no? So why? Because basic thing they have violated there. So misstatements can even happen in notes to accounts also, not just a normal misstatement, even pervasive misstatement also can happen in a notes to accounts. What is pervasive and all? We will talk about it later. Very bigger misstatements also can happen in the notes to accounts. So some auditors have been debarred from practice because of not finding a misstatement in the notes to accounts also. Not just in balance, not just in figures and all. Some auditors were not able to identify misstatements. Basically, they're I will not say they're not able to identify. They have helped the management to misstate the notes to accounts, even that has also led them to face ban from doing the audits and all. So such a bigger, crucial, pervasive misstatements also can happen even in notes to accounts. So next time when I'm going to say misstatement in the financial statements, will you imagine only numerical misstatements or even qualitative misstatements also? Qualitative misstatements also should come to your mind. So this is what basically a misstatement means. The difference between amount, classification, presentation, disclosure, which is there in reported financial statements, and the amount, classification, presentation, and disclosure, which is there in applicable financial reporting framework. That difference we are going to call it as a misstatement. But this is something called material misstatement. Now, what is material misstatement? What is material? Something which is significant, something which is major, something which is important. But there is no standard definition for material. Something which I say, something which will influence the decision of users of the financial statements. Because of a misstatement, if a user's decision is getting influenced, if a user's decision is getting changed because of a misstatement, that misstatement we call it as material. I am conducting audit of Reliance, lakhs and crores of turnover of a company. 1 crore of fraud I have found out. Is it material? Because that will not impact anybody's decision. If I have to invest my money in the company, Reliance Industries Limited, before investing, I have read the financial statements. I came to know there is a fraud amounting to 1 CR. Will I stop myself from investing? That 1 CR will go in rounding of error in the Reliance financial statements. So that is not at all material. Even though I came to know there is a misstatement in the financial statements, but I did not change my decision. As a user, I did not change my decision. That misstatement will not be considered material. Say a company which is hardly having a turnover of 10 CR, that the same misstatement of 1 CR has taken place. Will you stop yourself from investing in that company? 100% yes. Misstatement is same, no. One CR only. But the circumstances have changed. So a misstatement will be considered material if it could influence the decision of users of financial statements. Then we call that misstatement as material misstatement. So material is a relative term. Material is a what? Relative term. If I have to explain it, I will borrow some of the ideas of the Albert Einstein. So Albert Einstein has explained this. The term relativity is very important in physics, no? So Albert Einstein has explained this relativity in a beautiful manner by giving one example. So what he has told us, to give the example of relativity, he told, take for example, you have to spend 1 hour of time keeping a book in front of you and reading it. Time will feel like hell. It will not pass only. On the other hand, if I asked you to spend 1 hour of time with a beautiful girl or boy of your age, the entire 1 hour of time will just like that pass in as if even 5 minutes have also not gone by. Same 1 hour, but the circumstances have changed. That is what relativity is. So even the materiality is also a relative term. So same, the circumstances could be same, the amount could be same, the impact could be same, but the facts and circumstances will decide whether that misstatement is material or not material. So materiality is a relative term. It changes from circumstance to circumstance, facts to facts, entity to entity, company to company, industry to industry. It all depends. Understood? So that is a material misstatement. Why we are discussing about material misstatement? Come on, why we are discussing about material misstatement? Because we are addressing the first objective. What is the first objective? Whether the financial statements are free from material misstatements. So what do you mean by free from material misstatements? Should they contain or should they not contain? They should not contain material mistake. What should not contain? The financial information should not contain material misstatement. Whether the misstatements are there or not there, on that you have to give an opinion. Understood? Clear, everybody? So with this, we have covered two objectives. What are the two objectives? Whether the financial statements are free from material misstatements, whether they are prepared as per applicable financial reporting framework. So with this, till now, we have covered what is the definition of audit and also what is the definition of what are the two objectives, different types of framework, what is the meaning of the term misstatement, what is the meaning of the term material, legal form also we are done. Then what else, what else, what else? Users also we have covered. Do you want me to explain this also? Not required. They will not ask in the exam. Don't worry. So what is it? Define financial statements, define books of accounts, all this they will not ask. So now a few more terms before we proceed any further. A few more terms which we have to become very, very familiar. One term which we have to become very familiar is engagement. What is engagement? I see all the happy faces here, right? Hey, now only before happening only you will feel happy, okay? Ah, right. Experienced man is saying here, right? So what is the meaning of the term engagement? So what do you know? Something which happens before marriage. So that we call it as engagement. Is it so? See, that is only one engagement you know. But engagement is a very broader term. So what do you mean by engagement? It refers to some contract, some agreement, or a mutual understanding between two people where everybody is having one mutual promise, mutual thing to deliver. The same thing happens in the engagement, whatever you know also. So bride agrees to marry the groom, groom agrees to marry the bride with all the financial things included, right? So so that is an engagement actually. So even as a doctor, if the doctor has agreed to provide the treatment to his patient, patient will agree to pay the fees to a doctor. They have mutual promises. They have engagement. That doesn't mean they will marry. Yes or no? So even chartered accountant and a client, a chartered accountant, I have agreed to provide some audit service or taxation service to my client. Client in turn has agreed to pay me fees. We have an engagement between us. So engagement is a very broader term. It includes any such contract, any such understanding between two parties where they have mutual promises to deliver. That I call it as a engagement. Even audit is also a engagement. Where as an auditor, I agree to provide services. The client will agree to pay me the fees. So we have a mutual understanding where we have a mutual obligation to deliver. So that is also an engagement. So engagement is a very broader term. Audit is not the only engagement. We have different kinds of engagements which we chartered accountants offer. So we are after you qualify, say for your sake, if you have taken a practice, will you do only audit? If you do only audit, you are no longer going to survive in the industry in the coming 10 to 15 years. So might be statutory audits all might be gone. So you can't provide only audit engagement. See, I'm not saying our profession is in danger. See, I'm not spreading any, I'm not doing any fear mongering here. Okay, so just I'm saying other avenues are there for us to generate revenue. So till now, audit used to be a very good generator of revenue. Slowly, it has started coming down. Risk assurance, consulting, business consultancy, these are the upcoming areas where we have huge potential to generate the revenue. So our profession will have a very good future. Don't worry about it. But the only thing is we have to upskill ourselves. So whatever it is, let us come back to the discussion. So from where? Hey, you are stuck there only. Engagement over? No, no. What I was explaining in the engagement. Not only audit engagement, we chartered accountants will perform different kinds of engagements. We have something called review engagement. We have something called assurance engagement. We have something called related services engagement. All that I will explain later in the standards on auditing chapter. But for the time being now, one of the engagement which we chartered accountants do is a what? Audit engagement. Clear? Now, who is an auditor? Who is an auditor? Audit is a process of independent examination. Whoever is doing that independent examination, that person we call him as auditor. But auditor is not a single person. Auditor is a team. So tomorrow when you go and join the articleship, your partners will say, let us come. Tomorrow we will go to audit. So now when you go to the client's premises for audit, you are an article assistant. After all, article assistant. After all, article assistant. So even when you go to the client's premises, you will see the utmost respect you have never seen in your life. Watchman will open the door. He will call you, sir, come inside. The staff will come and ask you tea, coffee. They will serve you breakfast. They will be going around you, sir, you want this, you want that. Provided your client is not a relative of your partner. If your client is a relative of your partner and all these things are not going to happen. So some corporate client and all you are visiting, even though you are an article assistant, he will say the auditor has come. He will not say that bacha article assistant has come. What he will say? He will say auditor has come. So if you are a part of that team which is conducting audit, you all will be collectively called as auditor. So that team which is collectively going and doing the audit, that team we call it as engagement team, because you are the team who are going and conducting the audit engagement. So your team will be collectively called as what? Engagement team. Sir, who will be there in the engagement team? Engagement partner, basically your partners in the firm. So those who have started the firm and all, so those are partners. But engagement partner, I will specifically talk about it later. So engagement partner, basically the main person in the firm, the partner of the firm, we call him as engagement partner. And who else will be there? Article assistant, senior article assistant, junior article assistant, second year senior, first year junior, with 500 rupees increase in the stipend for the second year, right? Then audit manager will be there. Basically audit manager in the sense, some big audit firms, they will recruit in even the qualified professionals also as employees. So that for them we generally call them as audit manager. And someone will be called paid assistant. Like you give you extra, some people will give them extra qualification, semi qualified chartered accountant, which is not recognized by institute. I'm saying you can go and inquire even downstairs also. We don't have any qualification called semi qualified chartered accountant. It is not there. It is something which we ourselves have given. So there is no degree which will come and say you are a semi-qualified chartered accountant. So basically, if the firm wants to appoint some people who have cleared CA inter, but they are not unable to clear CA final, they are completed their articleship, that kind of people they will recruit. They will give them a designation paid assistant. Or even this BCom graduates, MCom graduates, MBA graduates, they also recruit them. For them, they give a designation called paid assistants. So this entire team, we call it as what? Engagement team. But once again, I have to tell you one more thing. Say for example, there is an audit firm XYZ and Co. There is an audit firm is there. In that audit firm, some 10 article assistants are there, sometimes 10 paid assistants are there, 5 audit managers are there, 3 partners are there. Totally how many staff we have? 28 staff we have. I told you, no, you are not good at math, I know it. So 28 staff we have. So this 28 staff, this firm has got an audit. They have got an audit of the client Z Limited. Now will entire office will go and do the audit. Why? Because we will have multiple works. No. So what we will do, one partner out of XYZ, 3 partners, one partner will take up the responsibility. That partner we call him as engagement partner. Now out of this 10 article assistants, some 5 article assistants, some 2 paid assistants, 1 audit manager. In total here how many? 9. So total 9 out of my 28 people in the office, some 9 people we have gone and completed the audit of the client Z Limited. Now, who will be coming in my engagement team? Will entire 28 people will come, or only this 9 people will come? Only this 9 people will come under my engagement team definition, because we are the team which is going and performing the audit engagement of the client Z Limited. Understood? Clear? So in this, when I say auditor, I refer to entire engagement team, not just the partner, not just the chartered accountant. Entire team will be considered as auditor, except in 2 circumstances. When I say auditor, generally I'm referring to all my engagement team members, except in 2 circumstances. In 2 cases, when I say auditor, I'm referring to only engagement partner. In 2 circumstances. What are the 2 circumstances? When it comes to acceptance of responsibility, like for example, you have to sign a document, an audit report you are required to sign, or financial statements you are required to sign. By signing, you are taking the responsibility. Somewhere it is mentioned auditor should sign the financial statements and take the responsibility. Who should sign? Only engagement partner. If you are an article assistant, don't go and sign that. I am also auditor. I also get included in the audit engagement team. So only auditor, when I say that, only engagement partner should come and sign that. Second matter, when it comes to accountability before regulatory authorities. What do you mean by accountability? Yeah, basically facing the consequences, I will say. If you have done something wrong, if your partner has done something wrong and police have come to arrest him, so that engagement partner is not there. You are that bacha article assistant sitting in the office waiting for your partner to come. So can the police come and take you? Hey, come, you are also auditor, let us take you and keep you in the jail. No. So when it is relating to accountability before regulatory authorities, there also auditor means only engagement partner. So in 2 circumstances, acceptance of responsibility. Number 2, accountability before regulatory authorities. In these 2 cases, auditor means only engagement partner. In rest of all the cases, auditor means entire engagement team. Clear? That's all. This is what regarding the chapter intro to audit. Since we have very strong foundation now, we can happily build the concepts now. Clear? Right. So just give me a minute. Fine. So since we have completed introduction to the audit, so now we will proceed further to understand the next chapter, which is nature objective, and scope of audit. So since, as I was saying in the introduction to audit chapter, we have got familiar with only the basic terms. We got to know what is what. So on the basis of this basic terminology, we are going to build some basic concepts as a part of this chapter: nature, objective, and the scope of audit. Right. So here I will follow in different order. We will not follow the order given in the material. So we'll try to cover up, fix up the easy things first. Right. First thing I would like to ask you, is audit mandatory for every organization? Is audit mandatory for every organization? The answer is definitely not. Why? Because today we have many businesses which are running in India, but you will not see each and everybody getting their accounts audited. If that is the case, chartered accountants will be very rich. They are rich actually. Some chartered accountants are very rich, but majority are not. So if that is the case, if every person has to get their accounts audited mandatorily, then as I was saying, every chartered accountant will be very, very rich, very prosperous. But that is not the case. Audit is not mandatory for every organization. There are only a few cases where some law and regulation will say to get your accounts audited mandatorily. Like for example, if you take company. So in case of company, the Companies Act 2013 says every company is required to mandatorily undergo statutory audit. Then it is mandatory. You can't escape that. Even tax audit. Under Income Tax Act, they say in certain cases, if your turnover exceeds a prescribed limit, then you have to compulsorily undergo tax audit. In GST also, there will be some concept of GST audit, cooperative societies audit. So like this, there are a few audits which are mandatorily required under law. Then it becomes compulsory. In rest of all the cases, audit is not mandatory. But still, if a client, even though audit is not mandatory for them, still if they want to voluntarily come forward and get their accounts audited, will somebody stop? If you're a chartered accountant, a sole proprietor has come, turnover is also less than 1 CR, not liable for tax audit. But he is coming to you voluntarily and asking you, sir, please do the audit of my financial statements, of my books of accounts. Will you say no? Since there is no requirement under law, I will not do your audit. Will you say that? So you will definitely do audit if he is ready to pay you fees provided. So definitely you will be able to do audit for him. So even though audit is not mandatory, even though it is audit is mandatory only for a few entities as per various laws, but still if a client wants to voluntarily come and get his accounts audited, he can always come and get it done. So on the basis of this law, we can say audits are two categories. One is statutory audit and the other one is a non-statutory audit, like company audit, societies audit, whatever we have seen now. So these are all required under law. We call them as statutory audit. Whereas the other audits, like sole proprietor voluntarily coming and getting his accounts audited, that is a non-statutory audit. Now I have a doubt. Even though there is, see, if there is a requirement under law, clients will get their accounts audited because there is an obligation. But as I have told, sometimes people, even though there is no mandatory requirement, they will come and get their accounts audited. Why do you think they will get it done? Because they find some benefits. If there is no benefit, no one will unnecessarily come and spend their cost. No. See, businessman always spends money with purpose. So when he has some purpose, when he finds some benefit there, then only he will spend a rupee from his pocket. Similarly, a businessman, even though the audit is not mandatorily required for him, if he is coming voluntarily and getting his accounts audited, he should find some benefits. So what are that benefits of audit? These are the benefits not just for these voluntary people. Even if you are getting your accounts audited statutorily also, still you will enjoy the same benefits. So tell me, what are the benefits of audit? If you are getting your accounts audited, how you will get benefited, how the client will get benefited? So number one, it will protect the interest of the people. It will protect whose interest? It will protect the interest of those people who are not interested, who are not having a direct participation in the management. So this will apply in the case of companies. So in the company, if you buy one single share, you are also owner. If I today buy one Reliance Industries Limited share, I am also a owner. I will go and say I'm a owner of Reliance, but we know what is the ground reality there. So basically you are a owner, but you will not be allowed in the day-to-day activities. You are not a part of the management. Board of directors will not call you every day, boss, at what time today should I open the office? They will not ask you. So basically you are a person, you are not having a direct interest in the management or affairs of the company, but you want to make sure that your interest is getting protected, your money is not getting misused. You want to know it or not? So how that interest will be protected? What is the only source which the shareholder will have to know the information? Financial statements. But if that financial statements are not audited, what is the guarantee the information reflected in the financial statements is genuine? They say 1,000 crores of assets are there. Whether really 1,000 crores worth of assets are there in the organization or not, what is the guarantee? So they need one assurance. That assurance will be provided in the form of audit. So if audit is there, if audit report is there, see, basically financial statements will be prepared by the management. That auditor will verify and he will give something called a report. He will express the opinion, no? That opinion will be expressed not orally. He will express that opinion in the form of a written report. That we call it as audit report. Now this audit report will be attached to the financial statements. That set we call it as audited financial statements. So when I say audited financial statements, it is audit report along with the financial statements. That comprehensive information, the total information, I call it as what? Audited financial statements. So when audited financial statements are given to the shareholder or any user, even though they don't participate in the day-to-day affairs of the business, they will have confidence. Okay, this information in the financial statements is really genuine. Why? Because it has been verified by some independent person. Our interests are protected. So in order to protect the interest of the shareholders, audit is beneficial. What else? What else are the other benefits of the audit? Very good. You have told one benefit. What else? So here we have, so as you could see, audited accounts provide high quality information. It will increase the confidence of the users like shareholders. Not just that, it will also safeguard. Interest is safeguarded. Those people who are not associated with the management, their interest will be safeguarded. And also it acts as a moral check on the employees. Whose employees? Client's employees. See, if there is no audit, nothing is happening. Employees might have an intention of committing the fraud and even they will do it also. But however, if the audit is happening, they will have a fear. If I commit something wrong, tomorrow audit will happen. Auditor will verify. He will catch me and he will tell it to the management. Management might fire me from the company. So that fear will stop them from committing frauds and thefts. That is also beneficial for the client or not? 100%. And also it is helpful for government authorities for determining your tax liability, whether you are making a prompt payment of tax, whether you are under reporting income or stating the income at the correct rates or not, paying GST amount correctly or not. Government also want to determine. How the government can determine? If you have financial statements, but that too audited financial statements, then only they will have the confidence. And also it can be relied upon by lenders and bankers. When you go to the bank and ask for a loan, he want to know whether you have a financial repaying capability or not. How we will establish that repaying capability? On the basis of financial statements. But he will not believe normal financial statements. He will believe what? Audited financial statements. Next, it will also help you to detect frauds and errors. If the audit happens, you will be able to find out frauds and errors which are taking place in the organization. That management can rectify and improve the overall organization or not. So once again, a benefit. And an auditor reviews existence and operation of various controls. Controls will come back to that later. You can also get to know various internal controls, whether they're operating effectively or not. So these are all the benefits which lead the people, even though audit is not mandatory for them, to come and get their accounts audited. So there was one past examination question, not recently, some old past examination question is that they have one question something like this. One of the main advantage of the audit, the chief utility of the audit lies in reliability of the financial information. But apart from that, there are various other advantages also, which will help the people even though audit is not mandatory for them. State what are those advantages. Question is very lengthy, but point is, question is straightforward. So, and one more thing, examiner will try to play with you by giving very lengthy questions. By looking at the length of the question, you will get a panic attack first, right? So don't get worried. So whenever you find a very lengthy question, see, earlier when I used to write the auditing paper, question paper hardly used to be 3 sides or 4 sides. CA final question paper also used to be like that, 3 sides or 4 sides. Now instructions only 2 sides. So after that, MCQ, case scenario based MCQ, that will run for some 7-8 pages, it will go. So by the time you reach the 10th page, you have completed only MCQ, 25 marks only you have read. So now main descriptive question will come. Now in the descriptive question, lot of spacing, header, footer, sides, all the margins are gone. In between, this much space will be there. So they are also spacing and all. The question will look half of the page. So one question will look half of the page, and the question they are testing for 4 marks. So when you look at the question itself, you get a panic attack for sure. But please make up your mind, that is just a way to kill your time and make you tense. See how effectively you have handled all this 5-6 months of time of preparation, revision and all. See, that is very important. You have to handle it very well. But how you will handle that 3 hours of time in the examination hall, that is going to be very, very crucial. Very crucial. So don't just get panic by looking at the size of the question. So just make up your mind. If the question is lengthy, the question is going to be straightforward. The question will be straightforward. Or I will give you one simple suggestion. When you find the lengthy question, ignore all the shit whatever they're giving in the few lines. Just first come and read the last line. Just come and read the last line. In 70% of the cases, you will get to know the correct answer. You will get the clarity. First come and read the last line. What is the requirement? But I'm not telling it this will work for all the questions, but for 70% of the questions it will work. So first come and read the last line. You will better get the clarity. Then you read the rest of the question. Okay. So but don't write exam only by reading the last sentence only. I told you to read the entire question. But first what you do? First get what is the requirement, then read the entire question. That's what I was saying. Okay, don't follow blindly that I will read the last line and I will write the answer. No, I did not say that. Don't do the bad publicity and all. So I told you to read the last line first, then read the entire question, then write the answer. Okay, right. So these are all advantages of audit. Now talking about few more things. See, as an auditor, what is your ultimate objective? To express an opinion. But before you express an opinion, as an auditor, you are required to satisfy yourself that financial statements are not misleading anybody. As an auditor, before you can express opinion, first you should satisfy yourself. No, okay, these financial statements do not contain any misleading information. What points you will check to make sure that financial statements are not misleading anybody? What points you will check to make sure that financial statements are not misleading anybody? Guys, in audit, terminology is very important. The terminology which I am using, intentionally I am using. Why? Because in this manner only questions will be tested. They will not ask direct question. So that's why please pay attention to the words which I am using. From these words only questions will be created. So what are the points which auditor will check to make sure that financial statements would not mislead anybody? 6 basic points you are required to check. So what are that 6 basic points which are required to check? Number 1, we need to check whether financial statements are matching with books of accounts. So whatever financial statements they have drawn up with reference to the source entries or not, have to check. Number 2, whatever entries which are there in the books of accounts, whether they are supported by sufficient and appropriate evidence. There should be proof. If an entry has been recorded in the books of accounts, there should be a proof for that. So whether there is a proof, proper evidence for that happening of the transaction is there or not, that I need to check. Number 3, there should not be any omissions. Nothing should be omitted from books of accounts, and also there should not be any fictitious entries. There should not be any fake entries. There should not be any omissions. Whatever should have come in the books, it should not have been omitted. Whatever should not have come in the books, it should not have come. So no omissions, no fictitious entries. Number 4, whatever information that is getting conveyed in the financial statements, that should be clear and unambiguous without any confusion. So whatever information that is getting presented in the financial statements should give a clarity, not a confusion. It should be free from confusion, clear and unambiguous. Number 5, information should be classified, presented in accordance with the accounting standards. Basically, accounting standards are complied with or not. That is also one basic thing which I will check. In addition to that, last, I need to check whether financial statements are giving a true and fair view. They are truly and fairly presenting the information or not. I need to check. So these are the 6 basic things which auditor will check to make sure that financial statements are not misleading anybody. Clear? So what are the 6 points? Financial statements should be matching with books of accounts. The entries in the books of accounts should be supported by evidence. There should not be omissions, no fictitious entries. Information should be clear and unambiguous, and they should have complied with accounting standards, and the financial statements shall give a true and fair view. These are the basic things which we need to check before you express your opinion to make sure that financial statements would not mislead anybody. If you find this phrase, financial statements would not mislead anybody, immediately these things should come to your mind. Sometimes question could be something else also, but first thing which should come into your mind is these 6 points. Might be 90% of the chances the question might be related to these things only. Okay, right. Next. Now we will talk about what is included in the scope of audit. What is included, what is not included in the scope of audit. What you are expected to cover as a part of audit, what you aren't expected to cover as a part of your audit. Basically, what are your responsibilities, what are not your responsibilities. So first we will talk about what is included in the scope of the audit. So what is included in the scope of the audit, that we will try to cover. So when we talk about what is included in the scope of the audit, there are a few things here, 4 things which you are supposed to do. Four things. Number one, you are required to cover all aspects of the entity. When I say all aspects which are related to the financial statements. All aspects which are related to financial statements, everything will form part of your scope. But that should have either direct or indirect linkage with financial statements. Like for example, inventory verification. Inventory verification, is it related to financial statements or not? It might not have a direct relationship, but somehow that inventory verification, if I do, I will get to know what quantity of stock is there, because whatever quantity of the stock is there as on the balance sheet, that stock value only will come into my balance sheet. So somehow it is linked with financial statements. So all aspects of an entity which are related to financial statements should be covered by the auditor. All that should be verified. Number two, you need to cover as a part of your scope reliability and sufficiency of the financial information. Basically, you need to check reliability. Reliability means what? Trustability. So whether the source information, here they mainly talk about source information, whether the source information, whether the source data is reliable or not. Which source data they are referring to? Source data for the financial statements. What is that source data? Books of accounts, whether the information which is there in the books of accounts is reliable or not. Why? Because if the books of accounts are reliable, automatically financial statements also will be reliable. If the source data itself is not reliable, even the financial statements also will not be reliable. So you need to check whether the source data is reliable or not. Sir, how will I get to know whether the source data is reliable or not? So number one, as you could see here, the auditor should be reasonably satisfied. As an auditor, first you should satisfy yourself whether information in the underlying records is reliable and sufficient or not. Sir, how will I get to know whether the source data is reliable and sufficient or not? They ask you to do two things. One is you should make a study and assessment of accounting system and internal controls. How you will get to know about reliability of the source data? You have to study two aspects. What are they? One is accounting system and the other one is internal control system. What is an accounting system? What do you mean by accounting system? Simply the processes, the systems, the methods which you are following for maintaining your accounting records. Like an accounting software could be an accounting system. Voucher preparations method, that also could be a accounting system. Approval mechanism, that also could be an accounting system. Basically, whatever methods, systems, procedures, softwares which you follow in the accounting process, that we call it as accounting system. So if you are conducting audit of an entity, first you have to go and study about their accounting system, which accounting software they are using, what vouchers they are creating, which approval mechanism they are following. So all these things you need to understand. In addition to that, you should also try to understand their internal control system. So what do you mean by internal control? So basically, internal control means any policy and procedure which is designed, implemented, or maintained by the management of the organization. For the time being now, I will tell you one simple definition. More about internal controls, we will learn it in the risk assessment and internal control chapter. So if I talk in very simple terms, any policy, any procedure which is getting designed, implemented, or maintained by the management of the organization to prevent mistakes from happening in the organization. Once again, I'm telling this is not the technical definition. Technical definition, we'll talk about it. So internal controls means what? Any policy and procedure. Who is designing it? Management, top level management is designing it. For what purpose? To prevent the mistakes, to prevent frauds and errors happening in the organization. See, you will be able to experience this internal control in every aspect of your day-to-day life. We just don't know that is an internal control, but we experience these internal controls in our daily aspects. Like for example, yeah, CCTV footage. So people are installing CCTV cameras in their shops and warehouses. That is an internal control system. Why they are installing that CCTV cameras and all? To make sure that the frauds and errors will not happen, that thefts and all will not happen. Appointment of the security guards and all. So even appointment of the security guards is also an example of internal control system. Even before you are coming and entering inside that hall, you have signed that sign sheet. No, sign sheet they have signed because they want to make sure the person whoever is entering the class whether they have registered themselves or not. So they want to make sure that any unregistered person doesn't want should not enter this class. To prevent that mistake from happening, they have that taken that printout of all your names and they're asking you to sign. That also can be a simple example of an internal control system. And if we talk about multiple aspects like this, like for example, in an IT company, just like that, you can't enter inside the company. Even if an employee has to enter inside the company, there will be a biometric access. You have to show your identity card, you have to give your biometric. If both are matching, then only the gates will open. Internal control system. When you are doing a banking transaction, the banker will ask you for a OTP. One-time password. That is also an internal control system. Clear, everyone? In accounting also, so many internal controls you will be able to find. Like for example, management has set a policy before any entry can be recorded in the accounting software. It needs approval of the concerned manager. Or without the concerned manager's approval, entry will not be recorded. That is also an what? Internal control system. Sometimes organizations will have internal controls with regard to check signing power. Up to 10,000, cashier can sign the check. Then up to 1 lakh rupees, finance head can sign the check. More than 1 lakh rupees, CFO should sign the check. Once again, internal control system. So basically, an organization will have multiple kinds of internal control system. Any policy, any procedure which has been designed, implemented, and managed by the management to prevent errors and frauds happening in the organization, all that systems we call it as internal control. If you would have visited the supermarket, plenty of things you will be able to find it. From the moment you enter the supermarket till the time you come out, various internal controls you will be able to find. Security check will happen, then CCTV surveillance will be there. When you come to the billing counter, price and discount will be captured by scanning the barcode. They will not be able to enter the price and discount manually. And after every transaction, cash box will be closed. So they have to open the cash box for every amount, for every transaction, enter the amount, give the change, close the cash box. Then only the billing will open for the next cycle. And after you have done all your shopping, before you leave outside of the store, security guard will be there standing at the exit gate. He will check whatever items that you are carrying in your trolley or in your pockets, whether that is included in the bill or not. So even that check also will happen. So these are all nothing but various kinds of internal controls which we generally experience in our day-to-day life. So as an auditor, what they're asking you to do is make a study and assessment of internal controls. If you're conducting audit of any client, go to the client's premises, study their accounting system, study their internal control system. If you study their accounting system, if you study their internal control system, you will get to know whether the source data is reliable or not. If I came to know the client is using the best software in the market, they're having excellent internal control system, automatically I have that confidence or not? Yes, this client is having a reliable source data. If the source data is reliable, automatically financial statements also will be reliable. So two aspects which are required to be covered in the scope. What and all we have seen? Number one, you should cover all aspects of the entity related to financial statements. Number two, you should be able to check the reliability of source data. Now coming to the third point, you should check proper disclosures. Nothing but whether the financial information is properly presented, disclosed or not, we need to check. That is also one of the important aspects which will be covered in our scope. Sir, how I will check whether there is a proper disclosure of the financial information, or what things exactly I need to check to make sure that there is a proper disclosure of the financial information. So here also they say a few points, like as you could see. So the auditor should decide whether relevant information is properly disclosed or not. I need to check it. Disclosures in the sense notes to accounts, presentation and all I have to check. In addition to that, I should check whether the financial statements properly summarize transactions and events. Expenses are classified properly or not, current assets, non-current assets, capital assets, capital expenses, revenue expenses. So that classification, direct expenses, indirect expenses, that summarization has been done properly or not, that also I need to check. And the management in the process of preparation of the financial statements, they will make various judgments. Example of the judgment in the sense they require to use their assumptions and all. In some cases everything will not be calculated in the financial statements. If the management has to prepare financial statements, sometimes they need to make some assumptions and estimates. Like in depreciation calculation also, if you see in the formula for depreciation, there are many things which are assumptions, which are judgments. Actual cost minus residual value divided by expected useful life. In this formula, only actual cost is something which we know with certainty. Residual value is an estimate. Useful life is an estimate. Provision for bad and doubtful debts, completely a management judgment, management estimate it is. Similarly, what else we have? Provision for warranties, that is also something which is completely an accounting estimate. So like this, in the process of preparation of the financial statements, not everything will be certain. There will be various aspects in the financial statements regarding which the management is required to make some judgments. I need to check whether that judgments are reasonable or not. What I need to check whether that judgments are reasonable. Whatever assumptions, whatever estimates which the management have made, are they acceptable or not? That also I need to check. And not just that, as a part of that, I need to check selection and consistent application of accounting policies. Two things they have covered. whether they have selected proper accounting policies. Just a selection alone will not be enough. Even I need to check consistency. What do you mean by consistency? Whatever accounting policies which are followed in the previous year, whether same accounting policies are also applied in the current year, unless there is a reasonable justification for doing it. So I need to check two things. Selection of accounting policies I have to check, and consistent application of the accounting policies also I have to check. And finally, understand that financial statements are prepared on a historical financial information. So as we all are aware, financial statements will be prepared on the basis of historical financial information. Basically, what is historical financial information? The information which has already happened in the past. Clear? So these are all the things which you are required to cover as a part of proper disclosure of the financial information. So three aspects regarding what is included in the scope. They have told three things: should cover all aspects, check the reliability of the source data, check the proper disclosure of financial information. So in order to know the reliability of the source data, study the accounting system and internal control system. When it comes to proper disclosure, what and all you are required to check? Number one, you need to check relevant information is properly disclosed. Number two, financial statements properly summarize the data. Number three, check the judgments. Number four, selection and application, consistent application of accounting policies, and realize the fact that financial statements are historical financial information. That's all, 5 points. Then, sir, what is not included in the scope of audit? We have seen what will be included, what we are supposed to do. We should also become familiar what we aren't supposed to do. If we don't become familiar what we aren't supposed to do, the client will make us do everything. Yes or no? So we have to realize what we are not supposed to do. Number one, you are not supposed to do anything which is beyond your competence, which is out of your scope. Like for example, if you are conducting audit of a manufacturing company, what is your objective there? What is your scope there? You are required to verify the financial statements or books of accounts, give the opinion. That's all. That is what your scope. So one day the machinery in that company has broken down in the factory. Immediately the management called the auditor and told, hey, our machinery has ran into trouble. Please come and fix it. Are you supposed to do it? Is it forming part of your scope? Is it forming part of your competence or capabilities? No. So if management is asking you to do something which is beyond your scope and competence, are you supposed to do it? No, you are not supposed to do it. So that is not included. Number two, second thing which is not included in the scope of the audit, you are not an expert in genuinity of the documents. You are not an expert regarding authentication of the documents. We are not forensic auditors. We are just a normal auditor. We obtain only persuasive, convincing evidence. We cannot get conclusive evidence. Two things, guys. Here also people often get confused here. Persuasive, pervasive. Both are two different terms. Okay, pervasive, we will talk about it later. Persuasive means you will get only convincing evidence. You will not get pakka 100% conclusive evidence. You will never get in audit. Say for example, the management has submitted you some invoice. You have verified. Invoice looks all genuine. Even signature is also there. Signature is also looking genuine. But that signature is a forged signature. Will you be able to find it out? Will you be made responsible for finding out that things also? No. Why? Because we are not an expert in authentication of documents. We can't establish genuinity of the documents. We can only obtain convincing, persuasive evidence. We can't obtain conclusive evidence. 100% evidence we can't obtain. Number three, audit is different, investigation is different. Sometimes people will not understand the difference and they will appoint us for audit, but they will make us do investigation. So both are two different things actually. Investigation is a special purpose examination, whereas audit is a general purpose. In audit, everything we verify on a sampling basis. But in investigation, a few things we will verify, but we will do 100% verification, in-depth verification. So audit is different from investigation. If someone is appointing you for the position of auditor and asking you to do the investigation, are you supposed to do it? No. Able to understand? So investigation is a critical examination, whereas audit is a general purpose examination. Understood? So you aren't supposed to do investigation also. So these are three things will not be included in the scope of audit. What are they? Number one, something which falls beyond your scope and competence. Number two, you are not an expert in authentication of the documents. Number three, it is not an official investigation. You aren't supposed to do any critical examination. You have to do audit only. Understood? So these are the things which will be excluded from the scope of audit. Out of this question also, instead of inclusions, exclusions is very important. In the recent times, they are asking questions a lot on exclusions than when compared with the inclusions. Either as a MCQ they are asking, or as a some small descriptive question also they are asking. Next. So now coming to the few more things here. So scope we have covered. Next. Next, we'll cover two simple points. Who appoints an auditor and to whom the audit report will be submitted? Two questions we'll try to cover in one go. Who appoints the auditor? Other question is what? To whom the report is submitted. If we answer one, automatically the other also will get answered. So first we will answer who will appoint the auditor. Tell me who will appoint the auditor. Basically, owners will make an appointment of an auditor. Like as you could have observed in the company audit, who will appoint the auditors? Shareholders. Except in the first auditor, board of directors will appoint, but except all that circumstances, who are required to appoint? Shareholders, because they are the owners of the company. If it is a partnership firm, partners will make an appointment. If it is a sole proprietor will make an appointment of an auditor. Then, but in some cases, in few exceptional circumstances, some constitutional or government authorities also can make an appointment. Who is that? C and H. In the case of government companies audit, even in the case of bank related appointments also. So sometimes constitutional or government authorities like C and AG and all also will make an appointment. So we have addressed one aspect, who will make an appointment of auditor. Majority of the cases, owners. In few cases, constitutional or government authorities like C and AG. To whom the report will be submitted? Whoever makes the appointment, to them you will submit the audit report. Simply, if I have to put it, whoever has made the appointment for you, to the same person you have to submit your audit report. Like for example, in the case of a company, you will submit the audit report to, when I say submit, you will not personally post it or send it to their email addresses. You will address. To whom you will address? Like if we read in the audit reporting chapter, they will say to the shareholders of the company. So in the case of a partnership firm, you will submit the report to partners. In the case of a sole proprietor, you will submit it to sole proprietor. In case if the appointment has been made by C and AG, then you are required to submit one copy of the audit report to the C and AG also. Able to understand? So whoever makes an appointment of auditor, to the same person, even audit report also will be submitted. So we have addressed two questions here. Next, coming to the next important concepts from this particular chapter, nature, objective and scope of audit. Relationship of auditing with other disciplines. See, the beauty of the subject of the audit is it is not a standalone subject. It is not something, if we become familiar with the content of the audit, we are all experts. For example, if you have mastered all the standards on audit, so if you are excellent in the standards on audit, that itself will not be enough for you to become an excellent auditor. Because the beauty of the subject of the audit is it is linked with all other subjects. Whatever subjects we are reading, with all other subjects, it will be linked. If you don't have a comprehensive and holistic understanding of all the subjects, whatever we are involved, we will never be able to become a good auditor. So there is a lot of interlinking between the subject of the audit and all other subjects. Tell me, what and all are other subjects with which auditing is linked? First thing, accounts. Because we are required to verify financial information. That financial information is an outcome of accounting process only. So accounting and auditing, without which, if without accounting, doing audit is completely impossible. So auditing and accounting are both closely interrelated with each other. What else? It is also related with law. In what matters we need knowledge of law? See, in the case of conducting audit of entities, specific laws which are applicable for them, that we need to have an understanding. Like if you are conducting audit of a company, the provisions of the Companies Act. In addition to that, we need to have a basic understanding regarding general laws also, like Indian Contract Act, Sale of Goods Act, because we should be able to judge when a contract is valid, when a contract is invalid. So we need to have a basic understanding of law also. Apart from that, we need to understand even auditing is having a relationship with economics also. Macroeconomics we have, microeconomics we have, internally which things will affect the company, externally which things will affect the company. So that also we need to understand. Apart from that, auditing and behavioral science. What do you mean by this behavioral science? Psychology. So thankfully this subject is not there as a part of curriculum, but still auditing is even linked with behavioral sciences. You need to know how to deal with the people, because a majority of the part of the audit we have to deal with the human beings. So we have to ask them the questions, we should know the techniques to extract the information, we have to sometimes lay a trap and make the other person fall into the trap to extract the information. So all this behavioral science also you need to learn it, but no need to take up any psychology courses and all. As a part of your experience, as a part of your interaction with the different clients, you will develop this habit. And auditing is related with statistics and mathematics. Mathematics I have already told you, No need to learn any advanced concepts. Just you need to learn addition, subtraction, deletion, multiplication. For that also we have a calculator. You need not worry about it. Even today you need not do it. All the things software will take care of. And it is even related with the statistics. The nightmare for us. No, it is a nightmare for me for my CPT, CA for CA Foundation and all. I don't understand the concepts only. They say probability, they say something, something. What we are going to do the hell with all that? I never realized, but after my qualification, I got familiar with that. So that is very important. See, life all runs on probability theories, you know. Life is full of statistics. So our people, the people who are sitting on our head, who are taking the decisions, be it politicians, be it policy makers and all, they take all the decisions on the basis of statistics only. But we chartered accountants don't use that much of statistics. The only area where we use the statistics in audit is sampling. I say it, but that also you will not do it. Why? Because today for sampling also we do software only. We'll get the sampling done even with the help of software. So what statistical formulas are getting used, what probability theories are getting used, we never know what is happening inside the software. But just somehow it is related with statistics also. Mainly for sampling, it will be related. Then apart from that, auditing and data processing, basically technology, information technology. Today the world runs on technology. Even accounting is also getting run on technology. If we don't get well versed with the data processing and information technology, we are not going to go anywhere. So definitely auditing is linked even with data processing, that is information technology also. Auditing and financial management. So even whatever things we learn, if I have to give one example, in the financial management we learn a chapter called ratio analysis. Whatever we learn in the ratio analysis, that is analytical procedures. So whatever ratio analysis we learn in the financial management, that only in audit we call it as analytical procedures. So even his audit is strongly linked with financial management. And here they say auditing and production. It's not actually production, it is costing. Something they are referring to costing here. Auditing is related with costing also. So even costing related provisions also, costing related that costed calculation, overhead allocation, these things also you are required to judge as a part of your financial statements. So even auditing is linked with production as well. Clear? So this is how audit is related with various other disciplines. Next. So let us proceed further now. So since now we have understood many concepts in this nature, objective and scope of audit, before we proceed further with the next chapter, we have few more important things which are required to be covered. One of the most important topics which we have to cover now is inherent limitations of audit. So we are required to cover a concept called inherent limitations of audit. So now they say, see, whatever content we are learning as a part of this subject audit at the CA interlevel, all that content has been taken from something called standards on audit. We have something called standards on audit. So that is going to be the source from where our entire syllabus has been taken from. So whatever we are going to learn, so all that content has been taken from standards. In majority of the chapters, whenever we pick a chapter and we are trying to discuss something, in that chapter we are basically trying to cover a few standards on audit. Similarly, when we take up this nature, objective and scope of audit, we are simply trying to discuss SA 200. SA 200 is the first and foremost standard on audit. So that is what majorly we are discussing in this chapter, nature, objective and scope of audit. See, they say one thing. When you read SA 200, when you read what is the objective of the SA 200, they say that the auditor is required to obtain reasonable assurance. So if I take you to specifically that paragraph, what is the objective of SA 200, you will be able to find one thing there. Yeah, this one. If you see, what is the objective of audit as per SA 200? So objectives of the auditor as per SA 200 are as follows. Like AS1 is the first and foremost standard on accounting. Similarly, SA 200 is also the first and foremost standard on audit. AS1 set the entire base for the accounting. Yes or no? For the entire accounting, for all the subsequent standards, AS1 sets the base. Similarly, for all the standards or for all the auditing related concepts, for all the auditing related content, SA 200 sets the base. And every standard will have an objective. Like every standard, like every accounting standard will have an objective. Every standard on auditing also will have an objective. Now, what is the objective of SA 200? The first and foremost standard on audit, which is setting the base for the entire auditing subject. So what is the objective of that standard? So SA 200's objective says that
while conducting the audit in accordance with SA 200, and the title of the SA 200 is this: overall objectives of independent auditor and the conduct of an audit in accordance with standards on audit. So this lengthy statement, whatever you are reading here, that is nothing but the title of the standard. So yeah, this is one more problem. In accounting standards, the titles are very simple, very smaller. We can easily remember. Now, if I have to remember the standard on auditing title, that itself will look like some big sentence. So that is where the trouble lies. But many people will ask me, sir, are we supposed to quote the names of the standards also in the examination? I have one universal answer for you all. Quote it better. Don't quote it fine. Wrong quoting it is worst. So if you could quote, if you are very confident that the standard number is correct, the standard name is correct, quote the standard. It's very good. It will elevate your presentation. Definitely, you are going to grab the attention of the valuer. If you don't know it, ignore it. If you don't know it, don't mention anything. So yeah, that might have a reduction in the marks, very little. I will not say many. Entire question will be struck off if you write the wrong standard number. If you don't write the standard number, I will not say that. Yes, little bit lesser in presentation when compared with quoting the correct standard number. But if you quote the wrong standard number or if you mention the wrong title, that is completely a bad impression. So if you know it perfectly, write it. If you don't write it, if you don't know it, ignore it, but never ever quote a wrong standard number, wrong standard name. So SA 200, the title of the standard is overall objectives of the independent auditor and conduct of an audit in accordance with standards on audit. So the title itself makes it clear what does this standard talk about. So from the title, it is clearly saying that if you are conducting an audit, what is your overall objective? What and all you are supposed to do in the entire audit. And also, this standard SA 200 specifically says that whenever you are conducting the audit, you have to do the audit as per standards on audit. After this SA 200, we have many standards. Whenever you are conducting audit, you have to conduct the audit after complying with all the standards. So this is what SA 200 says. Now, what are the objectives? So if you start looking at the objective, they say that the auditor is required to obtain reasonable assurance whether financial statements as a whole are free from material misstatements, whether due to fraud or error, thereby enabling the auditor to express an opinion whether financial statements are prepared in all material respects in accordance with applicable financial reporting framework, more or less similar to whatever we have discussed in the introduction. The same two objectives, whether financial statements are free from material misstatements and whether they are prepared as per applicable financial reporting framework. More or less the same thing here also they are trying to say, yes or no. But they have added one new term here. What is the new term they have added? Reasonable assurance. So we need to understand what is the meaning of the term reasonable assurance. If you open the standards and look at the definition of the reasonable assurance, they say reasonable assurance is a high level of assurance, but not a absolute assurance. So indirectly they try to say that reasonable assurance is something which is not an absolute assurance. Then what is absolute assurance? Something which is not a reasonable assurance. This loop will be never ending, no? We have to define at least one thing. Okay, so if they have told reasonable assurance is a high level of assurance but not absolute assurance, now it becomes necessary for us to know what is the meaning of absolute assurance. First of all, what do you mean by assurance? Not guarantee. We can't say it as guarantee. It is something like providing the confidence to you. Like for example, if I say, if you attend this marathon, I will assure you that you can score 50 marks in the auditing paper. Am I giving guarantee to you? I'm giving you confidence. If you follow the content carefully, if you put all your efforts, there is a high chance that you can qualify. So this is assurance. Assurance is not equivalent to guarantee. Assurance is something like giving confidence. Absolute means what? 100%. Pakka. So absolute 100% assurance means confidence. 100% confidence, which is equivalent to guarantee. Assurance alone will not become guarantee, but absolute assurance will become what? Guarantee. So, but they say that auditor should obtain reasonable assurance only. You are not required to obtain 100% assurance. That means you are not required to obtain a guarantee. You are not required to give a guarantee that financial statements are free from material misstatements. You are not required to give a guarantee that financial statements are prepared as per applicable financial reporting framework. Then what you are required to obtain, sir? Reasonable assurance. If you have high level of confidence, enough. if you have a reasonable level, if you have an acceptable level of confidence, yes, I am confident enough that financial statements are free from material misstatements, that financial statements do not contain any material misstatement. If I have a acceptable level of confidence, acceptable level of assurance, that is enough. The standards are not expecting from me. The first and foremost standard on audit, SA 200 itself is not expecting from me absolute assurance. Sir, why it is not expecting any guarantee from me? Why it is not expecting any guarantee from me? Why the standards are not asking me to give a guarantee to the user? Why they are expecting me only to give a reasonable level of assurance? Why? Because the logic is simple. You can't give it. You can't. Even if the standard says also, you can't. So the standards have recognized it and told that because the process of auditing is suffering from some limitations. Limitations means not disadvantages, you can say it as drawbacks. Sometimes we put everything in our effort, but still somewhere something will go wrong, not because of our weakness, not because of our mistakes. Situations are like that, limitations are like that, the process itself suffers from that. So like that, even audit is also going to suffer from some limitations, some drawbacks, which are of such a nature that they are unavoidable in nature. What in nature? Unavoidable. That means no matter whatever you do in your control, but still you will not be able to eliminate them. Those limitations we call them as what? Inherent limitations. So since the process of auditing is suffering from some inherent limitations, so that's why the standards on auditing have told, boss, because limitations are there, we acknowledge it. That's why we are expecting you to give only high level of assurance, a reasonable assurance, but not an absolute assurance. Because of these inherent limitations, auditor can only express opinion, but he cannot give guarantee. Till now, I nowhere told in my discussion auditor will give a guarantee. Everywhere I was saying opinion, opinion, opinion. I never use the phrase guarantee because he can't give it. So what is the logic why he can't give guarantee? Once again, inherent limitations. So because of inherent limitations, many implications are there. One implication is auditor can give only reasonable assurance but not absolute assurance. Auditor can only express opinion but not guarantee. And also they say one more phrase there, the audit risk can never be eliminated. By doing audit, there will be risk. Do you acknowledge it? What is that risk you will face? Whatever opinion that you have given, that might go wrong. No matter how sincerely, how effectively, how much standards you use, excellent work, excellent staff, excellent time, but still your opinion can go wrong. That possibility of your opinion going wrong, that risk is there. Whoever have depended on your opinion, their decisions might go wrong. So that is a risk we are facing. That risk we call it as what? Audit risk. They say that audit risk can never be eliminated. You can only reduce it to acceptably low level. I'm not saying it. Standards are only saying it. You can't eliminate it. You can only reduce it to an acceptably low level. And so that is one reason for that is also inherent limitations. Audit risk can only be reduced but can't be eliminated. And whatever opinion you have given, that opinion is having a possibility of going wrong. All these four are consequences of inherent limitations. All these four are consequences of what? Inherent limitations. So tell me, what are the consequences of inherent limitation? Number one, you can obtain only reasonable assurance but not absolute assurance. Number two, you can only express opinion but not guarantee. You can only reduce the audit risk, you can't completely eliminate it. Number four, there is always a possibility of your opinion going wrong. One single reason for all this is what? Inherent limitations. And what is the nature of that limitations? Avoidable or unavoidable? All these limitations are unavoidable in nature. Sir, what exactly are that inherent limitations? What are those limitations which we can't avoid no matter how much effort we are putting? So all that inherent limitations are given here in SA 200. So let us try to understand that inherent limitations in a detailed manner. So what are that inherent limitations? Number one, nature of financial reporting. See, sometimes they say, no, it's not you, it's me. Heard about it? Heard about it? No. Hey, what here? You are all Gen Z kids. You should know this, no? Uh-huh. Right. So it's not me, it's you. So no. It's not you, it's me. Yeah. So we see it, right? So that is what similar to this. Nature of financial reporting. They're telling it's not audit, it's in financial reporting only. There is a limitation because of which my opinion can go wrong. That is not with audit. The problem is not with audit. The problem is with financial reporting only. Sir, what is that problem with the financial reporting? One point I have told you in the scope of the audit. So what did I say? So management will make various judgments. That means management is going to make use of assumptions and estimates. When I say assumptions and estimate, they always have a possibility of going wrong. Management has made an assumption. When we use assumption here, when we don't know something with certainty. And whenever we are using an assumption, there is always a possibility that assumption cannot turn out to be a reality. Obviously, right? But the management, if they have to prepare the financial statements, they have to compulsorily make use of assumptions. And whatever assumptions at that point of time, they might sound reasonable. It sounded good for me. Say, for example, one data is there, he was about to go bankrupt. The company expected that nothing is recoverable from his account, 100% provision they have created. Even it felt sound for me. Why? Because everybody in the market is also expecting the same thing. There's a very bad reputation for this person. Everybody felt that he will become bankrupt. Zero, nothing will be recoverable. I did an inquiry. I am also satisfied. So provision for bad and doubtful debts, 1 crore is receivable. Entire 1 crore provision they have created. I am also satisfied. I gave a opinion, positive opinion I have given. Later, some situation has taken place. This debtor all of a sudden has become very rich. His financial position has become very good. He repaid me entire money. But last year I created 100% provision. No. Management created 100% provision. Even I certified that, yes, that provision is correct. But that provision, that estimate has gone wrong. Now, that means last year's financial statements contain some wrong. My opinion is also wrong on that. But is it because of my mistake? That is inherent. That is there in the process of financial statements. If I have to avoid this limitation, the management should have prepared the financial statements without using a single assumption. Do you think it is possible? No. So management, if they have to prepare the financial statements, they will use assumptions. If they are using assumptions, there is a possibility of that assumption going wrong. If the assumption is going wrong, financial statements go wrong. If the financial statements go wrong, my opinion also can go wrong. Clear? And one more example they say, one more thing they say in the nature of financial reporting. See, when we are preparing the financial statements, when we are verifying the financial statements, we generally assume that management has implemented internal controls to make sure that many of the errors and frauds are getting prevented. Generally, we go with that assumption. But those internal controls also might have some inherent limitations which can make that internal controls fail. We assumed that management implemented internal controls. These controls are working effectively. So that's why we did the audit on that basis and we felt financial statements are all correct, gave a positive opinion. But what is hidden there is even that internal controls also can have some inherent limitations. Because of that, even internal controls also can fail, which might not have come to our notice, because of which financial statements can go wrong, because of which my opinion can go wrong. That's why they told no guarantee, only opinion, no absolute assurance, only reasonable assurance. Sir, but what are that inherent limitations which can make the internal controls fail? That we will see it in the risk assessment and internal control chapter. Understood? Right. So here I have told two things in the nature of financial reporting. Number one, management make use of judgments, assumptions which involve uncertainty. Number two, audit is done on the basis of assumption that internal controls will be there. But these internal controls also could fail because of inherent limitations, because of which our opinion can go wrong. Understood? First category of inherent limitation. Now, coming to the second category of inherent limitation. Now, it's you only. It's you only. So first they told there is a problem with financial reporting. Now they are telling what? The problem is with audit only. So what is that problem with the audit? Nature of audit procedures. Now before that, we need to have we need to understand one cycle of the entire audit, how the entire audit actually happens. See, what is the ultimate objective of the audit? The auditor has to express an opinion. So when you express the opinion, the process of audit will come to an end. Now, the process of audit will actually start with auditor's appointment. Auditor will get appointed, but audit will come to an end by expression of opinion. It is not some magic. He will be appointed, he will give the opinion, audit will come to an end. It will not happen like that. In between, many things are involved. So in order to express opinion, see, if you are giving any opinion, that opinion should have some supporting information or not. If I say that person is a worst fellow, can I toss a coin and say? So I need to have some evidence, I need to have some info which supports my opinion. Even when I am saying opinion on the financial statements, if I say financial statements are true and fair, financial statements are not giving true and fair, for that also I need some information. If tomorrow someone comes and asks me, boss, you have given so and so opinion on the financial information, what is the basis for your opinion? I should have some information. That information which supports your opinion, that in the audit terminology we call it as audit evidence, we call it. Unless and until we have audit evidence, we will not be able to express our opinion. In some cases, we will not have any audit evidence, then also we'll express an opinion, which we generally call it as disclaimer of opinion. We'll see it in the audit reporting chapter. But one of the prerequisite for expressing an opinion is you should have audit evidence. But just because you are an auditor, the moment you enter inside the premises, the evidence will not come and fall in your lap. You have to put some efforts from your side. You have to definitely perform some procedures. You have to put some efforts to get that evidence. And that procedures, that efforts which auditor is putting to obtain that audit evidence, we call them as what? Audit procedures. So this is how the cycle of entire audit is going to go. First, auditor will get appointed. He will perform audit procedures. Then he will perform. Then by performing that procedures, he will get audit evidence. On the basis of that evidence, he will express the opinion. By expressing the opinion, over, audit comes to an end. So this is what the entire cycle, entire process of audit. Now they say that whatever audit procedures you will perform, no, there is a problem with that procedures. The audit procedures itself will contain some limitations because of which your opinion can go wrong. Sir, what are they? Number one. So the auditor carries on his work by obtaining evidence through performance of audit procedures. Just now I have told you will perform audit procedures. By performing that, you will get audit evidence. Now, sometimes there will be practical and legal limitation. Sometimes whatever evidence you want, you might not be able to get it, either because of practical limitation or because of legal limitation. Like you want to obtain evidence regarding some information, but management is saying that records are burnt. Recently fire accident happened, all the records got burnt. They are not able to generate the records. So it is a practical limitation. They can't help it. So they are unable to give the evidence. Sometimes there will be legal limitation. Like you want to verify the GST records, but GST department came and seized all the records. You are not able to get access to that records. That is a legal limitation. So sometimes because of practical limitation, because of legal limitation, you might not be able to obtain the evidence whatever you require. Then sometimes management intentionally they will not provide the information, either intentionally or unintentionally, sorry. So sometimes management will not give you whatever information you are requesting for, either intentionally or unintentionally. If the management itself is not giving the information, you will not be able to get it. Then also your opinion can go wrong. And also sometimes the management might consist of dishonest and unscrupulous people. That means this cunning people, fraud intended people will be there. They will commit the fraud in such a way that they will hide it also in an effective manner. See, generally the person whoever commits the fraud is an intelligent person, is a talented person. We have to accept that fact. No motivation for becoming a fraudster or scammer here. I'm giving a disclaimer. So, but generally the person whoever commits a fraud, he is an intelligent person, talented person. And any person whoever is committing a fraud, he will not commit fraud in such a way that he will get caught. He will take all the precautions. And if the person is more intelligent, more smart, he will hide the fraud in a very effective way. He will create fake documents. He will destroy the existing documents to make sure that this fraud will not get to anybody's attention. So if the fraud has been committed by intelligent person, very fraudulent persons who have very much experience in committing these kind of acts, those frauds, no matter how effectively you do the audit, you might not be able to identify them, because of which also your opinion can go wrong. And one more thing they say, one point we have already covered in the scope, you are not an expert in authentication, genuinity of the documents. Management gave you supporting document, but in that supporting document signature is forged. You are not an expert to determine whether that signature is really a genuine signature or forged signature. So signature looked fine and you have thought that this is a genuine case and you have given a positive opinion, but later it was found that that document is a forged document, but auditor can't do anything about it, no, right? And one more thing, sometimes entities may have entered into transactions with related parties. Whenever there is a related party, it should raise your suspicion. Why? Because it is very much easy to commit a fraud or manipulation through related parties. So you have to be very careful. Sometimes your client might have done a transaction with the related party. On paper, by looking at the transaction, it will look genuine, but behind it, many malicious intentions could have been hidden. So which you might not be able to find it out, because of which your opinion can go wrong. So these are the problems which audit procedures are suffering from. This is very important. This part is very important. In many cases, they have asked a question in the examination. They will never ask you to write all inherent limitations. They will ask you to write only one part. And in majority of the cases, this is what they have asked. Nature of audit procedures. Like they will pick one point. They will say that sometimes there will be legal and practical limitations on the auditor's ability to obtain audit evidence. Explain the inherent limitation associated with this. That means they are referring to the inherent limitation of nature of audit procedures. So when it comes to nature of audit procedures, 6 points we have covered. Number one, So you have to perform audit procedures to obtain audit evidence. It is not anything specific, some general statement they have told. Then second point, they told sometimes there will be practical and legal limitations because of which you will not be able to obtain audit evidence. Number three, management might not provide the requested information to the auditor, either intentionally or unintentionally. Number four, sometimes management could be fraudulent or very intelligent and smart. They can conceal the fraud in an effective way, which auditor might not be able to find out. Next point, auditor is not an expert in authentication of documents. So you can't establish the genuinity of the documents. And entities may have entered into the related party transactions. In those cases, you might not be able to understand, you might not be able to identify the actual frauds behind that transactions. Understood? Right. And in addition to that, this point also we have covered, audit is not like an investigation. See, if audit is also like investigation, like sometimes official investigations will happen. Income tax raid. Did you see it? Not lively, but at least in the movies and all, you might have seen it, no? So there they do all the things and all. They have extreme powers. They will come to your premises, they will stop the movement, they will cut the telecommunication, they will lock you, they will break your house. You have to just sit there staring, nothing you can do. So do we as auditors also enjoy the same power? Do we also, if a client has appointed us as an auditor, can we go to his premises, cut the connection, sit there, so stop the movement, break the walls, break the ceilings and all? Can you do that? If you do that, what will happen? He will hold you by the collar and catch you from, throw you from there. Yes or no? So we are not an official investigator. If the government says even auditor is also like an official investigator, he can do whatever he want, then you could have expected from us absolute assurance. But we are not an official investigator. No, we don't have that supreme powers, whatever they enjoy. So that's why you can't expect from us absolute assurance. You can only expect from us reasonable assurance. And also timeliness of financial reporting and decrease in relevance of information over time. So what I will say is this, I have to simplify in simple manner. Sometimes what will happen is, for doing audit, lot of time is involved, but you can't spend that much amount of time. Why? Because say for example, if you got one audit, if you want to do the audit in a 100% manner, giving it's enough of time for that audit, you might do only one audit for the entire year. So we can't do that. So sometimes what will happen is, to save the time, to save the cost, we use some previous year's evidences. We use what? Previous year's evidences. Like for example, I'm conducting audit for the financial year 24-25. From the last 2 years also, I have only done the audit. In the current year, I don't have enough of time. I don't have enough of energy to do entire verification now. So what I will do is, whatever last 2 years evidence is there, that I will use it in the current year. Is it permitted? Yes, it is permitted. As per the standards also, it is permitted. So in the current year, I am using the evidences which I have obtained in the last 2 years. But if you pay close attention, from the moment you have obtained the evidence till the time you are using it, lot of time has passed. And we all are aware, as and when the time passes, the relevance, the relatability of that information will decrease. So if I keep on using that past evidences, and standards are also permitting. So if I use the past evidence, there's a time gap between obtaining the information and using it, because of which its relevance will decrease. If I rely on that information and give my audit, there is always a chance of my opinion going wrong. And then finally, future events. In some cases, in the financial statements, a future events also will be involved, mainly going concern. So management will say going concern is valid. That means the entity will continue for the coming 1 year. There is no requirement or there is no intention to liquidate the business. Even I felt it correct. Okay, entity will continue for the going concern. Going concern assumption sounded valid. I gave an unmodified opinion. But sometimes what will happen is, in the next 6 months only, some calamity has hit. Like for example, COVID. So a situation like that has hit. Because of the COVID, whatever businesses which were sounded very good, very strong financially, they are swept out of the market. Just like that. So like that, something uncertain can happen which we did not expect, which can change the going concern. As on the balance sheet date, it felt going concern is valid, but now the going concern is no longer valid. My opinion has gone wrong. No. But is it my mistake? No. That is an inherent limitation. Understood? So these are all the 5 inherent limitations, because of which 4 consequences. What are the 4 consequences? Only reasonable assurance, not absolute assurance. Number 2, you can give only opinion but not guarantee. Number 3, you cannot eliminate the audit risk. Number 4, there is always a chance of auditor's opinion going wrong. And they have given inherent limitations under 5 categories. Number 1, nature of financial reporting. Here they say 2 things. It involves judgments, it involves internal controls, and they might go wrong. Number 2, nature of audit procedures. basically here they say 5 things. First point is not any specific point, it is a general statement. They say specifically 5 things here: practical and legal limitations, management might not provide requested information. Number 3, management might contain unscrupulous people, they can effectively conceal the fraud. Auditor is not an expert in authentication of the documents. And last one, related party transactions. Next one, audit is not an investigation, it is not an official investigation. Number 4, timeliness of financial reporting and relevance of information over a period of time. Last one, future events. Clear? Right, these are the inherent limitations. Then I think engagement we have already covered. No, so engagement we have already covered. What is an external audit engagement? Basically, this is statutory audits and all, you can call them as external engagements, where a person external to the organization will come and verify the books of accounts and financial statements. That kind of engagements we call them as external audit engagements. Mainly statutory audits will come under external audit engagements. Then what else we are left with? First question will be there, what is the origin of the auditing and all. I think that you can manage it, not relevant for the examination perspective. And so the next thing which is important from this chapter is, what is the meaning of assurance engagement? So as I have told, engagement is a very broader term. Engagement is a very broader term. And as a chartered accountant, we perform various engagements. We perform various engagements. Out of that, generally we call them as assurance engagement. In that assurance engagement, one of the engagement is audit engagement. The term assurance engagement is very wider. Many engagements will come under assurance engagement. Like if you see the definition of the assurance engagement, they say that assurance engagement refers to that engagement in which there will be a practitioner. Very simply, I will try to explain this. You need not worry about it. With the examples, I will try to explain. So there should be 3 parties. In order to call it assurance engagement, there should be 3 parties. Who are the 3 parties? There should be someone called practitioner. There will be something called responsible party, intended users. So intended users will be there, responsible party. 3 parties should be there. And in this assurance engagement, there will be one subject matter. There should be something what? Subject matter. There should be one important matter around which this engagement is going around. So there should be one professional whom we call him as practitioner. There will be some intended users of this subject matter, and there will be responsible party. So what practitioner will do is, basically responsible party will prepare some subject matter. Responsible party will prepare some subject matter. So if I try to link it with the audit, responsible party will be management. Management will prepare what? Financial statements. For the purpose of intended users. Who are the intended users? Let us take shareholder. Shareholder is an intended user. Now there will be one practitioner, auditor. So what auditor should do is, whatever subject matter which has been prepared by responsible party, if I link it with audit, whatever financial statements which are prepared by management, that will be verified by practitioner, auditor, against some applied criteria, against some criteria, applicable financial reporting framework. So basically, as a practitioner, as an auditor, you will verify whatever financial statements which are prepared by the management against the applicable financial reporting framework. That is whether as per Schedule 3 and accounting standards or not. And you will give a assurance. You will give a what? Assurance. You will give a confidence. You will give a conclusion to the user, to the intended user. In audit, what practitioner generally do? So he will verify the financial statements prepared by the management as per applicable financial reporting framework, and he will express a conclusion. He will express an opinion whether these financial statements are giving a true and fair view, so that intended users can use them for the purpose of decision making purposes. And whenever he is expressing that opinion, will he just give that opinion on a fluke, or he will do some verification? Will he have evidence, or will he don't have evidence? He will have evidence. So if all these things are there, then we call that engagement as an assurance engagement. So what should be there in order to call an engagement as an assurance engagement? A 3-party relationship. Who are they? Practitioner, responsible party, and intended users. There should be an appropriate subject matter, the main thing around which this engagement is going, like in audit, financial statements. And suitable criteria, nothing but that subject matter will be prepared as per certain rules, certain criteria, applicable financial reporting framework in audit. And there should be evidence. whatever opinion you are expressing, whatever conclusion you are giving, it should be based on some evidence. And a written assurance report. Finally, after all your verification, you will give some assurance. In audit, we give a opinion in the form of a written report. So is the audit checking all that boxes? Whatever audit engagement is there, is it checking all the boxes? So what in all boxes it is checking? Three party relationship is there, subject matter is there, that we are evaluating against suitable criteria, and we are obtaining evidence, and we are giving a written report through which we are expressing a opinion. That is assurance. So assurance engagement is very broader, in which one of the engagement is what? Audit. Now let me give you another example. So one bank is there. Okay. So there is one company, X Limited. So this X Limited company approached the bank for the purpose of loan. For the purpose of loan. Now bank, what they will do is, before they give a loan, they ask the borrower to prepare something called projected financial statements. Estimates, we say. They will ask you to estimate coming 5 years how the financial position will look like, how the balance sheet will look like, how the profits will look like. The management is required, the management of this client is required to prepare that projections, we call it in the industry, estimates, and they have to submit it to the bank, and then only bank, if satisfied, they will give the loan. And what this bank has done is, they told, boss, we will give you criteria how to prepare that projections, how to estimate, on what basis you have to calculate. We will give you criteria. According to that criteria, you prepare projections, and you take that projections to some chartered accountant. Ask him to verify, give his assurance whether these whatever projections are there, they are prepared as per the criteria whatever we have given or not. You get one report from the chartered accountant, then we will give a loan. So now you call me, this engagement, can we call that as assurance engagement? Can we call it as assurance engagement? See, in order to call assurance engagement, 5 boxes should be checked. Number 1, three party relationship. Is there a three party relationship? Who are the three parties? Practitioner, management, who is a responsible party who prepared that projections, intended user is a bank. Number 2, subject matter. What is the subject matter here? Projections. That estimates are projections, which is a subject matter. Is there a suitable criteria? What is the suitable criteria? The instructions, whatever bank has given. I told bank will give you instructions how to prepare the estimates. Next, fourth one, evidence. When they take the subject matter to the chartered accountant, will he ask some evidences or not? Yes. After he has verified that projections and the supporting evidences, he will give the assurance in the form of a written report. So all the 5 boxes checked. Can we call this as assurance engagement? But can we call this as audit engagement? No, we can't call it as audit. Clear, everybody? So assurance engagement is a very broader engagement. In that, multiple things will come, like something called audit engagement will come, review engagement will come, assurance engagement will come, and various, apart from that, various other engagements will come. So assurance is a very broader term. Whichever engagement which has this 5 aspects, 5 boxes which are getting checked, so all that engagements we call them as assurance engagement. So assurance is a very wider term. In that, one of the component is what? Audit engagement. Understood? And as I have told, as a chartered accountant, you will not just do audit engagement, you will do various other assurance engagement. Like we do something called review engagement, we do something called assurance engagement, we do something called related services. So like that, various engagements we do, all that fall under broadly assurance. In that, one of the category is what? Audit engagement. Understood? Clear and comfortable, everybody? Right. So, and one more last thing here we have, what are the qualities of an auditor? Very simple. You need to have 2 kinds of qualities. Technical qualities you should have, personal qualities you should have. What are technical qualities? Basically, we have read one question, how the audit is linked with various other disciplines. If you want to become a good auditor, you should have knowledge of all that subjects. Like accounting, you should have good knowledge, law, taxation, all that knowledge you should have. Apart from that, you should also have some good personal qualities. If you are a good person, if you are having sound knowledge in the accounting and all the things, you are well versed, but you don't have personal qualities, like you are not a careful person, you lack caution, you lack tactness, carefulness, you don't have clarity of the thought, you have a short temper, you shout at the clients and all, will you become a good auditor? No. So if you want to become a good auditor, you should take both hand in hand. You should have technical qualities, you should have a good sound technical knowledge. Along with that, you should also have good personal qualities. Whatever qualities that make a person good person, all that qualities should be there even for good auditor also. Like personal qualities, if I have to say, tact, caution, firmness, good temper, integrity, discretion, industry, judgment, patience, clear headedness, reliability. So basically, whatever qualities makes a person good person, all that qualities must be possessed even by an auditor to become a good auditor. Clear? That's all. So this is what regarding the chapter nature, objective, and scope of audit. Comfortable, everybody? Shall we proceed further now? Right. Good. Right. So the next chapter, which we will take up for revision, is what? Ethics and terms of engagement. So as I have told, even though the title of our subject is auditing and ethics, this is the only chapter which will talk about ethics. So what basically is the meaning of ethics? Moral principles. See, we are all living in a society. Yes or no? So you can't say I will do whatever I want. I will behave in this manner only. I will sleep on road. I will eat on road. You can't say that. So that is at the personal level. So you are required to follow some protocol. Being a part of the society, you are required to follow some protocol from a personal point of view. Even from a professional perspective also, you are required to follow some moral principles. See, every professional will be subjected to ethics. Like if I have to say doctors. See, doctors play a very crucial role. Patients place a lot of trust on the doctors. They disclose all their medical information to the doctors. Can you expect that doctor to go and publish that information on their social media platforms? Not expected, no. It is a moral responsibility on you to maintain the confidentiality regarding the personal information of your patients. That is minimum which is expected from you. Same thing is with lawyer. See, these are all the professions on which people place trust. And when the people are placing the trust on you, you are expected to follow some moral principles. Or else you will break the trust of the people. Even if one person breaks the trust of trust of his prospect, that will have an impact on the entire profession. Yes or no? Do you all agree with me? So that's why these people, these professionals will have moral principles. Their respective organizations will give moral principles. Like if you take doctors, Indian Medical Association, they will give some moral principles. That moral principles, they will document it. They will give it in one structured format. That document only we call it as ethics. So IMA, Indian Medical Association, will release a document. In that they will say some list of moral principles which they are required to follow. That document itself will be called as ethics for doctors. Similarly, lawyers also will have their bar council. That bar council will give the list of moral principles which they are required to comply with, and that moral principles we call it as ethics for lawyers. Like people place a trust on these professions, we chartered accountants, we auditors also play a very crucial role in the society, and people place a lot of trust on us. They come and disclose their financial information to us. Yes or no? So how much money they are earning, how much black money they are holding, what properties they are holding, who are their binamis. Yes or no? So all this information will be even disclosed to the chartered accountants. So it is expected from you. If people have to trust you, if people should continue to trust you, so whatever privilege you have got, whatever accessibility you have got to your clients, that should be protected. And that only can be protected if some moral principles are made mandatory on you. See, once again, whatever that moral principles I have told, that moral principle should not be given it as an option. If you want, you follow, you can't say that. You should make that moral principles mandatory on these professionals. If somebody violates that moral principles, the regulating authority should punish them. So you tell me, we chartered accountants also need that moral principles and stringent action on violation of that moral principles or not? Yes. So who is our regulating body? ICA. So what ICA has also done is they have given a documented list of moral principles which you are all expected to follow, and in case if you violate that moral principles, you will be subjected to action. That document only we call it as code of ethics. That document only we call it as what? Code of ethics. So that is what the ethics which you are required to follow. That is what the role the code of ethics plays in our profession. If our profession is enjoying the respect, that is only because of that code of ethics. But what exactly is that code of ethics? It is actually hundreds of pages of the document. It's not so simple to summarize in one chapter. So we have a dedicated chapter called professional ethics as a part of our CA final. So there we will spend somewhere around 14-15 hours to discuss only that ethical aspects and all, what you are supposed to do. If you are a member in practice, what you are supposed to do, what you aren't supposed to do. If you are a member in service, that means you are working as an employee of some company, what you are supposed to do, what you aren't supposed to do. So like that, we have a bulk document talking about the code of ethics. All that we will discuss at the CA final level. Here we are just going to have an intro. Just we will have an intro about ethics which you are required to follow. Understood? And that code of ethics says that every practicing professional, every chartered, not practicing professional, every chartered accountant, they should follow 5 fundamental principles of ethics. They should have 5 fundamental principles relating to ethics. What are that 5 fundamental principles? So they say integrity, number 2, objectivity, number 3, professional competence and due care, then confidentiality, then professional behavior. So these are the 5 ethical requirements. Also, you can say fundamental principles relating to ethics, you can say whatever you want to call it, you can call it. So these are the 5 fundamental principles. What are they? Repeat once again: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. So let us try to understand what does that each of the ethical requirement mean. Number 1, integrity. What do you mean by integrity? You should be a straightforward, sincere, honest person. If you know before accepting the audit only, if you know before doing any engagement, if you know that you are going to deal with the wrong information, you should stay away from that engagement. If you came to know, you should not knowingly associate yourself with wrong information. Sometimes what will happen is, at the time of knowing, at the time of accepting that association, you don't know that you are going to deal with wrong information. But after you have been associated, then you got to know that you are going to deal with wrong information. Then what you should do? Basically, you have to give a negative opinion. If I have to simplify it, in case if you know it well in advance that you are going to deal with the wrong information, don't get associated yourself with the client. In case after you have associated, then you got to know about that you are going to deal with the wrong information. If you give a negative opinion, no, then you have still followed your ethics. But after association, you got to know that is a wrong information, but still if you are giving a positive opinion, that means you are not a person of integrity. You are not a sincere person, you are not an honest person, you are a disrespectful person. Understood? So that is what the meaning of integrity. So you should be sincere, honest, straightforward, and you should not knowingly associate yourself with information that you believe it to be false. If at all after getting associated you got to know about it, you have to state it, you have to give a negative comment on that. Clear? Next, second ethical requirement. What is that? Objectivity. So what is the meaning of objectivity? Unbiasedness, without any prejudice. You should not have any kind of bias, you should not have any kind of prejudice, you should not show favorism. You should not say for some clients I will do favors, for some clients I will torture them. You should not say that. So you should deal the clients without any kind of bias. Next, third one. What is the third ethical requirement? Professional competence and due care. See, a client is coming to you, trusting you, giving you some responsibility, asking your advice, asking your professional services. It is your responsibility to well equip yourself with all the skills whatever you require. It is your responsibility. See, just because if you qualify CA final, your responsibility is not coming to an end. Till the time you are in this profession, it is your responsibility to update your skills and knowledge either by way of education, training, or as a part of your experience. Why? Because every year Finance Act will come. No. Yes or no? Finance Minister will come and give the amendments. If you say stick to the older provisions only, you are no longer going to be relevant in industry. So one drastic change which we have experienced is GST. At the time when I was qualified, all the indirect taxes were, I read all the indirect taxes, service tax, VAT, and also excise duty. All this we have learned. But the moment I qualified, I got the CA certificate, they told no, all these indirect taxes will not become applicable. Only one GST will become applicable. So if I still stick with the same old knowledge, will I be able to do the practice? I never learned GST in my class, but today I teach GST. I never learned in the class, I never learned GST, but today I teach GST. How come I am able to do that? Because continuous upskilling and upgradation of the knowledge. So that is one thing. And along with that, whatever your client needs. See, one more drastic change, should I tell you what you might experience? Like me, after your qualification, something will be scrapped altogether. The danger is for Income Tax Act. So we don't know when it is going to come. So if it comes, there might be a case. So I do expect if it happens very quickly, within 1 year it will come. If it does not happen within 1 year, it will take easily 3-4 years of time. So if it is happening, if that DTC is happening, direct tax code is happening within 3 years, no, then you qualify with Income Tax Act 1956 with all the amendments. But once you get the certificate, you will have a DTC which is getting followed in the real life. So that is one thing which you might experience. So it is a part of continuous learning. So it is your responsibility. Professional competence and due care means it is your responsibility to update your skills and knowledge by way of continuing education and provide capable services. Provide capable and competent services to your client. If you are not educating your client on the recent developments, on the recent changes, you are not giving some recent update to your client, recent report is required as per Companies Act, you are not giving it, which ethical principle you have violated? Professional competence and due care. You did not provide competent services. Like this, the questions will be tested here. They will give a scenario, something has been violated, and they will ask you to write the fundamental principle associated with this scenario. These days, we are seeing these kind of questions. And one more thing, they say due care. What do you mean by due care? You have to do the work with utmost care, with a lot of care. You have to perform the engagement. You should not be a careless or negligent person. That only we call it as due diligence. You have to do all your due diligence before you give any kind of report. So that is a third ethical requirement. What is the fourth one? Confidentiality, basically secrecy. So the client will come, we have a privilege, being an auditor we have a privilege. The client will tell us every information whatever we ask, provided it is business, not personal. Okay, so they will share all the information with us, all the financial and business related information with us. We have that privilege, and that privilege comes with a lot of responsibility. You should not go and disclose it. Sometimes as a part of your audit, you get to know about the business secrets also. You get to know about customer base, what salary they are paying it to the top officials. This is all a very price sensitive information. This information should not go out. Sometimes trading strategies, upcoming acquisitions, all that you will get to know. You should not disclose it to anybody unless there is a requirement from law or regulation. If there is any requirement from law or regulation, then also don't come and say confidentiality, I'm a genuine person, I will not share. So then all these things will not work. If there is a requirement from law or regulation, you have to share. In all other circumstances, you should not share. Next, last one, what is that? Professional behavior. So many chartered accountants have worked very hard to bring all the disrespect we have today. So you should not be a fuel to the fire. So to the extent possible, you should work towards reducing that disrespect, reducing that bad image. So whatever work we are doing, that should be in compliances with laws and regulations, and we should not do any such act which brings a disrepute to entire profession. So if one chartered accountant does a mistake, generally we find the news, they will not mention the name of the chartered accountant in the headlines. They will say a chartered accountant has committed so and so fraud. So that's where the entire profession is getting blamed. So we should not do any such act which is against laws and regulations, and we should not do any such act which brings a disrepute to our entire profession. So that we call it as professional behavior. So these are the 5 ethical requirements. Now apart from all this, we have one more important ethical requirement, which is, even though it is not ethical requirement, but one of the foundational concept, which is independence. So what do you mean by independence? Ability to take decisions without any influence from others, or the ability to take decisions, your decisions not being subordinate to others' wishes and challenges, others' wishes and directions. So that we call it as what? Independence. So you have to maintain a lot of independence, and this independence should be of 2 types. One is independence of mind, and the other one is independence of appearance. What is independence of mind? It is a state of mind. Say for example, if some client has come to me and asked, boss, you have to do the audit for me. I made a agreement in my mind, I am going to do the audit in an independent manner, I will not get influenced. That state of mind, we call it as independence of mind. Independence of mind is something which can't be seen. You can't break someone's head and see whether there is independence of mind or not. So it's kind of a feeling. So independence of mind, it is a state of mind, it is the acceptance in mind to act independently. Whereas what is independence of appearance? You have to appear to be independent. Yes, that is in simple terms. That means you should be free from any kind of relationship. You should be free, not all relationships here. You should be free from relationship or associations which might make a person feel that you are not independent. Able to understand what I'm trying to say? So you should be free from, you should not have any kind of association or relationship with the client which might make the other party, a third party, believe that independence has been compromised. Say for example, one day a client has approached me to conduct audit for them. In that client, the company has approached me, in which my brother is a CEO. So I have agreed in my mind, even though my brother is a CEO in this company, I will still independently do the audit. Independence of mind is there. But here what is not there? Independence of appearance is not there. Why independence of appearance is not there? See, I am having a relationship with the client which I am doing an audit, which will make a third party believe that independence has been compromised. Independence of appearance is required. What is required? What kind of independence we should have when we are doing audit? We should have both, and especially in the case of statutory audits, we should have both independence of mind and also independence of appearance, provided if the audit is a requirement under law. If there is no requirement under law, I'm a sole proprietor. I'm not required to undergo company audit. I'm not required to undergo tax audit. My turnover is also within the limit, but I still want to get my accounts audited. I went to my brother who is a chartered accountant to get my accounts audited. Can I do that? Independence of mind is enough. Independence of appearance is not required. First thing, no one is asking you to get your accounts audited. Out of your own itching, you are going and getting your accounts audit done. Now, with whom you are getting your accounts audited, who is bothered? No one will come and question you. But in the case of those audits which are required under law, independence of mind is also required. Independence of appearance is also required. Comfortable, everybody? Next. So this is two kinds of independence. Now, what are various threats to independence? So there are some threats to independence. There are some circumstances which are considered a threat to independence. When I say a circumstance has been considered a threat to independence, what do I mean by that? Because of that circumstance, will independence will increase or independence is in danger? Independence is in danger. And those threats, they have classified into 5 categories. How many categories? 5 categories. What are that 5 categories? Self-interest threat, self-review threat, advocacy threat, familiarity threat, intimidation threat. See, understanding the meaning is not important here. Examples are very important here. From the examples, they will frame the question, either a descriptive question or a MCQ question. They will give one scenario, they will ask you to identify the threat associated in the given case and explain about that threat and also state examples of that threat. That is how the questions are getting tested these days. So especially from this question, I have seen multiple examples in MTPs, RTPs, even in the past examination papers also you can open and check. They will take one example and from that example, they will frame a question. But anyhow, let us have one quick meanings and let us see a few examples. Number one, self-interest threat. When self-interest threat will occur? When the auditor is having some financial interest in the client or whatever he is dealing with, then that threat we call it as self-interest threat. Examples: holding the financial interest, like investing in the shares or investing in the debentures or bonds, or you are having some business relationship with the client, or your fees is contingent upon completion of the audit, contingent on findings. Client told he will pay the fees depending on your report. So, or you are exclusively depending, your majority of the revenue is coming from only one client. So these are all the cases where you are having a financial interest. You are tied up with the financial interest with the client. These are all the examples of self-interest threat. Number two, self-review threat. As a part of a previous engagement, you performed some work. Now in the position of an auditor, you are verifying the work which you have performed earlier. Basically, whatever work you have performed, that you are only reviewing. So that will fall under self-review threat. Example: you have been a director in the company. For the same company, they are asking you to act as an auditor, self-review threat. Or you have provided accounting and bookkeeping services for the client. For the same client, they are approaching you to do the audit. Or you have provided compilation of financial statements for them. The same company is asking you to do the audit services for them. These are all examples of self-review threat. Then we have advocacy threat. What is advocacy threat? When the auditor supports the client's opinion to such an extent where people believe that independence has been compromised. Examples: when you are acting as an advocate, like when we are representing a client in an income tax case or a GST case, when we are acting as an advocate, we support the client's opinion. We know our client has done a mistake. Just imagine, he has done some violation of the Income Tax Act. We know our client has done a mistake, but still we will support to make him win. If we are also appointed as an auditor at one place, we are supporting my client is a good person even after we know that he is committing a mistake. In another conflicting position as an auditor, I have to point out my client is a fraudster. So both are two conflicting positions or not, where independence will be compromised. In one engagement he will compromise. What are the chances for which engagement he will compromise? Audit only he will compromise, because for that you will get less fees. For that advocate services you will get more fees, there you will not compromise. And also one more case here, one point of conflict is there, one doubt which will be there in you. They say auditor dealing in the shares and securities will also fall under advocacy threat. Look at the example. So let me show you here. So one confusion people are facing, just let me sort it out for you. Like, so if you see here, self-interest threat, they have told direct financial interest or material or significantly indirect financial interest in a client, like holding the shares and all. When you come to advocacy threat, they say when an auditor deals with the shares or securities of the company. Sir, you told when you are holding shares of the company, it is a self-interest threat. Now once again, same example they are giving for advocacy threat. What is it? No guys, there is a difference. Holding a financial interest means you are owning the shares. Dealing in shares or security means you are acting as a underwriter. You are providing the services relating to IPO, FPO of a company. So that will fall under advocacy threat. Dealing in shares is different, owning shares is different. So if you are acting as an underwriter, or if you are providing some services relating to IPO or FPO, if you are see, some chart accountants will even provide that stock broking services and all. So if you provide those kind of services, then you are dealing in the shares. See, if you have been appointed as an underwriter, so what is your responsibility? To the extent possible, you have to promote the company for the people to apply for that shares. So even if you know that your client is doing some mistake, but still you will try to promote or not, you will try to advocate for him or not. So that's why if you are dealing in shares or securities, like as an underwriter or relating to IPO, FPO or stock broking services, that is an advocacy threat. If you own the shares, that will be a self-interest threat. Very, very important. I think in the recent times also they have tested this question. Next, familiarity threat. What is familiarity threat? What is familiarity threat? When you are having a close personal relationship. Here they talk about the personal relationships, like your relative is in some top financial position, or you have been an auditor for a very long period of time with the client, so because of which you develop sympathy towards the client and all. So these are all examples of the familiarity threat. I think familiarity threat you can easily identify. Next, apart from that, we have something called intimidation threat. What is intimidation threat? You want to act independently, you genuinely want to act independently, but the client is not permitting you to act independently by way of blackmailing or threatening. So no, how do people do blackmail? Do really blackmailing happen to the auditors? Yes, in PSU companies they will happen. So how they will happen is, say for example, in PSU companies the contracts and all will go to the local gundas and dadas. Definitely they will commit some kind of things and get the contract. If you try to find out that, if you are a PSU auditor, you found out one person has got a contract from this PSU to supply the material, but he committed something wrong and got the contract. You wanted to report it. So you did all the work. Tomorrow you are going to give the report and sign it. Today night he will come to your home with some people and he will give a thumki to you. So these kind of things we call it as intimidation threat, where you want to act independently, but still you are prevented from acting independently by way of intimidation, by way of threatening. These kind of threats we call them as what? Intimidation threats. But here I say is a little bit soft. They give examples of soft threats, like they are telling threat of replacement. The client is telling we will replace you. That is a threat or what? Replace me, I will go and find another company, right? So threat of replacement over disagreements with the application of accounting principles, or pressure to disproportionately reduce the work. We will reduce the fee, reduce the work. I told you, no, I say it's a little bit soft here, so we can't be so harsh in our official content. So that's why they have given examples of some soft threatening and all they have given, right? So this is what regarding 5 kinds of threats to independence. Now, next concept, if you see, safeguards to independence. Safeguards to independence. Safeguards means what? Protection. See, you should always try to protect your independence. So how we can try to protect our independence is, they say simple things here. They give so much of information, but the answer is very specific here. Before accepting the audit itself, before accepting the engagement itself, you need to check whether there is any threat to independence, whether there is any self-interest threat, self-review threat, familiarity. So whenever a client has approached you, the battery is over here. Done. So let us continue. So what are the safeguards to independence? Basically, how you have to protect your independence. First, we'll see simple things, then we'll read the content from the material. Often students will get confused here, but the underlying concept is very simple. So how to safeguard your independence? As I was saying before, whenever a client is approaching you and asking you to do some engagement for them. So first, before accepting the engagement only, you should check, is there any threat to independence? If it is there, either try to eliminate that threat, or try to take some actions to reduce the threat to an acceptably low level. So if you are able to eliminate the threat, or if you are not able to eliminate, at least you are able to reduce it to an acceptably low level by implementing some safeguards to you accept it. If you are able to do neither, you are neither able to eliminate it, you know that you will not be able to reduce it even to an acceptably low level, then don't accept that engagement only. Sometimes what will happen is, at the time of acceptance of the engagement, there will not be any threat to independence, but after you have accepted the engagement, then you will come across a threat to independence. Then what you should do? Here also same, either try to eliminate, either try to reduce it to an acceptably low level. If you can't do either, withdraw from the engagement. Withdraw from engagement. So that's what even they try to mention here. The concept is very simple, but they make the things look complicated. Like if you see, First point, they say, for the public to have confidence in the quality of the audit, it is always essential the auditor should always be and appear to be independent. General statement. So if the people have to trust you, you should always be an independent. Next, before taking on any work, an auditor must conscientiously consider whether it involves threats to his independence. This is also, I have told, before you take any appointment, that before only you have to check, is there any threat to independence. If such a threat exists, the auditor should either desist from the task. That means you should not do the task. When you should not do the task, if you are either unable to eliminate it, or you are unable to put the safeguards to reduce it to an acceptably low level. See, order, they have to change it here. So first, they should either try to eliminate. If they are not able to eliminate, implement the safeguards, reduce it to low level. If you are unable to do either, then you have to desist. That means don't take up the task. All the safeguard measures need to be recorded in a form that can serve as evidence of compliance with due procedure. That means if you have implemented the safeguards, reduce it to an acceptably low level, what safeguards you have implemented, what steps you have implemented to reduce that threat to an acceptably low level, that you have to record it. And if the auditor is unable to fully implement credible and adequate safeguards, he must not accept the work. Clear? Next. So the sentence formation and order is a bit different, but underlying concept is very, very simple. Next, let us come to the next concept. What is that? Professional skepticism. So one of the most important question again from the examination perspective. So what is this professional skepticism? What do you mean by skepticism, first of all? Being doubtful, someone who will not accept anything with ease, who will try to raise many questions, who will try to keep on digging the information. To convince a person, you need to provide him a lot of information. That nature of questioning mind, we are going to call it as what? Skepticism. Is skepticism good or bad from a personal perspective? From a personal perspective, we feel it as bad. No, so we have to convince. In order to convince a person, we have to, he will ask continuous questions, he will not accept anything with ease. So that is a difficulty on a person. So that is considered a bad quality at the personal level. But at the professional level, they say that skepticism is one of the most important quality which every auditor must possess. And professional skepticism means you have to maintain questioning mind on your professional matters. What is a professional matter for us? Audit engagement. Mainly we are going to deal about audit. We do various engagements, but as a part here, we are going to mainly talk about only audit engagement. So while doing audit engagements, you should not accept anything with ease. You should maintain an attitude of questioning mind. If the client has given you information, think from the perspective what information can go wrong, how, why the client might not have given a wrong information. Don't blindly accept anything, try to have a questioning mind. So that nature of questioning mind, we call it as what? Professional skepticism. But I say, as per the standard, professional skepticism contains three components. Professional skepticism contains what? Three components, which we generally call it as ABC of professional skepticism. So what is that ABC of the professional skepticism? A refers to maintaining an attitude of questioning mind, being alert to unusual circumstances, and C is critical assessment of audit evidence. So three things of professional skepticism. What are they? Number one, attitude of questioning mind. Number two, being alert to unusual circumstances. Number three, critical assessment of audit evidence. See, we know what is the meaning of attitude of questioning mind. As I have told, you have to maintain questioning mind. You should not accept anything with ease. You have to question why not this information could be manipulated, why not this information could be wrong. And being alert to unusual circumstances. Whenever you come across unusual circumstances, you should remain alert. Sir, what are the examples of that unusual circumstances to which you have to remain alert? So they say something in the contradictory audit evidences. If you have multiple evidences, sometimes you get evidence from multiple sources. If you are getting evidence from multiple sources, all that evidences should match with each other. They should not contradict with each other. So if you find any contradictory audit evidence, that is one example of unusual circumstance to which you have to remain alert. Similarly, if you have doubts over reliability of audit evidence, what? If you have doubts over reliability of documents, then also you should maintain questioning mind. Basically, you found one check. In that check, the signature is not matching. So that will generally give a doubt to you regarding reliability or not. That is one unusual circumstance. Will you remain alert or will you ignore it? You have to remain alert. And also conditions that may indicate possible fraud. sometimes you might come across a circumstance which might indicate there is a possibility of fraud. If you come across any such circumstances which indicate a possibility of the fraud, to that circumstances also you have to remain alert. And the circumstances that suggest a need for additional audit procedures. In some areas you might come across certain matters which need you to perform more audit procedures. To those areas also you have to remain alert. So these are the examples of unusual circumstances to which you should remain alert. Give me the examples, guys. 4 examples. What are they? Contradictory audit evidences, when you have doubts over reliability of audit evidence, conditions that may indicate a possible fraud, or situations which require additional audit procedures. So these are the 4 circumstances to which you have to remain alert. So B component also we are done. Now let us come to the C component. What is C component? Critical assessment of the audit evidence. You have to analyze critically the evidence from multiple perspectives, like whatever evidence you have got, is it sufficient, is there any requirement of additional evidence, is the evidence qualitative? So from multiple perspectives you have to obtain the critically analyze the evidence. So that is what 3 components. Now the next thing is, sir, by maintaining professional skepticism, how an auditor will get benefited? So by maintaining professional skepticism, you can reduce a certain risk. What you can do? You can reduce certain risk. So what kind of risk you can reduce? Number 1, risk of overlooking unusual circumstances. So if you don't have professional skepticism, if you come across unusual circumstances, I gave you just now example, what are unusual circumstances? If you don't have that questioning mind, you will ignore them. You will overlook them. But if you have professional skepticism, you will not just overlook them, you will pay more attention. So risk of overlooking unusual transaction, that risk you can reduce. Number 2, risk of overgeneralizing. You will also reduce the risk of overgeneralizing. So generally I use one common example to make you understand what is overgeneralization. A dog has how many legs? 4. Fact? No. That is a general fact. If I say all the beings which has 4 legs are dogs, that is what? Overgeneralization. There is a fact. A dog is having 4 legs is a fact. If I say all the animals which have 4 legs are all dogs, that is what? Overgeneralization. Is overgeneralization good or bad? Because they will result in wrong conclusions. See, overgeneralization might happen in the audit also. Like for example, I started my audit with sales. In the sales, I did not find any misstatement. Now, how can I do overgeneralization? Since in the sales, no misstatements are there, in all other areas also, there will not be any misstatement. Is that a good thing or a bad thing? Bad thing. But if I maintain professional skepticism, will I do overgeneralization? What will be my thought process? If in sales no misstatements are there, why can't be a misstatement in purchases? So by maintaining professional skepticism, I am reducing the risk of over generalizing, and basically over generalizing is very bad for audit, so that risk we are reducing. And also I will reduce the risk of taking inappropriate decisions. I will reduce the risk of taking wrong decisions regarding nature, timing and extent of audit procedures, which means I will take better decisions regarding nature, timing and extent of audit procedures. So by maintaining professional skepticism, the auditor is going to get benefited by reduction of 3 kind of risk of overlooking unusual transactions, risk of overgeneralizing while taking decisions, risk of taking inappropriate decisions regarding nature, timing and extent of audit procedures. Comfortable? Shall we proceed further? Right. So we are done with that. So now what else we do? Fine. So we'll try to understand SA 210 related provisions now. Agreeing to the terms of the engagement, very, very important. From this area also, they're asking a lot of questions in the recent times. So let us try to cover SA 210, agreeing to the terms of the engagement. See, they say one more thing here. If you are an auditor, before you accept the audit, as I have told, first you will check for independence requirements, whether you are able to comply with the independence or not. Are there any threat? If any, we will try to eliminate. And after that, one more thing also you need to check. Before you say yes to the audit, you need to check few more things also. You need to check something called whether preconditions for an audit exist or not. Whether there are preconditions for audit, whatever are there, whether they are existing or not. And you should obtain one understanding with the client regarding the terms and conditions of the audit. Before you can accept the audit, first we will check independence requirements. In addition to that, we need to check 2 more things. What is that? Whether preconditions for an audit are present or not. So what do you mean by preconditions? Prerequisites also you can say. So before you want to do something, if I say there are some preconditions before I can start the class, that means what? There are some essential things which must be present before I can start the class. Similarly, when I say preconditions for an audit, there must be some essential things before I can start doing the audit. So what are that preconditions? We'll talk about it later. But I need to check before accepting the audit whether preconditions for an audit are present or not. In addition to that, I should get an understanding. We should arrive, I and the client, we should arrive at a common understanding regarding the terms and conditions, and regarding the preconditions also, we should obtain one common understanding. So I will come back to that preconditions later, but let us talk about common understanding. How can we arrive at that common understanding? See, in any commercial engagement, in any commercial transaction, there is always a chance of misunderstanding between the parties to the business transaction. Take, for example, buying, selling, or even you take service provider, service recipient. In every kind of commercial transaction, there is always a chance of misunderstanding. Like the conflict might come in price, the conflict might come in deliverables, the conflict might come in quality, quantity, in multiple things, the issues might come. But in all the commercial transactions, we can do one simple thing to avoid 99% of the misunderstandings. What is that one? What is that one thing we can do? So basically, agreement we can write. So what are the terms and conditions of the supplier, of the recipient, and what is expected payment terms? Everything, if we put it on a piece of paper, better on a stamp paper. If the both the parties to the contract sign it along with the witness signatures and all, that will be legally one thing which we can resolve 99% of the misunderstandings. Like any other commercial transaction, even audit is also a commercial transaction. We are not doing any charity. Even audit is also commercial transaction. Even in audit also, misunderstandings could come. So if we want to avoid, like for example, if I accepted the audit of the client, so I went to the client's premises for doing the audit. I went to the management and told, sir, please give me financial statements, I will start doing the audit. Management is telling, what financial statements? I told, sir, financial statements you have to prepare and give it to me, then only I will do the audit. Now the client is saying, that's why we appointed you. So clear misunderstanding, no? So you could have avoided even this misunderstanding also before accepting the audit. What is your responsibility? What is management responsibility? What you are supposed to do? What management is supposed to do? What is the fees, payment structure? Everything you could record it in a piece of paper. You sign it. Let the client also sign it. Both of you keep one copy, and 99% of the misunderstandings will be resolved here also. So that document which contains the terms and conditions of the audit, we call it as engagement letter or letter of engagement, we call it. And this letter of engagement should be prepared by whom? Auditor. Auditor should prepare the engagement letter and send it to the client, not the other way around. So auditor must send the engagement letter to the client and get the client's acceptance by way of a signature. And this client this audit engagement letter should contain some contents. What and all should be the contents of the engagement letter? How you can prepare that engagement letter, and what and all should be there in the engagement letter? So if you see here, these are all the contents of the engagement letter. So there should be a paragraph which is talking about objective and scope of audit. So what is your objective, what is your scope, you have to include. Responsibilities of auditor, responsibilities of management, identification of applicable financial reporting framework. Which financial reporting framework will be applicable to them, that you can identify. Reference to expected form and content of the audit report. What will be your expected form? What content will be there in the audit report? Simply you can refer to the standards. I will give the audit report as per SA 700. So like that, you have to give reference to expected form and content. But one important clause is missing here, payment terms. That is where 99% of the conflicts will come. You have to add the fees clause also, payment terms also, you have to add it. And along with that, at the bottom, management will sign, someone representing the management. If it is sole proprietor will sign. If it is a partnership firm, any of the partner will sign. If it is a company, some director on behalf of the company will sign, and also auditor will sign. So but auditor has to prepare it as per SA 210. Auditor has to prepare it, send it to the client, and get the client to sign it. So that will indicate that they have agreed. So I told one thing which we need to check before accepting audit. You should get a common understanding. No, how you should get that common understanding? By way of this engagement letter. So if we have included all this in the engagement letter, as an auditor, I signed it, I gave it to the client also signed it, that indicates that the client has agreed to the terms and conditions. That is how you should get a common understanding. Okay. So now in all this content, we have to focus something on responsibilities of management. Sorry. We should focus on responsibilities of management. Sir, what should be the responsibilities of management? Those responsibilities of the management is only, we call it as preconditions for an audit. See, when I say preconditions for an audit, what do I mean by that? Before I could do the audit, some things should be done. So before I can do the audit, unless and until management does some things, Unless and management makes ready certain things, unless and until management agrees to do something, I can't go and do my audit. So the other name for management responsibilities is nothing but what? Preconditions for an audit. So what are that preconditions? Number one, management should prepare financial statements. Unless and until management prepare the financial statements, I will not be able to do the audit. So preparation of financial statements is a precondition. It is whose responsibility? Management. And they have to prepare the financial statements, that too as per applicable financial reporting framework. Good. Second one, just preparing financial statements alone will not be enough. They have to even implement internal controls. That is also whose responsibility? Management responsibility. Number three, to provide the auditor. I am an auditor. If I have to do the audit, I have to get access to all the records, information, books, documents, everything. I need to get the access. Unless and until management gives the access to me, I will not be able to do the audit. So it is whose responsibility to give the access to me? Management. So third precondition, to give the auditor with access to all the records, documents and information. So management has given me records, but I need some extra information or clarification. It is whose responsibility to provide? Management once again. And I need to talk with the people. I need access to the people, access to the employees from whom I can inquire and get the information. That too unrestricted access. So it is whose responsibility to give me unrestricted access to the people in the organization? Management. So these are all basically responsibilities of the management. So three things I have told: preparation of financial statements, implementation of internal controls, to provide auditor with the three things. What are they? Books, documents and records, additional information and explanation, unrestricted access to people within the organization. So all these preconditions must be present. So if we now try to cover the content here, so if you see, write a short note on agreeing to the terms of the audit engagement as per SA 210. They say that the objective of the auditor is to accept engagement or continue engagement only when basis upon which it is performed has been agreed. You have to agree with the client certain things before either you can accept or continue the engagement. So what are they? Number one, you need to check whether preconditions are present. Basically, whatever responsibilities are there, whether that management has fulfilled or not. Number two, confirm that there is a common understanding between the auditor and the management, and where appropriate with those charged with governance. So this is nothing but how we get that common understanding? By way of engagement letter. Then what if these things are not present? Don't accept the audit only unless there is a requirement of law or regulation. Here you will be able to find it. What happens if preconditions are not present? Unless there is a requirement of law or regulation, unless law is forcing you to accept the audit, in all other circumstances, if either preconditions are not present, preconditions are not present, that is agreement of the management is not obtained. And one more thing also, they say whatever applicable financial reporting management has followed, that is not acceptable. Like for example, client is a banking company. They are required to prepare the financial statements as per Banking Regulation Act, but the client says no, we will not follow, we will follow only Companies Act. Then also you should not accept the audit. Adoption will be done by management only, but you should check whatever applicable financial reporting framework which has been adopted by the management, is it acceptable or not. If it is acceptable, accept the engagement. If it is not acceptable, don't accept the engagement. Clear? Next. So if we talk about, so meaning of the engagement letter and all, that I have already told you to avoid the misunderstanding and all. Next, yeah, what are the preconditions for an audit? So as I have told, you need to determine whether financial reporting framework is acceptable, that you have to determine. In addition to that, you should get an agreement whether management fulfills these responsibilities. Management responsibilities I have already told you. To that, one more point they add in the preconditions. What is that? Checking whether applicable financial reporting framework is acceptable. Along with that, management has fulfilled the responsibilities or not. So to the management responsibility, if you accept that, if you add that one point, that will become what? Entire preconditions. Understood? Clear? Right. Next content also we are done. This one, question number 12. What if there is a limitation on scope prior to audit engagement acceptance? Before you accept the audit only, the client is coming and putting a restriction on your work. Then what you are supposed to do? Don't accept the engagement only. Like for example, a client came to your office and told, sir, you do a company audit for us, but we will not give you any data regarding sales. You did not say yes. At the time when he is asking only, he is saying, we will not give you sales data. What you will say? Show him the exit gate. Yes or no? So that means don't simply accept the engagement. See, sometimes what will happen is at the time when I'm accepting the engagement, then the client did not put any objection. He told okay. For everything, he told okay. Then after I have started doing the audit, now the client is coming to me and asking me to, and he's requesting me to change the terms of the engagement. To change the terms of the engagement. Like for example, so what they try to say here is, so changes in the terms. If before only they are requesting, no issue, we will not accept. If after they are asking, so client is coming to me and asking me a request for changes in the terms of the engagement. Like for example, as a part of my initial thing, I told, sir, I will verify the stock also. Client told, okay, sir, you verify the stock. I started verification. Then when the audit is progressing, when I wanted to visit the warehouse and verify the stock, client told, now he came to me and requested, sir, please take out the stock verification from your scope. Earlier he agreed, but now he is coming to me and asking for change in the terms. Earlier he told, okay, I want to go to the warehouse and verify the stock. But now he is coming and telling, no, sir, please take out that from your scope. Now what I should do? So now what they say here is, first you should ask for reasons. So whenever see, first of all, you should understand why the need might arise, why the auditor might need why the client might approach a auditor asking for the changes in the terms. There could be multiple reasons. Sometimes there could be changes in circumstances. Sometimes the situations might have changed, whatever conditions which are present at the beginning of the audit. Like as you could see here, sometimes there could be change in circumstances. Sometimes there could be a misunderstanding. At the time when we originally agreed to the terms, client misunderstood. Now he realized his mistake. Now he might approach you asking you for the changes in the terms, or sometimes intentionally to put a restriction. So any of the three reasons, either that could be a change in circumstance, or either that could be a because of misunderstanding, or that could be because intentionally putting a restriction on your scope. See, out of these three, first two are genuine cases. So if there is a change in circumstance, or if there is a misunderstanding, that's why they are asking you to change the terms of the engagement, genuine cause. But if it is because of third case, then it is not a genuine cause. So whenever the client is coming and approaching you asking for the changes in the terms of the engagement, first you should go and ask them reasons. Now on the basis of reasons, you should evaluate, is there a reasonable justification or there is no reasonable justification. If you go back to the example whatever I was using, client is coming to me and asking me to change the terms of engagement. They are asking me to take out inventory verification for my scope. Now I asked the reason, sir, why? They told, sir, the place wherever we have kept the stock, that is at a place where social riots are happening, where some calamity is happening or some social riots are happening. Traveling to that place is prohibited. Now I can't go and verify. So that's why they are asking me to exclude that from the scope. I can't say, no, even if I die also, no problem, I will go and die on the field. You can't say, you're not an army soldier, you are just a chartered accountant. Okay, you can't say that. So the client is asking you to exclude that inventory verification from your scope. And is there a valid justification? Yes. Yes, there is a reasonable justification. Now what you should do? Now what you can do is you can agree to the change. But once you have agreed to the change, old engagement letter will no longer be valid. You have to draft a new engagement letter. And also, when you continue with the new engagement, finally you will give the audit report. No, in your audit report, you should not give any reference to the old engagement letter. You should not give any reference to the audit procedures performed as per old engagement. Like if I have to relate with this example, you are taking out inventory verification from your scope. That is a new engagement. In the final audit report, whatever you are giving, you should not refer to any audit procedure that you have performed regarding inventory verification. Understood? Right. See, sometimes what will happen is when you are going to agree to the changes, sometimes you might not be able to continue with the audit engagement. Why? Because if you agree to the changes, assurance is coming down. In audit, we need to obtain reasonable assurance. But sometimes you feel that if you agree to the changes and all, that assurance you will not be able to provide. Even reasonable assurance also you will not be able to provide. Then what you should do is you should say, I will no longer be able to continue audit engagement. Let us change the engagement altogether. Like you can ask them to convert it to limited assurance engagement, like review engagement. You can request it. So what is that review engagement or all? We will talk about it later. But for the time being now, if you are reasonable, if there is a reasonable justification, you can agree to the changes, document a new engagement letter, and in the audit report which you give, you should not mention, you should not give any reference to the old engagement letter or whatever audit procedures you have performed as per old engagement. Sir, what if there is no reasonable justification? If there is no reasonable justification, don't agree to the changes. Don't agree. You say, no, sir, I will not. For example, I wanted to verify the stock. He's coming and saying, no, no, sir, please take out verification from your scope. I asked him, why you are asking me to exclude that verification from my scope? He told that, sir, keys are missing. What he is telling? Keys are missing. Is that a go down keys are missing, sir? He is saying. Is that a reasonable justification? No. What you will say? I will say to the client, boss, no, this is not at all a reasonable justification. You can't stop me. I have to go and verify the inventory verification only. In majority of the cases, what will happen is when you reject to do the changes in the terms, auditors, clients will not mess with you, because we know we will make their life a mess. So they will not mess with you. So what they will do is they will permit you to continue the audit as per original terms. Okay, why the headache with this fellow? Go and verify, they will say. In some cases, what will happen is you are not agreeing to the changes in the terms, but the client is not permitting you to continue the audit as per original terms. So when you don't agree to the changes, two options could be possible, two outcomes could be possible. Outcome number one, continue the engagement as per original terms. Case number two, what will happen? The client is not permitting you to carry out the audit as per original terms. If he's continuing, if he's permitting me, okay, you want to do verification, you are not listening, no, go and verify. Then what we will do? Continue the audit, perform the audit procedures, complete your audit. But in some cases, client will not permit you to continue the audit as per original terms. So he told key is missing. I told no, I will not agree. I will go and verify. Then he is saying, I will see how you will verify. I have placed 4 people there. Cross them and go and verify. So he is not permitting me to continue the audit as per original terms. Then what I should do? Then you have to withdraw from the engagement. Then you have to withdraw. So here also most of the students often they do the mistake here is whenever there is no reasonable justification, the straight away option is not withdrawing. When withdrawal will come into picture, you do not agree to the changes, and if the client is not permitting you to carry out the audit as per original terms, then the question of withdrawing comes. Clear? If you do not agree to the changes, but the client is permitting you to carry the engagement as per the original terms, what is the question of withdrawing there? Not required, no? Yes, so you have to be very careful there. Understood? So this is what regarding the things. So withdraw from the engagement. So you have to withdraw from the engagement in case if they're not allowing to continue as per the original terms, and also determine whether there is any contractual or either a obligation, either contractual or otherwise, to report the circumstances to other parties. Sometimes withdrawal alone will not be enough. You might have an obligation to report this to some regulatory authorities or the people who have appointed you. Like in the case of a bank, in addition to withdrawal, I might report to RBI. There might be an obligation on me. Fulfill that obligations also. Withdraw. No one is stopping you, but fulfill that obligation of reporting and all. Understood? Right. And one more thing, in the case of engagement letter, I missed one important point, which is having a chance of getting tested in the MCQs. This one. If law or regulation prescribes in sufficient detail the terms of the audit engagement, the auditor need not record them in a written agreement, except for the fact that such law or regulation applies and the management acknowledges and understands its responsibility. This is very important statement. A lot of interpretations are there. See, if you have seen in the case of in the engagement letter, multiple things we are required to include, like what are the responsibilities of the management, what are the responsibilities of the auditor, we have to include. In case if the scope is already decided under law, this will mainly happen in the case of statutory audit. In case of company audit, what are the responsibilities of the management, what are the responsibilities of the auditor, they would have already given under Companies Act. If law or regulation is already explaining in sufficient detail what and all are the terms of engagement, you need not once again record them in a detailed manner in your engagement letter. You need not write what are the responsibilities of the management in the list. You need not write what are the responsibilities of the auditor. That list you need not write. Simply what you can do is you can say the responsibilities of the management are as per so and so section of the Companies Act, and management accepts its responsibility. Like that, you can give a reference. So if law or regulation prescribes in sufficient detail the terms of the audit engagement, they need not be, not a compulsion once again. If you want to write it, write it. Even if you don't want to write it also, not a problem. The auditor need not record them once again in a written agreement. What you can do, but you have to mention one fact. What fact you have to mention? So and so section will become applicable, so and so law they have given the responsibilities that will become applicable, and the management should accept it. So if you mention that, that will be enough. So now how they will test this question in a MCQ is, See, earlier when they have a true or false statements, that is better here. Earlier when they had a true or false, that will be better. So now they will, in the MCQs, no, in the MCQs they will test true or false statements. How they will test MCQs in the true or false statements? Choose the correct statement from the below. They will give a question, choose the correct statement from the below. 4 options they will give. In one option, what they will do, in one option, they will remove this not. In one option, they will remove this not. They say if law or regulation prescribes in sufficient detail the terms of the engagement, the auditor need to record them in a writing. In some case, what they will say is here they will keep the not as it is, but they will add not here. If the law and regulation does not prescribe in sufficient detail the terms of the engagement, the auditor need not record them in the writing. In one more statement, what they will do is they will do some other thing, some other correction they will do, and only one statement will be there which will be as it is. So now you tell me true or false statements is only better. No, there we are required to analyze only one statement for 2 marks. Now for 2 marks we have to analyze 4 statements. So lot of torture there. So you have to be very careful when you are reading it. So this question, this statement is having a very high chance of getting tested in that manner. So don't go with the terminology. I'm not asking you to mug up the content. Try to break the sentence and understand in the correct perspective. See how many sentences you will mug up here. You can't do it, no. So that's why, but if you become clear with the concept, what the intention behind that statement, no matter in how many ways they try to confuse you, you will be able to write correct answer. Yes, that will take some time. I will say that will definitely take some time, but instead of mugging up, concentrate on the concept. Understood the intention behind the sentence? Logic behind the sentence? If the law or regulation is already prescribing in sufficient detail the terms of the engagement, you need not record them in once again in writing, except that you have to mention the fact and state that management accepts its responsibility. So like this, understand the concept behind that complex statements, then you will be able to write the correct answers. Clear? Understandable? Shall we proceed further? Right. So we have one more last thing. After that, we will wind up this chapter also. In case of recurring audit, see, we can divide engagements into 2 categories: initial audit engagement and recurring audit. Basically, initial audit engagement means if the previous year's auditor and the current year's auditor both are 2 different persons, then we call the current year engagement as initial audit engagement. If the last year auditor is only appointed as current year auditor, then we call that engagement as a recurring audit. See, if it is the initial audit engagement, if last year you are not the auditor, definitely you will send an engagement letter. There is no question about it. What about the recurring audit? Last year you have done the audit. Last year you might have given the engagement letter. Current year, the same company, the same client, the same auditor. Are you required to give the engagement letter in this year also? Not mandatory. The law did not say yes or no. The law has left it to the choice of the auditor. Let the auditor himself decide. If he wants to send the engagement letter, let him send it. If he doesn't want to send the engagement letter, don't send it. We don't have any objection. But still, what the standard has told is they have given some circumstances. If any of that circumstances present, even though it is a recurring audit engagement, still it is mandatory to send the engagement letter again. So what are that circumstances? Like if you came to know that the entity has misunderstood the provision. Last year I sent the engagement letter, but there is a clear indication they misunderstood some term last year. Rectify it by sending the new engagement letter once again. Or terms of the audit engagement have changed, like fees has changed, your responsibilities have changed, recent change of senior management, board of directors have changed, send a new engagement letter, get the acceptance of the new management. Or significant change in ownership, might be some other company has acquired significant stake in your client company. So like your client has become a subsidiary of some another company, so send the engagement letter once again. Or change in nature or size of the entity's business, your client's business has grown much wider when compared with the last year, send an engagement letter, new areas you have to cover. Or there is a change in legal or regulatory requirements, or there might be a change in financial reporting framework, like accounting standards have changed, schedule 3 amendments are there. So try to get that acceptance by way of new engagement letter. Or a change in other reporting requirements, like auditors reporting responsibilities, SA requirements. If those things are also changing, then also you can send an engagement letter again in the case of recurring audit. One more last, this is really last. See, just this was a new thing, many people will have a confusion, that's why I wanted to focus this thing. Principle based approach versus rule based approach. Very simple. See, institute wants to make sure that chartered accountants are complying ethics. They have to make sure that we chartered accountants want to comply the ethics. Now, when they have to bring the ethics, when they have to give the ethics, what ethics we are required to follow? There are 2 approaches. One is rule based approach, easy to understand. So rule based approach is, say for example, ICA is saying 10 things. These are 10 things you should not do, or these are 10 things you should do. So if you follow that 10 rules, that will be enough. If I give you one example, if I'm saying this class analogy only, will use it. So if I told that if you want to come and sit in my class, I gave you some 10 instructions. I told you should come on time, you should not talk in between, you should not use a mobile phone, like that 10 instructions I have told. So my approach is to make the class effective, to make the class interactive. That is what my intention. So that's why I have given rules to follow. But what one student is doing is he's following all the 10 instructions, he's coming and sleeping. He's coming and sleeping. I did not include that sleeping in my 10 instructions. So you tell me, is my objective met there? No. So in the rule based approach, what I generally do is some list of rules I will give that you are supposed to follow. But I told other way. What I told is, I told you 10 instructions. Along with that, I also told, if I find any person not listening, not paying attention in the class, I will throw him out of the class. Throwing in the sense sending out. I can't lift you and throw it. So just I will send you out of the class. That's what I have told. So now it is a principle based approach. I'm not telling you exact rule. I'm telling what I want to achieve. So when I say you have to pay attention, you have to be listening to the class, even not sleeping also will get covered there. Not using mobile phone also will get covered there. So everything will get covered or not. So that is a principle based approach. So where we will tell what is the objective required to achieve that principle, everything will get covered. Same logic now apply to ICI. ICI wants to make sure that chartered accountants follow the ethics. They can either bring rule based ethics or principle based ethics. You tell me which is effective. Not exactly, both combination we have. So they have given rules, they have given list also. Like for example, as I've told, professional ethics, which we will learn it in the CA final. So there they have told some 25 things which a member in practice should not do, which a member in service should not do. Some 20 things they have told. For example, I'm not telling exact figures. That is rule. But in addition to that, they give broader perspective also. You should not be committing any, like for example, if you see now professional behavior we have seen, you should not do any such act which brings a disrepute to the profession. Now what will bring a disrepute? It is not listed out. Every activity which brings a disrepute will get covered here. So even ICA has also followed the same model. We have a combination of rule based approach as well as principle based approach. That's what this is all the question is about. Rule based is very narrow, principle based is very wider. Both are on extremes. So we need to have something in combination. A rule based with a little bit of principles also we need to have. Understood? So that is what the difference between principle based approach versus rule based approach. Able to understand the concept, right? So with this we will wind up ethics and the terms of engagement. Clear? So in the previous session we have completed the revision of the chapter ethics and terms of the engagement. So till now what and all chapters we have completed. So we are done with the 3 chapters. So first one we are done with introduction to audit. Number 2 we have done with nature, objective and scope of audit. And the third one we have completed ethics and the terms of engagement. So now we are going to talk about the next very important, very conceptual and very practical chapter we are going to talk about, which is dealing about auditor's report. So basically, as I was saying in the morning session, in the previous session, the ultimate objective of the auditor, what is the ultimate objective of the auditor, is to express an opinion on the financial information. And when I say auditor has to express his opinion, that opinion has to be expressed in a written format. If the auditor comes before the audience and take a mic like this and speak out his opinion, that is not going to be a valid opinion. So he should express his opinion in a written format, and that written document which contains the auditor's opinion, that document we are going to call it as audit report. And can the auditor prepare the audit report according to his own wishes? Can he use whatever terminology he wants? Can he use whatever format he wants? No. Why? Because we need uniformity in the audit reports. See, today we have uniformity in the financial statements. Like if you take the financial statements of multiple companies, you can compare them easily so that you can do better analysis, better comparison. So that kind of uniformity we even require even for audit reports also. So if someone has to compare the audit reports of 2 entities, they must be comparable. They must follow some same format, same terminology. Then only the people will be able to compare it. So we need that uniformity. Like the way today we have achieved the uniformity in the financial statements, the same level of uniformity even we require for audit reports also. What is the way by which we can achieve that uniformity? So we can achieve that uniformity by way of standards on audit. So if we ask all the auditors to prepare the audit report as per specified standards, and when they follow practically these standards when preparing the audit report, then even audit reports also will be uniform, they will also be standardized, and that will lead to better comparison. So ICA has given a few standards. They have suggested 700 series of standards which are going to deal about how to prepare the audit report, what should be the format, what should be the content, what terminology you have to use. So all that content has been given in the SA 700 series. That SA 700 and SA 700 series we are going to learn here. So basically four standards will get covered here. SA 700, then we have SA 701, we have SA 705 and SA 706. So these are the four standards which are going to guide the auditor regarding how to prepare the auditor's report, what format you have to follow, what headings you have to do, what terminology you have to use. All that guidance has been given under these four standards. These are four standards we are going to cover. In addition to these four standards, there are a few reporting requirements as per the Companies Act. In case if you are going to conduct a audit of a company, in addition to fulfilling the reporting requirement as per the standards on audit as per SA 700 series, in addition to that, you are also required to fulfill some reporting requirements under certain sections of the Companies Act. So those sections of the Companies Act are 143 subsection 1, 143 subsection 3, 143 subsection 11, and 143 subsection 12. So under all these subsections of section 143, we have a few reporting requirements. That reporting requirements also we are required to cover. And this reporting requirements under 143 subsection 11, there is other name for that. We also call it as CARO 2020. So that CARO also we have to cover. So these many things we are supposed to cover as a part of this chapter audit reporting. Okay, clear and comfortable everybody, right? So we'll do one more thing. We'll try to load the things here. We'll try to take the help of one audit report. With that, we'll proceed. With that, we'll proceed. Just give me a moment. I will load the audit report. So I have taken an audit report for our reference. So Reliance Industries Limited audit report I have taken. So using that, we will try to proceed further. So first, out of four standards which we are required to cover, the first standard which I will pick for explanation is SA 700. So SA 700 is a standard which is going to talk about overall audit report and what and all contents should be there in my audit report. So SA 700 speaks about many things, but I will ignore all that. First, I will come to the most important thing. What and all are going to be the contents of auditor's report. So the contents are given here. Let us try to understand that contents. Right. So this paragraph is going to talk about. So if you come to this paragraph is going to talk about what and all contents should be there in my auditor's report. So as you could see here, the list is there. The list contains various elements like, as you could see, title is there, address is there, auditor's opinion, basis for opinion. So like that we have so many contents. So we will try to address each and every content in the auditor's report. So first I will start with the first content, which is what? Title. So whenever you are giving an audit report, that audit report should have an appropriate title. So what will be that title generally? Independent Auditor's Report. So whenever, in case if you are conducting a statutory audit, in case if you are conducting an external audit, the title of your report should always be Independent Auditor's Report. So that's what even you will be able to find it here. We have something called independent auditors report. Then after that, the next content. What is the next content? Addressing. To whom you are expressing the opinion. So basically, as a part of this audit report, we are expressing the opinion, but to whom you are addressing this opinion, to whom you are expressing that opinion. We have already told this in the nature, objective, and scope of audit, to whom the report will be addressed. To the owners. So basically, whoever have appointed you, to them you are going to address. So in the case of a company, owners will be what? Shareholders. So to the shareholders, you will address. In the case of a partnership firm, we are going to address it to partners. In the case of a society, we might be addressing it to the board members of the society, trustee in the case of trust and all. So like that, depending on the owners of that organization, proper addressing will be there. So since Reliance is a company, they will address to the members, shareholders of the Reliance Industries Limited. Next, so title we are done, addressing we are done. See, these two are not actually title, these two are not actually contents. This I will say basically as headings. The first and foremost content in the auditor's report is auditor's opinion. So why we are giving auditor's report? What is the main objective? To express opinion. So standard also says first come to the point. You are giving the audit report for expression of opinion. First to fulfill that purpose. Whatever opinion you want to express, that you express it. After expressing the opinion, if you have to say something else, then say it. Yes, we have a lot of things to say, but you should not confuse the reader saying all the other things somewhere in between. You are embedding the opinion paragraph. He will not be able to identify which paragraph is opinion only, or you are going to keep it at the end. So we can't guarantee that person will read till the ending. Even after the first paragraph itself, he will read it or not, we don't know. So that's why the standards have been very specific. You are giving the audit report for expressing the opinion. So first to come to the point, express your opinion. So now we need to talk about this opinion in a detailed manner. Now we are going to talk about this opinion in a detailed manner. So tell me, opinions are into how many categories? So like any other opinion, even auditor's opinion is also divided into two categories. What are the two categories? Unmodified opinion and the other one is modified opinion. So nothing but in our common parlance, if I have to put it, unmodified opinion is a positive opinion, modified opinion is a negative opinion. Why these names? The logic is very simple to remember. Who will prepare financial statements? Management. I have verified the financial statements prepared by the management. I am satisfied that financial statements are giving true and fair view. They don't need any modification. That's why the name, unmodified opinion. On the other hand, modified means what? Management prepared the financial statements. I have verified the financial statements, but I am not happy. I feel that financial statements need some modification. So then I will give what? Modified opinion. So first, when unmodified opinion will be given, in what circumstances unmodified opinion will be given? So the standard says that SC 700 says you have to give unmodified opinion when you have obtained sufficient and appropriate audit evidence, and when you have been satisfied that financial statements are free from material misstatements, and you are also satisfied that financial statements are prepared as per applicable financial reporting framework. So if you have sufficient and appropriate audit evidence, and if you are satisfied that financial statements are free from material misstatements and they are also prepared as per applicable financial reporting framework, then the auditor should give unmodified opinion. So when I say unmodified opinion, should the auditor mention in the opinion paragraph, I am giving an unmodified opinion? Should he use that phrase? Do you think if he uses the phrase, I am giving an unmodified opinion, will the normal user be able to understand? Sometimes we ourselves, after taking these many lectures, after reading these much time, sometimes we only get confused. What is a modified opinion? What is an unmodified opinion? So you can't expect the common audience who doesn't know this technical terminology to use this phrase as unmodified opinion. So that's why what the standard has told you is, if you want to give unmodified opinion, we will tell you the phrase. I say so confident on our communication skills. Okay, so wherever drafting things comes into picture, they did not give the choice to us to choose what kind of sentences we have to use, how we have to draft. That freedom has been taken away from us. So wherever drafting you are required to do, what the ICA has done is, in the standards we will give appendix. There we will give for everything a format we will give. Just copy paste it, make the changes of the name of the client, the name of the auditor. That much you do. We are no longer trusting you on your communication skills. So we don't have any opportunity to show our communication skills there. So we have to simply do the copy paste job here. So what the standard has told is, if you want to give unmodified opinion, we will give you terminology. So what is the terminology is, if you want to express unmodified opinion, in your opinion paragraph, use one of these phrases, not both, any one phrase you have to use. You can say that the financial statements give a true and fair view. This terminology you can use. Or if you want to be different, If you want, see, we all have that urge, we have to look different from the crowd and all. So that's why they are giving that option also. If you want, you use the phrase financial statements give a true and fair view. 90% of the people will use it. But that guy will be there, no, who wants to sound different. So what that person will do is, for them also, in order to satisfy them also, ICA has given one more statement. You use the phrase financial statements present fairly in all material respects. One of these two phrases you use. Either financial statements give a true and fair view, or you use the phrase financial statements present fairly in all material respects. Apart from that, nothing else. You can't say financial statements are not misleading, financial statements are correct only, financial statements give proper information. Sir, everything is conveying same thing. Yes boss, everything is conveying same thing, but we don't have freedom to use that many phrases. Any of this two phrases, financial statements give true and fair view, or financial statements present fairly in all material respects. Any of these two phrases you have to use. And there are other names for unmodified opinion. We also call it as unqualified opinion, we also call it as clean opinion, also we do call it. Understood? Clear and comfortable, everyone? So if you come to the Reliance Industries Limited audit report, so we have the opinion paragraph. In the opinion also two paragraphs will be there. First paragraph, I will come back to that later. So in the second paragraph, second sub-paragraph of the opinion paragraph, actual opinion of the auditor will be expressed. Like if I take you through the exact phrase, if you see, in our opinion and to the best of our information and according to the explanation given to us, the aforesaid financial statements required by the Companies Act as amended in the manner so required, and they give a true and fair view. So it is an unmodified opinion. Nowhere you will be able to use the term unmodified here. But how we are able to identify it as an unmodified opinion? By paying attention to the phrases, whatever they are using, we are able to identify this is an unmodified opinion. Clear? Right. So now let us come to the modified opinion. When the auditor will give modified opinion, if I put it in simple terms, if the auditor doesn't want to say the financial statements are giving a true and fair view, he observed some negative comment, he found some material misstatement, he don't want to say financial statements are giving true and fair view because he found something wrong, then he will give modified opinion. We will define the term modified opinion later, but first we will try to understand what are the different types of modified opinion. So we have three types of modified opinion. How many we have? Three types, which are, number one is qualified opinion, adverse opinion we have, disclaimer of opinion we have. So these are the three different kinds of modified opinion. All the three are modified only, all the three are negative only, but severity of the negativity will change. Some are less severe negative, some are extremely severely negative. So severity of the negative opinion is changing, but all the three, qualified, adverse, or disclaimer, everything is a kind of qualified opinion only. So first we will talk about qualified opinion. When qualified opinion will be given? So they say that qualified opinion can be given in two circumstances. So what are that two circumstances? Case 1, auditor has obtained sufficient and appropriate audit evidence. On the basis of that evidence, auditor concluded that there is a misstatement. Auditor concluded that there is a misstatement whose effect is material but not pervasive. Whose effect is material but not pervasive. So you have performed audit procedures, you have obtained sufficient and appropriate audit evidence. On the basis of that evidence, you have concluded there is a misstatement. The effect of that misstatement is material. It is material enough. If it is not even material, then we will not come to the modification only. If you found a misstatement is there, but it is not at all material, then there is no need of modification only. You can give unmodified opinion. But you found a misstatement which is material, but not pervasive. What do you mean by pervasive? So pervasive, if I put it in simple terms, a very big misstatement which is large enough to say financial statements are completely wrong. A misstatement which is large enough to say financial statements are completely wrong. But technical definition, we'll come back to that later. Very big misstatements you can say for the time being now. So that we call it as pervasive. So I found a misstatement which is material but not pervasive. Then I will give what? Qualified opinion. Similarly, there is also one more case where I can give a qualified opinion. So what is that case? I am unable to obtain sufficient and appropriate audit evidence. And the matter regarding which I am unable to obtain sufficient and appropriate evidence, the possible effect. What the phrase I have to use here? Possible effect. When you have evidence, you will use the phrase what? Effect. When you have evidence, you can say it with certainty. What is the effect of this? When we don't have evidence, we are estimating. Even though item, for example, I'm not able to obtain evidence regarding stock. If that stock goes wrong, I'm not telling it has definitely gone wrong. Since I don't have evidence, I'm assuming if that item regarding which I'm not able to get the evidence, if that goes wrong, what will be the possible effect? So whenever you are using the phrase evidence is not available, you should never use effect of the misstatement. You should always use the phrase possible effect of the misstatement. So I don't have sufficient and appropriate audit evidence, and the possible effect of the misstatement is what? Material but not pervasive. Then also I will give modified qualified opinion. I will give. Can I use qualified opinion phrase when the auditor is giving qualified opinion? Will he mention in the opinion paragraph, I am giving qualified opinion? Once again, confusion will come. Normal people will not be able to understand. So here also what ICA has done, we will give you the text. Use the same thing. So what they have told is, in case if you want to give a qualified opinion, how you give the opinion is except or subject to certain items. Except or subject to certain items whose effect or possible effect. If you are giving a qualified opinion because of availability of evidence, you can say except or subject to certain items, so the effect of which is so and so, the rest of the items are giving true and fair view. Except or subject to certain items whose effect or possible effect. Whether we will use effect or we will use possible effect, that depends on why we are qualifying. Are we qualifying because of availability of audit evidence, or are we qualifying because of non-availability of audit evidence? So except or subject to certain items, financial statements give a true and fair view. Or even you can say except or subject to certain items, financial statements present fairly in all material respects. When we are giving unmodified opinion, also two options are given. No, the same two options here also will be given. Except or subject to certain items, financial statements either give a true and fair view, or you can use the phrase except or subject to certain items, financial statements present fairly in all material respects. Clear? So when you find this phrase except or subject to certain items, financial statements give true and fair view, or financial statements present fairly in all material respects, so that we call it as qualified opinion. Now let us come to the adverse opinion. In how many circumstances adverse opinion will be given? Adverse opinion will be given only in one case. So adverse opinion will be given when we have a sufficient and appropriate audit evidence. We must have sufficient and appropriate audit evidence. And on the basis of the evidence, I have concluded there is a misstatement. And the effect of the misstatement. The effect of the misstatement. I'm using the pay attention to terminology. I'm saying effect. I'm not using the phrase possible effect. Why I'm not using the phrase possible effect? I have evidence. I can conclude. Why I need to use the term possible effect there? So I have sufficient and appropriate audit evidence. On the basis of that evidence, I have concluded financial statements contain a misstatement, the effect of which is not just material, it is also pervasive. It is large enough to say the financial statements are completely wrong. Very big amount of misstatement I am having, and regarding that I have evidence also. Then I will give adverse opinion. Here also I have to use phrase. I have to use a specific phrase. Which phrase I have to use? I can directly say adverse means completely negative. I will say financial statements do not give true and fair view. Financial statements do not give true and fair view. Don't believe the financial statements only. They are completely wrong. This is not what exactly I use, but instead what I use, financial statements do not give true and fair view. This phrase I have to use. The moment you find this phrase, that opinion is a what kind of opinion? Adverse opinion. So tell me, in how many circumstances adverse opinion will be given? One. What is that circumstance? Sufficient and appropriate audit evidence is available, and I have concluded that financial statements contain a misstatement, and the effect of that misstatement is material and also pervasive. So then you are required to give an adverse opinion. And how to identify the adverse opinion? You will say financial statements do not give true and fair view, or even you can say financial statements do not present fairly in all material respects. Understood? Next, coming to the last case, disclaimer of opinion. The name itself says disclaiming. What do you mean by disclaiming? Stopping yourself from doing something. Disclaimer of opinion. You are stopping yourself from expressing the opinion. So when you will give disclaimer of opinion, Here you will give disclaimer of opinion when you don't have sufficient and appropriate audit evidence. Sufficient and appropriate audit evidence you don't have. And the matters regarding which sufficient and appropriate audit evidence is not available. Should I say effect here or possible effect? Possible effect. The matters regarding which I am unable to obtain audit evidence, the possible effect of that misstatement is not just a material, it is also pervasive. Basically, if I put it in the layman terms, I am not able to obtain evidence regarding multiple terms. If all that things even go wrong, I don't know because I don't have evidence. I'm assuming if that things goes wrong, the possible effect, the overall effect is not just a material, it is going to be pervasive also. So in those circumstances, I will give disclaimer of opinion. But what phrase I have to use here? We do not express an opinion on the financial statements. We do not express an opinion. We are unable to express the opinion because we don't have sufficient and appropriate audit evidence only in that case. We are unable to obtain evidence regarding multiple things. Why we will express the opinion? We will say we are unable to express the opinion. Saying you are not able to express an opinion is also a kind of opinion which we call it as disclaimer of opinion. Able to understand? So saying we are unable to express an opinion, not giving an opinion is also a kind of opinion, which we call it as disclaimer of opinion. Understood? So these are the three cases: qualified, adverse, disclaimer. All the three are modified. All the three are negative, but severity is changing. Like if you see qualified opinion, it is a little negative, majorly positive, but a little negative comment is attached, except or subject to certain items. Adverse and disclaimer, if you take, those are extremely negative. In adverse, I am telling don't believe the financial statements, those are not giving true and fair view. In disclaimer, I am telling I am not at all able to express my opinion also. Both are extreme. Whereas qualified is what? Little negative, not completely negative, not completely positive, it is little negative with major positive comment. Understood? So these are all different kinds of qualified opinion. So now one more thing here. See, I told qualified, adverse, disclaimer. All the three are different types of modified opinion, but we did not define the term modified opinion. We defined what is a qualified opinion. We defined what is an adverse opinion. We defined what is a disclaimer of opinion. But all these three are nothing but different types of modified opinion. We did not define modified opinion. Now we should define modified opinion in such a way that under its definition, all the three are getting covered. We should define modified opinion in such a manner that under its definition, qualified is also getting covered, adverse is also getting covered, disclaimer is also getting covered. So how that definition can be done? So they have given one simple definition. So what they have given is modified opinion will be given in two circumstances. Modified opinion will be given in how many circumstances? Two. So you have sufficient and appropriate audit evidence. On the basis of that, you have concluded that financial statements contains a material misstatement. You have obtained sufficient and appropriate audit evidence. On the basis of that, you have concluded that financial statements contain a material misstatement. Or you are unable to obtain sufficient and appropriate audit evidence to conclude whether the financial statements contain a material misstatement or not. You are unable to obtain sufficient and appropriate audit evidence to conclude whether the financial statements contain a material misstatement or not. So in 2 points, they have defined the term modified opinion. You have obtained sufficient and appropriate audit evidence, but you are on the basis of that you have concluded there is a misstatement, there is a material misstatement. Second one, you are unable to obtain sufficient and appropriate audit evidence and you are unable to comment whether there is a material misstatement or not. Now, if you tell me in the first point, which kinds of modified opinion will get covered? You have a sufficient and appropriate audit evidence. On the basis of that, you concluded financial statements contain a material misstatement. Which kind of modification? Very good. Here there will be qualified and also adverse. If the misstatement is only material but not pervasive, then we give qualified. If the misstatement is material and also pervasive, then we give adverse. Next, second one. Come to the second case. If you are unable to obtain sufficient and appropriate audit evidence to conclude whether the financial statements are free from material misstatements or not, here which kind of modification will be relevant? Once again, either a qualified or a disclaimer. This is also one blunder which most of the students will do. The moment you find unable to obtain audit evidence, you will go and mark a disclaimer directly. No. When you are unable to obtain audit evidence, there are two options available, either a qualified opinion or a disclaimer of opinion. If the possible effect is only material but not pervasive, why to give disclaimer? Why to go to extreme? You can give qualified opinion. No. So when you don't have a audit evidence and the possible effect is not just material but also pervasive, then only go for the extreme of giving a disclaimer. Understood? Clear and comfortable, everybody? So now you tell me, in the definition of modified opinion, have we covered all the three kinds? So we have covered qualified also, adverse also, disclaimer. See, in case if they are asking a question, on what factors you will decide which kind of modified opinion you will give? What are the factors which affect the auditor's decision regarding the type of modified opinion? Only two factors. The nature of the circumstance giving rise to the modification, that is whether evidence is available or the evidence is not available. Number two, pervasiveness of the misstatement. These are the only two factors. Depending on these two factors, we can always decide which kind of modified opinion is appropriate. So only two factors. What are they? Number one, nature of the circumstance giving rise to the modification. When I say nature of the circumstance, whether it is a availability of audit evidence or non-availability of audit evidence. Second one, pervasiveness of the misstatement. These two factors, if we have the information, we can always judge whether an opinion is a qualified, adverse or disclaimer. Understood? Clear and comfortable? So opinion paragraph, are we done? Why we have discussed different types of opinion? Basically we have started to discuss the contents of the audit report in SA 700. There we have seen title, addressee, opinion. As a part of that opinion discussion, we have covered different types of opinion, unmodified, modified. In the modified, three types. But the discussion is not yet over regarding the opinion paragraph. If you pay close attention, I told in the opinion paragraph, two sub paragraphs are there. Second subparagraph actually talks about what opinion you are expressing. But apart from that, there is a first paragraph also. So in that first paragraph, you will find this everywhere. Every audit report you open, in the opinion paragraph, you will find two subparagraphs. In the second subparagraph, they always talk about opinion, but in the first paragraph, they will tell you some information. So what is that information they are trying to convey in the first paragraph? So SA 700 says in the opinion paragraph, along with the opinion you are expressing, extra 5 things must be stated. How many? 5 things must be stated in the opinion paragraph along with the opinion which you are expressing. So what are that 5 things? Number 1, identify the entity whose financial statements have been audited. Basically mention the name of the entity whose financial statements you have audited. Number 2, state that the financial statements have been audited. You have to mention one line, we have audited the financial statements. Number 3, identify the title of each statement comprising the financial statement. Basically financial statements comprise balance sheet, P&L, statement of changes in equity. So mention that title. And you should give a reference to notes including summary of significant accounting policies. You should say that the financial statements contain even notes also which contains a description of significant accounting policies. And then finally specify the date and period covered by each financial statement comprising the financial statements. So basically for which period related financial statements you have conducted the audit, that period also you have to mention. So basically 5 things in addition to opinion. In your opinion paragraph you should state 5 things. What are that 5 things? Name of the entity whose let us put it in the simple terms. Name of the entity whose financial statements you are auditing. State the fact that you have audited the financial statements. Title of components of the financial statements. Reference to notes including significant accounting policies. Reference to date and period covered by the financial statements. These are 5 references you have to give. Like if you read this paragraph here, you will be able to find all the 5 things getting covered here. Like if you read this here, we have audited the accompanying standalone financial statements of Reliance Industries Limited. 2 points are covered here. They are mentioning the name of the entity whose financial statements they have audited. They are also stating the fact that they have audited the financial statements, which includes joint operations, which comprises balance sheet, statement of P&L, statement of other comprehensive income, cash flow statement, statement of changes in equity, title of the components of the financial statements, and notes to the notes to the standalone financial statements which contain summary of significant accounting policies. Reference to notes and significant accounting policies, and even if you see here, date and period covered by the financial statements. Able to understand? Clear and comfortable, everyone? So all these 5 things must be there in each and every auditor's report in the opinion paragraph. Now one more thing before we proceed to the next content. See, I was saying we will decide which kind of modified opinion will be appropriate on the basis of circumstance giving rise to the modification and pervasiveness. I told general meaning of the term pervasive. What did I say? Very large misstatement which is large enough to say entire financial statements are wrong. But there is a technical definition. given to the pervasive misstatement. So they have told a misstatement can be considered as pervasive in any of the three cases. If the misstatement is not confined to specific elements, that means misstatement is not just restricted to one item, misstatement is spread across so many items. Then we can call that collective misstatements as what? Pervasive. So number one, first case, when we can call a misstatement as pervasive? Come on, repeat the exact terms. It is not confined to specific elements or items of the financial statements. Number two, sometimes it will be confined to specific elements or accounts, but they represent a substantial portion of the financial statements. Come on, second case, not confined to specific elements, but it represents substantial portion of the financial statements. Like say for example, we have one company which is having a total assets of 100 cr. In that, fixed assets are amounting to 70 cr. In that fixed assets only misstatement is there, and the amount of misstatement is 60 crore rupees. Pervasive or not pervasive? It is confined to only one item, but it is representing what? Substantial portion of the financial statements. So two cases. Number one, if it is not confined to specific elements or accounts of the financial statements. Number two, even though if it is confined, it is representing a substantial portion. Number three, in relation to those disclosures which are fundamental to users' understanding of the financial statements. If the management has done any mistake in the notes to accounts, in any explanation, in any disclosure, and if that disclosure is very much fundamental to users' understanding, in that disclosure only if they have made a mistake, that also we call it as pervasive. Like I told you in the morning session, when I say misstatement, we always imagine it from numbers. No, even pervasive misstatement, which require us to give adverse or disclaimer, even that misstatements also can happen in notes to accounts. Like management has given a wrong disclosure regarding going concern. That is very fundamental to users' understanding. If the management has made something wrong in the going concern related disclosure, I will give, if I have evidence, I will give adverse opinion. If I don't have evidence, I will give disclaimer of opinion. So even pervasive misstatement, not just a normal misstatement, even pervasive misstatement also can happen in a notes to account. Clear? Understood everybody? So we have covered with this opinion related discussion, we have completed successfully. Now, what is the next content in the auditor's report? Basis for opinion paragraph. So now you have given your opinion. You have stated your opinion, whether it is unmodified, modified, whatever it is, you have stated your opinion in the opinion paragraph. Why anybody should believe your opinion? Why anybody should believe your opinion? If you let them know on what basis you have given your opinion, what and all things you have done to express this opinion, then they will be able to understand it. So that's why what they have told us, first to give your opinion, along with the opinion, you also give what is the basis for your opinion. And here also they did not give any freedom to us. They have told what exactly needs to be mentioned in the basis for opinion paragraph. In the basis for opinion paragraph, 4 things should come. How many? 4 things should come in the basis for opinion paragraph. So what are that 4 things which should come in the basis for opinion paragraph? Number one, you have to state that the audit was conducted in accordance with standards on audit. Number two, you have to give a reference to the auditor's responsibility paragraph. Number three, you have to include a statement that you are complying with ethical requirements, including independence also. And finally, you should say that whether you have obtained sufficient and appropriate audit evidence. Clear? So 4 things. What are the 4 things which you must state in the basis for opinion paragraph? So you are required to state that you have conducted the audit as per standards on audit. Number two, give a reference to auditor's responsibility paragraph. Number three, talk about compliance with the ethical requirements and state that you have obtained sufficient and appropriate audit evidence. Understood? Comfortable? So if you look at the basis for opinion paragraph, you will be able to find all that 4 things converted into a paragraph format. So I'm not reading it, anyhow you can get it. But I need to explain few more things. If you give unmodified opinion, if you give unmodified opinion, your basis for opinion paragraph will contain only these 4 things. In case if you give modified opinion, in case if you give modified opinion, whether that could be qualified, whether that could be adverse, whether that could be disclaimed. In addition to these 4 things, you should also mention the reason for which you have given the modification. Be it qualified, be it adverse, be it disclaimer, For what reasons has caused you to give that modified opinion. If you have given qualified, because of what reasons you have given qualified. If you have given adverse, because of what reasons you have given adverse. If you have given disclaimer, because of what reasons you have given disclaimer. So that reason for giving that modified opinion, that reasons are also required to be stated where in the basis for opinion paragraph. So if you are giving a modified opinion, in addition to these four things must, no matter whatever you give, these four things must. That reason for giving a modified opinion is extra. Clear? And one more thing also they have stated, if you give unmodified opinion, the title of the opinion paragraph will just remain opinion. The title of basis for opinion will just remain basis for opinion. But in case if you give qualified, adverse or disclaimer, the titles of the opinion and basis for opinion paragraphs also should change. How they have to change? If you give qualified opinion, change it to qualified opinion. Paragraph heading should be qualified opinion. Basis for opinion will become basis for qualified opinion. If you give adverse opinion, opinion paragraph title will change to adverse opinion. Basis for opinion will change to basis for adverse opinion, and the same logic will apply for disclaimer also. Clear? And one more thing, sir, you are telling I am required to give the reasons. I am required to give the reasons why I am giving a qualified, adverse or disclaimer. So if I am giving a mistake, if I am giving a modified opinion, if I am giving a qualified, adverse or disclaimer because of a numeric figure, because of a quantitative misstatement, some amount has been wrongly calculated or some quantitative misstatement they have done. So then what the standard says is, when you are explaining the reason, you should be able to quantify. That means what is the exact amount of misstatement or approximate amount of misstatement which has taken place. That amount also you are required to mention. Don't just say so and so mistake has happened, that's why I have given a modified opinion. In sales, mistake has happened, I have given a modified opinion. Don't say that. You have to say quantification, how much amount of misstatement has happened, that you have to say. In case if you are not able to quantify, in some reasons you will not be able to quantify. If you are not able to quantify, mention the fact that you are not able to quantify. In case a misstatement is regarding narrative disclosure, as I have told, misstatement might not always be related to figures. It could be related to narrative disclosure. Then you have to explain in your basis for opinion what mistake they have done, what is that disclosure regarding which mistake they have done, and if permission is there, if there is no prohibition in law or regulation, even include what's the correct disclosure, not in the financial statements. In your audit report, you mention. In case if you are giving a modified opinion because of a narrative disclosure, so you should mention in the basis for opinion paragraph regarding which narrative disclosure misstatement has taken place and what misstatement they have done and what is the correct narrative disclosure. That also you add it if there is no prohibition from law or regulation. In case if you are modifying the opinion because of non-disclosure, see, many things I have told. Guys, are you able to relate? So what I have told, I'm telling reason. When you are giving a modified opinion, what you have to explain in the basis for opinion paragraph. If it is quantitative, we should be able to quantify. If we are unable to quantify, what we should do? Mention the fact. Next, sometime misstatement could be relating to narrative disclosure, wrongly disclosing a notes to account. So then what we should do? We should explain that we are giving a modified opinion because of narrative disclosure. What is a misstatement in the narrative disclosure, that you explain. And if there is no prohibition on you, mention what is the correct disclosure also. Sometimes you might give a modified opinion because of non-disclosure. What do you mean by non-disclosure? The management did not explain. They missed some disclosure in the financial statements. They should have explained about something in the notes to accounts, but they did not explain it. For that also I will give a modified opinion or not. If it is a material and if it is material or metal and pervasive, I will give modified opinion. So if you are giving a modified opinion because of non-disclosure, then also state the fact in the basis for opinion paragraph that you are giving a modified opinion because of non-disclosure. And if there is no prohibition from law or regulation, you add what is that disclosure in your basis for opinion paragraph. Understood? Clear and comfortable, everybody? So all these things you are required to do. And when we will do all this? Whenever there is a modified opinion. Understood? If there is no modified opinion, if there is unmodified opinion, then we can chill out. No need to give everything. Just mention that paragraph which contains 4 matters. That's all. Our responsibility will come to an end. Understood? So with this, how many contents we have completed? 4 contents we are done. What are the 4 contents we have completed? Title, addressee, auditor's opinion, and basis for opinion. They say something about the going concern. This going concern related discussion I will try to explain in the 570. When we take up the 500 series of the standards, there I will try to explain what is this 570 dealing about. Then we have key audit matters. This also we will have a separate discussion in SA 701. In SA 701 we will have a separate discussion. Some other information is also required to be there, no? 7. Other information SA 720. I think something is missing here. Other matter paragraph and emphasis of matter paragraph. Okay, that got missed here. So anyhow, I will add it. So it should contain emphasis of matter paragraph or other matter paragraph. So what is this emphasis of matter? What is this other matter paragraph? This we will try to explain in SA 706. We have other information. Yes, this is regarding SA 720, not a forming part of our syllabus. SA 720 is not there as part of CA into, that is there at the CA final level. This you can ignore. So all this we will have a separate discussion. Going concern related paragraph, key audit matter paragraph, emphasis of matter and other matter paragraph. Going concern paragraph we will not discuss in this chapter at all. That we will try to discuss when we take up the standards on audit. But key audit matter, once we complete all this SS 700 and 705, see basically whatever modified opinion and all we have discussed, no, all that content is from SA 705. Different types of modified opinion, meaning of the term pervasive, this is all from SA 705. So once we complete 700 and 705 fully, then we will take up 701, complete the key audit matter. After that we will take up 706, complete emphasis of matter and other matter paragraph. Then next thing which we will take up for discussion is what? Responsibilities for the financial statements of the management. So who is responsible for preparation of financial statements? Management. So in addition to that, they will have a few extra responsibilities also. So I have to explain in my audit report a paragraph called responsibilities of the management for the financial statements. In that, I have to mention what are their responsibilities. So what exactly I have to mention here? What exactly I have to mention here? Not something which is there in the engagement letter. In engagement letter, their responsibilities are different. There, what we have seen, what are the responsibilities? Preparation of the financial statements, implementation of internal controls to provide the auditor with access to information, explanation, and unrestricted access to people. So this, the management responsibility paragraph will look like this in the engagement letter, but in the audit report, management responsibility paragraph looks little different. So what will be there in the audit report under the responsibilities of management paragraph is, so you have to add a separate section with the heading responsibilities of management for the financial statements. And in that matter, in that paragraph, you have to state three things. How many? Three. Number one, you have to state that the management is responsible for preparing the financial statements, that too in accordance with applicable financial reporting framework, and they're also responsible for implementation of internal controls to prevent the frauds and errors. So this is the first responsibility you have to state. What is that? Preparation of financial statements and the design and implementation of internal controls. Number two, you should state in the responsibilities of management paragraph that management is responsible for making an assessment regarding going concern. Whether the entity will continue for the foreseeable future or not, whether going concern assumption is valid or invalid. That assessment who has to do? Management has to assess an entity's ability regarding going concern. Then what auditor will do? Verify whether that assessment is correct or not. So whatever it is a responsibility of the management to assess the ability of the entity regarding going concern. Mention that in the auditor's report. Along with that, you should also identify who is having the oversight of the financial reporting process. What do you mean by financial reporting? Nothing but accounting, the process of preparation and presentation of financial statements. Basically, who is looking after that financial reporting process? Who is having supervision over that financial reporting process? Like basically, if there is an audit committee will have control over that financial reporting process. If any such audit committee is there, just write there, audit committee is responsible for oversight of the financial reporting process. If there is no audit committee, generally board of directors only will oversee the financial reporting process. In that case, mention it. Board of directors itself oversee the financial reporting process. So these are three things that must come in the management responsibility paragraph. Tell me what are the three things. Number one, preparation of financial statements and implementation of internal control. Number two, assessing the entity's ability to continue as a going concern. Number three, who is having oversight of the financial reporting process. Clear? So with that, responsibilities of the management paragraph will come to an end. So after that, we have one more paragraph, which is auditor's responsibility for the audit of the financial statements. Now we have to tell all our problems here. We have so many problems, no, so many responsibilities we have. So you have to start listing out all your responsibilities. So these are the responsibilities. Like you have to say that what is your objective. What is my objective? To obtain reasonable assurance whether financial statements are free from material misstatements, and also explain what is the meaning of reasonable assurance. Like reasonable assurance is a high level of assurance but not absolute assurance. And mention that we are worried about the misstatements. Misstatements may arise from fraud or error, but we are not worried about each and every misstatement. We are worried only about material misstatements. When you consider a misstatement as material, if it could influence the decision of users of the financial statements, so mention that also. Next, after that, you should say that you are required to exercise professional judgment throughout the audit, and along with that you have to maintain professional skepticism. That is also one more responsibility of you. Then you have to say that you are responsible for identifying and assessing the risk of material misstatement. So what is this risk of material misstatement and all, we will see it in the risk assessment procedures chapter. Then you are responsible for obtaining an understanding of internal control, scope of audit, checking the reliability of source data. In order to check the reliability of source data, you have to study accounting system and internal control system. This also we have covered. So mention once again, this is also my responsibility to study the internal controls, to evaluate appropriateness of accounting policies, whether accounting policies are selected properly and applied consistently. That also you have to check. Appropriateness of management's use of the going concern basis of accounting. We have told in the management responsibility paragraph, they are responsible for making an assessment regarding going concern. But as an auditor, what responsibility you have? Whatever assessment management has done regarding going concern, whether it is valid or not, and also whether financial statements are prepared in accordance with a fair presentation framework or not. In that case, you are required to mention whether whether they really achieve a fair presentation or not. And also this is SS600. Basically, if you are a conducting audit of consolidated financial statements, you will also use the work of those people who have conducted the audit of the standalone financial statements. If you are conducting audit, if you are conducting audit of consolidated financial statements, in the consolidated financial statements, holding company information will be there, subsidiary companies information also will be there. In those cases, you will use the work of that standalone auditors, standalone companies auditors. That is governed by SS 600. Once again, detailed explanation applicable at the CA final level, not at the CA inter level. In CA inter, we have a small part of SS 600 applicable, so that we will anyhow cover later. Not just that, with here auditor's responsibility is not coming to an end. Our headache is not at over. We have still more. So what else we have? The auditor has to fulfill some communication requirements with those charged with garnets, SA 260 and SA 265. You have some communication requirements with the management and those charged with garnets. Tell that also. Boss, my responsibility is not just this. I have to fulfill some communication requirements with those charged with garnets, with management. And also, in case of listed entities, in case if you are conducting audit of a listed entity, the auditor provides those charged with garnets with a statement that audit has complied with ethical requirements. In case if you are conducting audit of a listed entity, it is a mandatory responsibility. You have to give a statement that you have complied with ethical requirements. And not just that, whatever key audit matters are there, even those key audit matters also you will include it. You have a responsibility to include key audit matters also in the auditor's report. In case of a specified companies, that also we'll talk about it later, but that is also anyhow your responsibility. Understood? Clear and comfortable, everyone? So all these are responsibilities of auditor. And specifically SS7, here one important point. We have seen so many things. Don't worry, they will not ask you to write about all the auditor's responsibilities. But what they will ask a question is, in case if you are giving a disclaimer of opinion, in case if you are giving a disclaimer of opinion, your auditor's responsibility paragraph need not be this much detailed. In case if you are giving what? Disclaimer, not in all other cases. If you are giving unmodified, qualified, adverse, all these things must come. But only when you give disclaimer of opinion, your auditor's responsibility paragraph will not be this detailed. It will be limited. Very limited information should come in the auditor's responsibility paragraph. So what information will come if I am giving a disclaimer of opinion? See here. Description of auditor's responsibility for the audit of the financial statements when the auditor disclaims an opinion. If you are giving a disclaimer of opinion, your auditor's responsibility paragraph should undergo a change. Good change only, because our work will get reduced. So we are required to give only limited information. What limited information we have to give? So if you see here, when the auditor disclaims an opinion on the financial statements due to an inability to obtain sufficient and appropriate audit evidence, the auditor shall amend. He should make some changes to auditor's responsibilities as required by SA 700 to include only the following. If you are giving a disclaimer of opinion, three things they are saying. If these 3 things, if you mention in the auditor's responsibility paragraph, that will be enough. All this list, whatever we have read now, all that you are not required to mention. So what you are supposed to do, is only 3 things you state in your auditor responsibility paragraph. What are they? A statement that auditor's responsibility is to conduct an audit in accordance with standards on audit. A statement that because of the matters explained in the basis for disclaimer of opinion, the auditor was not able to obtain sufficient and appropriate audit evidence. Your responsibility is to obtain sufficient and appropriate audit evidence. But because we are giving a disclaimer, why we are giving a disclaimer of opinion, that we will explain in basis for opinion paragraph. You say that some matters we have already explained in the basis for opinion. For those matters we are unable to obtain sufficient and appropriate audit evidence. Mention it. Not just that, the statement about auditor's independence and other ethical responsibilities. Just 3 things you add. Where you have to add this information? In the basis for, in the auditor's responsibilities paragraph. That long list, whatever we have read now, not required. 3 things. What should be that 3 things? Number 1, you have conducted the audit as per standards on audit. Some matters are explained in the basis for opinion paragraph, regarding which, because of which we are unable to obtain sufficient and appropriate audit evidence, and also a statement that you complied with your independence and ethical requirements. Understood? Then one more thing is also there. One more thing. Here, this point. When the auditor disclaims an opinion, some changes you are required to do to the basis for opinion paragraph also. See, in the basis for opinion paragraph, anyhow we will give reason. We will mandatorily state 4 things, no, in the basis for opinion paragraph. What are they? That you have conducted the audit as per standards on audit. Number 2, you have give a reference to auditor's responsibility paragraph. Number 3, you have complied with the ethical requirements and independence. Number 4, you have obtained sufficient and appropriate audit evidence. If you give disclaimer of opinion, which point should undergo change? Definitely that you have obtained sufficient and appropriate audit evidence. You should not say that, because you are unable to obtain sufficient and appropriate audit evidence. One more change also we can make. See, anyhow, auditor's responsibility we are shrinking, no. Only 3 points we are adding. So there is no logic in giving reference to auditor's responsibility paragraph. Clear? So that's what they say here. When the auditor disclaims an opinion on the financial statements, the auditor's report shall not include. They are talking about that 4 mandatory things. In that 2 is not required. One is auditor's responsibility paragraph. You need not give reference. Why you need not give reference? Because anyhow there we are saying we are not able to obtain sufficient and appropriate audit evidence. And frankly speaking, we are not giving any of the responsibilities. Basic things only we are saying. 3 things only we are saying. So that's why no need to refer to auditor's responsibility. And one more thing, you will not be able to say that you have obtained sufficient and appropriate audit evidence. Why? Because we are giving disclaimer. Why we are giving disclaimer? Since we are unable to obtain sufficient and appropriate audit evidence. Comfortable till here? Able to understand? Right. Perfect. Now, let us come back. Okay, so management responsibilities we are done. Auditor's responsibilities also we are done. So if we proceed further, location. This is also one important point which has been tested in the recent examinations. Location of the description of auditor's responsibility. See, till now I have told many responsibilities, no, where you have to describe all that responsibilities. Number 1, you can do it in the audit report itself. Whatever heading you are giving, in that, under that heading only you can list out all the responsibilities. Or else some people will feel that because of writing all the responsibilities, my report is looking lengthy. Then what you can do is you can add an annexure. You can add one annexure to the audit report. In that annexure, like we do for CARO also same thing. If you would have seen the practical audit reports, CARO they don't include in the audit report. What they will do is they will add an annexure. In that annexure, they will give they will report on all the 21 points. But at that respective place, a report on other legal and regulatory requirements, which we will talk in a short while, there they will give reference. Refer annexure number 2, annexure number 1. So if you feel of that nature, if I include all the responsibilities in the main audit report, the report is looking lengthy. What you can do is you can add an annexure. That annexure link, you can give it in the auditor's responsibility paragraph. They have given one more option. Sometimes your responsibilities are already stated in some law or regulation. Like in the standards, already the reference has already all your responsibilities are given. So what you can do is, instead of writing all these responsibilities, even you can write under that auditor responsibility paragraph, go and refer to respective standard or respective section where our responsibilities are there. Understood. So this is what regarding location of the description of auditor's responsibility. So they gave us three options to choose from. So if you see here, you can include it within the body of auditor's report. So majority of the people will do this only. Or what you can do, you can add an appendix or annexure, whatever you want, you can say within an appendix to the auditor's report, in which case the auditor's report shall include a reference by a specific reference within the auditor's report to a location of such a description on a website of an appropriate authority where law, regulator, or national auditing standards expressly permit the auditor to do so. Basically, I told references to sections and all. Here they are telling website. In case if you get a permission, already your responsibilities are uploaded in some website, you can give reference to that website. Like for example, say my responsibilities are already listed at ICI. So if I have a permission, instead of writing all my responsibilities, I can say our responsibilities are given under ICI. You can click this link to know more. That link you can add there. Understood? Clear everyone? So this is what regarding description of location of description of auditor's responsibilities. Now coming to the next content. So what is the next content we have? Other reporting responsibilities. So what are the other reporting responsibilities? See, till now, whatever we have seen, that basis for opinion, responsibility, management responsibility, auditor's responsibility, all these are also nothing but reporting responsibilities only. So these are all reporting requirements as per standards. But apart from the standards on audit, the governing law of the client. What? The governing law of the client. Like for example, if I'm conducting audit of a company, the Companies Act 2013 becomes a governing law. That governing law also might put some extra reporting requirements on the auditor. Yes or no? Like I told, in case of Companies Act has given some reporting requirements on the auditor under 143, subsection 1, 3, 11, and 12. So that also you are required to mention in your audit report. Sir, where you will mention? You can use this paragraph, other reporting responsibilities. So apart from the standards on audit, if there are any other reporting requirements on the auditor, like as per Companies Act or as per Banking Regulation Act, as per IRDA rules and regulations, depending on the client, if you have extra reporting requirements, that you can come and report it under other responsibilities paragraph. And after that, after all that, just like that, take a printout and give the report? No. You should even sign that audit report. So when you see the digital copies, you will not be able to find any signature there. Don't come and ask me, sir, there is no signature. Those are all digitally signed documents. So whatever it is, you have to include your signature. So now how you have to sign it? If an individual person has been appointed as an auditor, the individual person will sign in his personal name. I have an individual. The individual has been appointed as an auditor. I will sign in my personal name. And below my signature, I will mention my membership number. If a firm is getting appointed as an auditor, then one of the partner on behalf of the firm, he will sign the auditor's report. So that partner will sign in his personal name. Along with that, he will also mention the firm's name, and below his signature, he will mention his membership number, and he should also mention the firm's registration number. Clear? So all these things has to be clearly specified. And then finally, the place of signature. What do you mean by place of signature? Where the order is signing. So you will write the door numbers, line, address, nearby landmark, and all you will write. No. If you write the city, that will be enough. So you have to mention the place of signature, and finally the date on which you are signing the auditor's report. And you have to be pretty careful here. The date of auditor's report should be later than the date of obtaining audit evidence. It should not be prior to that. If you date your audit report prior to the date of obtaining audit evidence, you are displaying yourself as a bigger fool there, which we should not be. Yes or no? So why? What is the sequence actually? Auditor gets appointed, he will perform audit procedures, he will get audit evidence, then he will express opinion. So that's why whatever audit report you are giving, that should be dated either on or after the date of obtaining audit evidence, but not later, but not earlier, sorry. Understood? So this is what regarding the date of the auditor's report. With this, we have completed all the contents of the auditor's report, along with some special things also we have covered. Then if you come back to SA 705, we have one small thing left out there, which is important from the examination perspective. Consequences of inability to, no, one, UDIN we have missed out. So UDIN also you have to mention, as we all are aware, today the chartered accountant signature will not be valid unless you have a unique document identification number. So at any point of time you are signing a document, after you have signed or at the time of signing, you have to log into the Udin portal, enter your username, enter your password, and after that give the information regarding the document which you are signing, enter the amounts and all. Then a unique number will be sent to your email ID and mobile address. That Udin number you have to mention. If you don't mention that unique document identification number, your audit report will not have any kind of validity. Clear? Able to understand? Shall we proceed further? Right. In SS 705, if you come back, this one. Consequences of inability to obtain sufficient and appropriate audit evidence due to management imposed limitation after the auditor has accepted the engagement. See, this will sound very much similar to request of the management to change the terms after you have accepted the audit. We have seen in SA 210, no, little bit extended version. To that only little bit extension we add. See, at the time when we are discussing SA 210, at that point of time we are not aware of all these different kinds of opinion and all. So but now we got to know about different kinds of opinion, no. So now since we got the different kinds of opinion, that discussion only, if the management is asking you to change the terms of the engagement after you have accepted the audit, what you will do, along with incorporating these opinions, we will discuss one chart now. Okay, right. So if you are unable to obtain sufficient and appropriate audit evidence, why? Due to management imposed limitation after the auditor has accepted the engagement. At the time when you have accepted the engagement, client did not put any objection. He was saying okay for everything. But when I started doing the audit, the client is not letting me do my work. They are putting a restriction on me, because of which I am unable to obtain sufficient and appropriate audit evidence. Then what I should do? First, behave like a gentleman. First, what you should do? Behave like a gentleman. Don't show your rowdyism and all that. So behave like a gentleman. What you should do? What does a gentleman do? He will go and request, sir, please remove the limitation. Let me do my job. So please, why you are putting a restriction on me? Please remove that limitation. Let me do my job. As I've already told, what majority of the auditors will do? So you can do sweet. You can give it something like a sweet warning also there. So how you can give the sweet warning? Sir, if you don't permit me, I am requesting you to please remove the limitation. If you don't remove the limitation, I might be required to give wrong opinion. I might be required to give negative opinions and all, because of which you will go and sit in the jail. That will not happen, but just say it. So you will go and sit in the jail because of that. So something you give a sweet warning, and after you requested the management to make the changes to remove the limitation, 90% will agree. I have already told you, no, nobody wants to mess with us. If they mess with us, we'll make their life a mess. So that's why what most of the people will do is they will remove the limitation. So once they remove the limitation, what we should do? You should not do any extras there. You have to go and directly do the work, because they have removed the limitation now. So do your fulfill your responsibilities, complete the audit, give the opinion. But when the problem will arise, management refuses to remove the limitation. You are giving a sweet warning, in return you are getting a hard warning from the management. So they are trying to threaten you. So this will also happen in some cases. You are requesting the management to remove the limitation, but the management is saying, go get lost, we will not remove any limitation. Then what we should do? See, if the management is not removing the limitation, ask those charged with governance. Top level management. Above the management, higher level of authority, if it exists, go to those charged with governance and say, sir, your management is misbehaving. They are not letting me do my work. Please, you at least remove the limitation. Or if there is no higher level of authority, what you should do is try to perform some alternative audit procedures. Okay, management is putting a limitation. Can I do anything alternatively to get my required audit evidence? So first you explore that opportunity. No, there is no, those charged with governance, you went and communicated with them. Even they are also helpless. They are also not able to remove the limitation. You thought of performing alternative audit procedures. You are unable to think of any alternative procedures. Only way is management only should remove the limitation. So if that is the case, what you should do? So here what they have told is, in the previous case, what we have told, directly withdraw we have told. In SA 210, in the same case, if the management is not permitting you to continue the audit as per original terms, what did we say? Withdraw we have said. Now they will filter the information. They will add one more layer here. What one more layer here they add is, you are unable to obtain audit evidence, no? Determine what is the possible effect of that. Determine what is the possible effect of that. If the possible effect is only material but not pervasive. Don't take an extreme step of withdrawal. What you do is continue the audit, give a qualified opinion. In case if the possible effect is material and also pervasive, then first option should be withdraw. First option should be withdraw. In some cases, withdrawal will not be permitted. Withdrawal will not be permissible. Or see, I will tell you why it will not be practicable to withdraw from the engagement. See, you have already done 70 to 80% of the work. Now, if you withdraw from the audit, client will not give you audit fees. Client will not give you audit fees. That can also be a practical ground. See, they did not say what exactly is the meaning of impracticability. It depends on the facts and circumstances. So if you feel that withdrawal from the engagement is not practicable, then what you should do? Continue the engagement and give a disclaimer of the opinion. What you should do? Continue the engagement and give a disclaimer of opinion. If you are an auditor, what you will do? If I am an auditor, what I will do? I will not withdraw. I will find every opportunity to call it as impracticable. Okay. So I will continue the engagement. Give a disclaimer of opinion. Get the fees. Why I should leave the fees here? By unnecessarily withdrawing? Yes or no? So, but whatever it is, if you came to know if the possible effect is material and also pervasive, first option should be what? To withdraw. In some cases, withdrawal from the engagement is not practicable. Then what we should do? Then we should give a disclaimer of opinion. Just one layer they have added. In SA 210, we have told directly if the management does not permit you to carry out the audit as per original terms. Directly we told withdraw. Now we are adding just one more layer. So before you take that decision, before you go to that extreme step of withdrawal, just to determine what is the possible effect. If the possible effect is only material but not pervasive, give a qualification, give a qualified opinion. If the possible effect is material and also pervasive, give a first option should be to withdraw. If withdrawal is not practicable, then you give a disclaimer. Understood? Clear and comfortable, everybody, right? So this is what the major content from SA 700 and SA 705. Now, so 700 and one more thing. In case if you want to give modified opinion, in SA 705, one more small point is that if you want to give modified opinion, when I say modified, it could also be qualified adverse disclaimer. So whenever you want to give any of this kind of modification, better go and communicate with those charged with gun. Not better, mandatory. You have to communicate with those charged with governance and then only give a modified opinion. That means am I required to take the permission from them? If I go to the management and say, sir, I want to give a modified opinion, management says, no, don't give. Should I stop? No. So they are not asking you to get the permission. They are just asking you to intimate, communicate with them. There is a reason behind that communication also. Why the management, why the standard has asked you to give communicators. So might be the objective behind here is, or the objective behind this is, the management might give you extra information for explanation in the basis for opinion paragraph. You can give much more better presentation for the basis for opinion paragraph. So they will give you extra information, but it is not at all a valid reason. No. Why they will blame themselves here? Sir, we have done the mistake at this point also. Will you say no? So, but still, the management might just they will tell their point of view. There is a misstatement. Sometimes there could be a genuine reason also. So might be you are giving a qualified, but in the comments you will, in the basis for opinion, you will politely give a remark. So that's why they are asking you to communicate with those charged with guidance. But once again, don't mistake it as permission. It is just what? Communication. Clear? Able to understand? So this is what the major discussion from 700 and 705. So now what we will do is we will try to understand SA 701. We will try to understand, which is talking about key audit matters, communication of key audit matters in the auditor's report. So why these key audit matters have been introduced is very simple. See, today audit reports have all become similar. There is a lot of uniformity in the auditor's report, and the uniformity has gone to that level. If you take two audit reports which contains unmodified opinion, and if you keep both the audit reports side by side, everything will remain exactly copy pasted. Only few things will change. Name of the client will change, name of the auditor will change, date of signing will change, city where you are signing you will change. Apart from that, all the information is copy pasted information. So why we have achieved that level of uniformity? Because everybody is copying from the same source. So we have under SA 700 series, at the end of the SA 700 series, we have appendix. For each audit report, they have given a format. So if you give unmodified opinion, every auditor will go to SA 700. At the end, appendix will be there. He will copy the information from there and make the changes. What changes he will make? Name of the client, the name of the auditor, date and all he will change. So everybody started doing it. See, when we don't have uniformity, people started complaining, hey, people, you don't have uniformity, it is becoming difficult for us to do the comparison. So I say I brought the uniformity. Now, once again, they started complaining, your audit reports are all looking similar. What is the value addition by reading that report? What is the value addition? Unnecessarily, we are paying the audit fees for you. You are not giving value added audit reports only. Why we should read the audit report? Why we have to get our accounts audited? Now they started complaining. So I say has to do something. No matter whatever we do, the industry will feel jealousy on us, because they feel that our families and all are surviving on the fees whatever they give, right? So whatever it is, whatever we do, see, one genuine pain here, because with the auditor they have to share all their secret information. Once again, business and financial information they have to share. So would you like to share your binami transactions and black monies and all with anybody else? No. But with the chartered accountant, you become helpless. You become helpless. You have to share it. So nobody would like, they will always have that thing on the chartered accountant. So whatever we do, they have a problem. But our ICI, they have to take all the burden on their shoulders, do something to stop the complaints against us. So what ICI has done is, okay, let us do one thing. You are complaining all the audit reports are looking similar. No, we will add one more content in the auditor's report with the name key audit matters. So in the key audit matters, what we expect the auditors to do is, we have done the entire audit. No, from this entire audit, identify few matters which you feel it as most significant. Identify a few matters which you feel it as most significant. Explain about that matters, how you have tackled them. How you have tackled them. So why you are considering that matter as a significant matter? Why you felt that matter is a very significant? What reasons has led you to take that decision? And you are telling yourself it as a key audit matter, how you have dealt with that matter, what procedures you have performed. Like for example, I might be conducting audit of an IT company. For IT company, revenue recognition might be very significant. It takes a lot of time from the auditor's side to obtain audit evidence. So this auditor, what he should do is that revenue recognition, he should select it as a key audit matter. He should explain why he selected that particular matter as a key audit matter and how he has tackled it. What audit procedures auditor has performed to obtain audit evidence regarding that revenue recognition. Now, if you are conducting audit of Reliance, the same matter might not be a key audit matter. Why? Because it is not a IT company. For this Reliance Industries Limited, might be they have stock in the form of gases. They need to determine what is the value of the stock as on the balance sheet date. For that, auditor has to obtain evidence, and obtaining that evidence is very difficult. Reliance Industries Limited says they have one rig in ocean. Oil rig is there in the ocean. They say that at the oil rig, which is there in the center of the ocean, we have some 2000 liters of crude. So now auditor needs to obtain audit evidence really whether at that oil rig in the middle of the ocean, that too underneath that rig, they have 2000 liters of oil. So you need to obtain audit evidence for that. So that is a difficult matter for the auditor. So auditor felt that as significant. Now he can explain in the audit report that estimation of that oil reserves is a significant matter. How you have tackled it? What steps you have followed to obtain audit evidence regarding that reserves of the oil? So that you have to explain. So now if you see here, all other contents are going to look exactly copy pasted information, but key audit matters cannot be a copy pasted information. If key audit matters also looks copy pasted, exactly ditto copy paste information, if you are finding, one of the auditor is a fool there. One of the auditor is a fool there. Why? Because key audit matters, you have to do it from your own audit. And what is most significant, it changes from industry to industry, entity to entity, circumstance to circumstance, financial year to financial year. Yes or no? So that's why the management, that's why the standard has put this responsibility. A new standard they have brought, SA 701, where they told that the auditors are required to identify from the current year's audit, they have to identify a few matters which they feel it as most significant and explain about those matters in a paragraph called key audit matter paragraph, so that if any person reads the audit report, he will not have that feeling that I'm not getting any value addition. So the main purpose of communicating the key audit matters is to enhance the communicative value of auditor's report. Able to understand? Clear and comfortable, everybody? So the audit report, the key audit matters will look something like this. So if you see it here, right? So if you see, so we have the key audit matters here. They will pick up various matters as key audit matters, and they will say, yeah, here you have. So they will explain something, this matter, capitalization and useful life of tangible and intangible assets, that they have identified as a key audit matter. They will explain why they have considered this as a key audit matter and how they have addressed that matter. So if you could see here how the auditor addressed the key audit matter. So like this, a few matters they will identify and they will try to explain about it. So this will be a extra value addition. And one more thing I want you all to pay attention. Do you think if the auditor explains something in the key audit matter, is he giving any negative remark regarding it? Is he saying something negative about that particular area? Here, Reliance Industries Limited auditor has told some 5-6 matters as a key audit matter. 4 matters he has told it as a key audit matter. Is he giving a negative remark on any of this point? No. So just he is saying what is a significant matter, how he has dealt with that. No negative comment. So this is what the background behind the key audit matters. Now, if you start going through it, so definition of the key audit matter. The key audit matters are those matters that in the auditor's professional judgment were of most importance. That too in the audit of the financial statements of current period. From the current period audit only you have to select. You should not go to the prior years. For example, you are conducting audit of the year 24-25 and you want to explain something which you come across in the 23-24 audit as a key audit matter. Can you do that? No. Sir, if I don't have any key audit matter, nothing I feel it as significant, then what I should do? So then what you should do is, in case if you don't have any key audit matter, nothing you feel is as significant, then if you do a deeper reading of SA 701, in that case what you should do is you have to include a paragraph called key audit matter. In that you have to say there is no key audit matter. Okay, so if you don't have any key audit matter, that's what you are supposed to do. So you have to add one paragraph key audit matter, and in that you have to say there is a no key audit matter, but you cannot bring the key audit matters from the previous years. So what is the purpose of the key audit matter? To enhance the communicative value of auditor's report, to increase the communicative value of the auditor's report. And if you communicate key audit matters, it will also assist the users in understanding the entity and what are that significant areas. Next, determining, no, not this one. One more thing is there. Key audit matters is not a substitute for certain items. See, the standards are asking you to include a paragraph called key audit matters in your audit report. But some people have started misusing it. Some people have started as using for substitute for certain things, which ICA did not intend for. Like for example, to understand this, I have to give you some little background discussion. Management, I'm conducting audit of one entity. Management prepare the financial statements. While management is preparing the financial statements, in the notes to accounts, they forgot to give some disclosure. They did not give some disclosure where in the notes to accounts. Now they are coming to the auditor and saying, sir, we forgot to give one disclosure in the notes to accounts. Anyhow, you will give key audit matter. No, give that disclosure in the key audit matter paragraph. Is it permitted? Do you think is a key audit matter introduced as a substitute for giving disclosure in the notes to accounts? No, it is not a substitute for that. So whatever disclosures which are required to be given in the financial statements, that should be given only in financial statements. Auditor should not use a key audit matter paragraph for that. Number 2, auditor has identified a material misstatement. What is the auditor's course of action? If the auditor identified material misstatement, what should be the course of action? He should have given a modified opinion. But some auditor is saying, I will not give a modified opinion. Instead, I will explain that in the key audit matter paragraph. Permitted? Is the key audit matter introduced as a substitute for giving a modified opinion? No. One more thing. There is some the auditor has identified some matter which is required to be included in the going concern paragraph. In the material uncertainty relating to going concern. What will come in material uncertainty relating to going concern? We will see it in SA 570. But auditor identified some matter which is required to be included in material uncertainty relating to going concern paragraph. The auditor is saying, instead of explaining that in that paragraph, I will explain it in the key audit matter paragraph. Can he do that? No, it is not a substitute for that. So key audit matter is not a substitute for 3 things. What are the 3 things for which key audit matter is not a substitute? It is not a substitute for disclosures in the financial statements, not a substitute for modified opinion. It is also not a substitute for material uncertainty relating to going concern. And also, whatever auditor is explaining in the key audit matter paragraph, he is not giving any separate opinion on any of the matters. Clear? And one more thing, applicability. I forgot to mention about applicability. Applicability paragraph, you will find it in SS 700 if you go back to the contents there. So, is key audit matter required for all audit engagements? Currently, no. Why? Because this was a relatively new standard when compared with the others. They did not make it mandatory for all audits. Initially, they told for all the listed entities, it is mandatory. If you are conducting audit of a listed entity, in that audit report, compulsorily you have to include a key audit matter paragraph. Sometimes the entity might not be a listed entity, but sometimes law and regulation might require you. Say, for example, you are conducting audit of some bank which is not listed, but RBI or some banking regulation act might require you to, what happened? Gone. Okay. Oh shit. Now only it's gone. Yeah. So let us continue. I was talking about when the key audit matters are mandatory. Number one, if it is a listed entity. Sometimes entity will not be listed, but there might be a requirement of law or regulation. Then also you are required to include a key audit matter paragraph. In some cases, in rest of all the entities, that is up to your choice. The rest of the entities, it is up to your choice. So if you feel it is necessary in the public interest, you can do for other entities. If you don't feel any requirement is there, you can ignore it. But only in two cases it is mandatory, in the case of listed entity, or if there is any requirement from law or regulation. In rest of the cases, let us leave it to the auditor's choice. Next, how you have to present that key audit matters. We have already seen the presentation. You have to include that in a separate heading, and for each key audit matter you have to include separate subheading. Like as you could see here in the Reliance Industries Limited audit report, the audit is explaining 4 key audit matters. One main heading is their key audit matter. Under that, for each key audit matter we have a separate subheading. And before you start explaining the key audit matter, some 2-3 lines of introductory information you have to say. So what is the 2-3 lines of introductory information you have to say? This paragraph. Key audit matters are those matters that in the auditor's professional judgment were of most significance while conducting audit of the financial statements. And these matters were addressed in the context of audit of the financial statements, and the auditor does not provide separate opinion. This information exactly you have to copy paste. So even you will be able to find it here. So before they explain the key audit matter, they will give a few introductory lines here. So whatever we have read, the same thing you will be able to find it. Right. Next, sir, how to identify key audit matters? How to identify key audit matters? As I have told, what did I say? Those matters which auditor feel it as most significant. So, but you can't put all the responsibility on the auditor's head, no, sir. At least institute should give some guidance where I can go and start looking for the key audit matters, or what factors will help me to identify the significant matters. At least some guidance should be given. Yes, ICA has given the guidance. So what guidance ICA has given is you can start looking for key audit matters from these areas. So you can determine key audit matters from these areas. From which areas? Those areas where you have a high risk of material misstatement. From that areas, one area you can choose it, one or few areas you can choose it as a key audit matter. Or you can choose from those areas where many judgments are involved. Like as you all are aware, management, like we have seen in the process of preparation of financial statements, management will make use of various judgments. In those areas wherever judgments are very large in number, from those areas also you can select the key audit matter. And finally, you can also select significant events or transactions, like any significant acquisition which has taken place, that you can explain it as a key audit matter. So these are the 3 areas where you can start looking for key audit matter. What are they? Areas of higher assessed risk of material misstatement, those areas which involve significant judgments and significant events or transactions that has taken place. And one more thing, before you want to include anything in the key audit matter paragraph, you have to communicate that with the those charged with guardians. So basically, in the definition itself, they say you have to select the key audit matters from those matters which are communicated with those charged with guardians. This is what simply SA 701 is about. Now let us talk about SA 706, which is relating to 2 more contents. What are the 2 more contents? One is emphasis of matter paragraph, and the other one is other matter paragraph. So 2 contents. This standard also will cover 2 contents. So each one we will take it up. First, we will talk about emphasis of matter paragraph. So what do you mean by emphasize? What do you mean by or emphasis? Highlight, to highlight something. So emphasis of matter paragraph will be used by the auditor where some information is already presented or disclosed. Where? In the financial statements. So management has already presented or disclosed some information in the financial statements. but as an auditor you felt that that information is very essential or very fundamental to users understanding of the financial statements. See, management without their mistake they have included in the financial statements, but we can't expect each and every shareholder to read each and every page. Like we only will not read beyond the figures and numbers. So we only will not read the notes to accounts. How can we expect a normal person to read even through the notes to accounts? So that's why what the standard SS 706 says is some information is there which is already presented or disclosed by the management. But that information is very fundamental to users' understanding of the financial statements. You have a fear that some people might miss out on this information. Even though the management has given it, some people might not go through that information, which can make that people to take wrong decisions. Like for example, fire accident, exceptional item has taken place. This year company has suffered a huge loss, and the main reason for that loss is there was a fire accident. That information management without hiding they have explained in their notes to accounts, but people might not read it. They will assume that when compared with the last year there is a significant fall in the profit of the company. Might be company is in a bad phase, they might start liquidating their money, they might start selling the shares, but the actual reason for the decrease in the profit is not decline of the business, but it is a exceptional circumstance. Management without their mistake they have explained where in the notes to account, but auditor is having a fear. What fear auditor is having? The user might not read that information and he might take wrong decision by just looking at the face of the P&L. So he wants to highlight this information somewhere in the auditor's report. Can he highlight by giving modified opinion? Management will give a tight slap to you. So why we will, when we give modified opinion, what we are trying to say? We are trying to say management has done something wrong. But management did not do any wrong, no. Without their fault, they have explained everything in the notes to accounts. I want to highlight. So what I can do? I can't highlight by giving a modified opinion. So in those cases, the standard SS 706 is giving an option for you. You do one thing in your audit report, include a paragraph with the heading emphasis of matter. In that paragraph, you highlight. So the paragraph will start something like this. We draw your attention to so and so note number. Basically, you are required to give a reference to that respective place where the reader can go and get that full information. So you can mention in the emphasis of matter paragraph, we draw your attention. We want you to pay attention to so and so note number in the financial statements where some important information is there, which is very much fundamental to your decision making. So for that purposes, emphasis of matter paragraph will be used. So some information is already presented or disclosed. So like if you see here, emphasis of matter paragraph, it is a paragraph which is included in the auditor's report that refers to a matter which is appropriately presented or disclosed in the financial statements, but it is of such importance that it is fundamental to users' understanding of the financial statements. So how you have to use it, how you have to present that emphasis of matter paragraph. So if the auditor considers it necessary to draw users' attention to a matter which is already presented or disclosed in the financial statements and which is fundamental, then what you should do is use a separate heading, emphasis of matter paragraph, and in that heading you can mention. And only those matters you are required to highlight in the emphasis of matter paragraph regarding which you are not required to give a modified opinion. If I put it in simple terms, only those matters you are supposed to highlight in the emphasis of matter paragraph which are not materially misstated. If you are satisfied some information is not materially misstated, only those matters you can highlight in emphasis. Why? Because if some item is materially misstated, then what is the action you should do? Should give a modified opinion. Just a highlighting will not be enough there. You have to give a modified opinion. So only those matters which are not materially misstated, which doesn't require you to give a modified opinion, only those matters are required to be included in the emphasis of matter. And also, if a matter has already been determined as a key audit matter, if a matter is already determined to be a key audit matter, no need to include it once again under emphasis of matter paragraph. Next, once again gone. Okay, concentrate. So I think we are about to reach the break time. Let us do it quick. So whenever you want to include an emphasis of matter paragraph, guys concentrate now. So whenever you want to include an emphasis of matter paragraph in the auditor's report, can I mix it with other paragraphs? No. Use a separate dedicated section, emphasis of matter paragraph within a separate section, and you should clearly give a reference. What do you mean by giving reference? As I've told, give a reference to the note number. Go and refer to so and so note number. We draw your attention to so and so note number. That reference must be there. And also, you should mention that you are not modifying the opinion. Why? Because many a times people will have a misconception. Even with a good intention, auditor is highlighting, people might take it wrong. Since auditor has mentioned this, something is wrong here. So to avoid that misconception, just add one line that you are not modifying the opinion, just you are highlighting it. Clear? Right. So most important thing from the standard examples, they have asked this question also in the previous attempts. So they have told, give examples of a few matters which can be highlighted in the emphasis of matter paragraph. Like an uncertainty relating to future outcome, nothing but pending case, contingent liabilities are there that you can highlight. Significant subsequent events, if there are any subsequent events that you can highlight. And early application of a new accounting standard, or even it could be a major catastrophe. So this they have asked it. So that's why specifically I am referring to this. They might ask you this next. And it is also not a substitute, like the way we have seen key audit matter is not a substitute. Even emphasis of matter paragraph is also not a substitute. So it is not a substitute for modified opinion. It is also not a substitute for disclosures in the financial statements. It is also not a substitute for material uncertainty paragraph. Understood? So we have understood what is a emphasis of matter. Now let us try to focus on what is an other matter paragraph. So when it comes to other matter paragraph, very simple, emphasis of matter paragraph will be used to highlight some information which is already presented or disclosed. Other matter paragraph will be used to bring to the user's attention some information which is not presented or disclosed in the financial statements. Basically, other matter paragraph will be used for the purpose of responsibilities of the auditor. Any additional responsibility taken by the auditor, or any reduction in the responsibility of the auditor, like you are not the person who conducted the branch audit, along with you there is some joint auditor. So these kind of things, if you want to explain that things, you will try to basically explain in the other matter paragraph. Responsibility related things will be explained in other matter paragraph. And one more small thing here, before you want to include an emphasis of matter paragraph or another matter paragraph, you are required to communicate with those charged with governance. Okay. Next, audit of the branch office accounts and all. I think this you can manage. So who is required to do, who can do the branch audit? Who can do branch audit? Company auditor himself can do it, or any other accountant can do it. Any other accountant also can do. Or in case if the branch is located outside India, the company auditor himself, or any other accountant from India, or a person who is qualified to act as auditor as per the laws of that respective country also can do it. And out of this also, this one, when you are using the work of another auditor, the principal auditor should perform some procedures. Say for example, there is a company X Limited, you are a principal auditor. It is having one of the branches. The branches is there in, say, Delhi. So what the company has done is, for this Delhi branch alone, they have appointed a branch auditor. So now this person will do the audit of the Delhi branch, and he will submit that report to whom? Principal auditor. Now what principal auditor will do? Using his work and also using branch auditor's work, he will give a report on entire company. So basically, this principal auditor, when giving the report on the entire company, is he using the work of other auditor? He's using his own work and is also using the work of branch auditor. So the principal auditor, when he wants to make use of the other auditor's work, he is required to perform some procedures. See, you should be on a safer side, no? Why? Because ultimately your report is going out. Branch auditor's report will not go out. Your report with your signature will go out. So whenever you are making use of branch auditor's work, you have to be a bit careful. You have to take some precautions. You have to perform some procedures. So what procedures you have to perform when you want to use the work of other auditor? So 5 things SA 600 has told. How many? 5 things. Number 1, first, before you even start doing the audit, have a formal communication with the branch auditor. Tell him how you are going to make use of his work. What you are going to tell him? How you are going to make use of his work, and make sufficient arrangements for coordination also. Like once in a week we will have a call, once in 15 days we will have a call. So that you have to do. So first step, what you should do? Let him know how you are going to make use of his work and make arrangements for subsequent coordination. Number 2, if you find, as a company auditor, if you find any area which require special consideration, tell that to the branch auditor also. In the branch also, revenue is a critical area. Please pay more consideration to the revenue. So that also you can let him know. And You can let him know what are the significant accounting, auditing and reporting requirements, not just communicate with him, even get a representation that even branch auditor also will comply with him. This is particularly very important in case if your branch is located outside India. Why? Because country to country accounting and reporting requirements will change. So it will always be better you communicate with the other auditor what are your accounting, auditing and reporting requirements. Don't just communicate, even get a written representation that he will also comply with them, and discuss with the other auditor the audit procedures applied, or even review a written summary. So what even you can do is, before final, once the branch auditor has submitted the report, if you have some doubt, so what you can do is you can ask him, you can call and ask him, boss, can you explain what procedures you have performed in this area? If you find that just oral communication alone will not be enough, what you can say is you can ask him to send a written summary what procedures he has performed. Even with that also you are not satisfied, still a bug is going on in your brain, so whether this person's work I should believe it or not, then you go and visit. What is the last option? You go and visit. So as a principal auditor, when you decided to make use of other auditors work, these are the 5 procedures you have to perform. What are they? First, let the branch auditor know the use you are going to make out of his work and make arrangements for coordination. Inform the other auditor regarding the areas which require special consideration. Communicate with them significant accounting, auditing and reporting requirements, and even obtain a written representation as to compliance with them. And then finally, discuss with the other auditor what procedures he has performed. If required, ask him to provide a written summary. Even if you are not satisfied with that also, you go and visit the branch. Understood? Right. 299, we will come back to that later. So first what we will do is we'll try to we'll try to read a few reporting requirements under 143 subsection 1, subsection 3, subsection 12. First we will do this 3, then 143 subsection 11 we will have a dedicated discussion which is talking about CARO 2020. So first we will talk about 143 subsection 1. See, 143 subsection 3 I will not explain in a detailed manner. 143 subsection 3, in that only clause J I will explain, because that is where the question will come from. So, but anyhow, let us go in the order. Under 143 subsection 1, you have 6 matters on which you are required to report. How many we have? 6. This they have a chance of asking. Once again, it is coming out. Okay. Just a minute. Hey, what is... Fine. So let us start now. We are going to now talk about, till now we have seen the reporting requirements under the standards on audit. So now we will see some reporting requirements under 143, section 143 of the Companies Act. So under 4 sections we have reporting requirements: subsection 1, subsection 3, subsection 11 and subsection 12. So first we will try to cover reporting requirements under 143 subsection 1. Here we have 6 matters on which we are required to report. Very many times they have tested it, and this they will test also. This is having a scope for testing. So the 6 points which are required to be commented by the auditor, reported by the auditor under 143 subsection 1 are as follows. Come on, let us repeat along with me. First point, you are required to comment whether loans and advances which are made by the company. So first point is regarding loans and advances, and they're telling made by the company. When I say made by the company, given by the company or received by the company. Loans and advances which are given by the company to the others. If they are telling it on the basis of security, if they have told that they have given the loans and advances on the basis of the security, whether they have been properly secured. What do you mean by properly secured? When we can say a loan is properly secured, the amount of asset, the value of the asset which has been offered as a security, that value should be more than the amount of the loan given. Then we call it as properly secured. So whether loans and advances which are made by the company to others, if they are given on the basis of security, then we should check whether they are properly secured or not. And even we should check the terms and conditions on which those loans have been made, are they prejudicial? Prejudicial means what? Harmful to the interest of the company or shareholders. That is the first point. Number 2, we need to check whether the transactions which are represented merely by book entries are prejudicial. What do you mean by transactions represented merely by book entries? So not fake entries actually. Sometimes there could be genuine entries also which are represented merely by book entries, like depreciation, provision for bad and doubtful debts. These are just merely book entries. So we need to check these kind of transactions which are represented merely by book entries. Are they prejudicial. That means whether over provision, under provisioning has been created, that we need to check it. Third one, where the company not being an investment or banking company, whether so much of the assets of the company as consists of shares and debentures and other securities have been sold at a price less than purchase price. Basically, if your client company is other than investment company or banking company, if it is investing company or banking company, this point does not become applicable. Your client is a normal company which is other than investment company or banking company. In case if they are holding investments in the form of shares, debentures or bonds, have they sold it at a loss less than purchase price? Once again, I am telling you, sometimes they will try to confuse you giving the market price. They will say the purchase price of the shares is 100, the current market price is 120, whereas the company sold the shares at, okay, no, not like this. So let me give it to you. Purchase price is 100, current market price is 90, but the company was able to sell it at 95. The company is not an investment company or banking company. Is this transaction required to be reported or not? Yes. What is current market price? Irrelevant. Just we need to compare two values: sale price minus purchase price. So if the sale price is less than the purchase price, you have to report it here. Understood? Next, fourth one, whether loans and advances made by the company have been shown as deposits. So fourth point is also talking about loans and advances which are given by the company. If your client company has given loan and advance, but instead of showing it as loans or advance, is it showing it as deposits? That you have to report it here. And whether personal expenses have been charged to revenue account. What do you mean by that? Whether personal expenses have been shown as business expenses. So whose personal expenses? Company will not have any personal expenses. Company will not go on vacation. Company will not enjoy anything. So whether the personal expenses of directors, employees, have they been treated as business expenses? That we need to check. And also, in case if your company has allotted the shares for cash, whether that cash has actually been received, and if not, the position stated in the financial statements should be correct and not misleading. So these are the 6 points which are required to be reported under 143 subsection 1. What are they? Loans and advances made by the company are properly secured and terms are not prejudicial. Number 2, transactions represented by mere book entries, they should not be prejudicial. Number 3, other than investment company, banking company, have they sold their investments at less than purchase price. Number 4, loans and advances have been shown as deposits. Number 5, personal expenses have been charged to revenue. Number 6, if your client company has allotted shares for cash, whether cash has actually been received. If not, position should be correct and not misleading. And these 6 points are required to be reported only when you have a negative comment. Only when you have a negative comment, then only these 6 points are required to be reported. If you have positive comment, you are not required to report. If you are unable to find any of this point in the audit report, what does that mean? That means that auditor has verified all the 6 points, but he did not find any negative comment regarding any of the 6 points. Understood? Clear? Then coming to 143 subsection 3, we have some 143 subsection 2 simply says you are required to give a report. So whatever accounts you have examined, on that you have to give a report. In that report, you have to say financial statements give a true and fair view or not. This you can ignore it. So now let us come to 143 subsection 3. In 143 subsection 3, we have various reporting requirements. Starting from clause A till clause I, we have various reporting requirements. There is a very less chance of asking the question. Write all the reporting requirements under 143 subsection 3. They will not ask. Why? Because today question will be tested for maximum 4 marks or 5 marks. So for that, they will not ask you this much lengthy question. But what is the probability is they might ask only this point. What are the reporting requirements? Sorry, not this one, this one. What are the reporting requirements under 143 subsection 3 clause J? So under 143 subsection 3 clause J, we have 6 matters which are required to be reported. Out of that, the first 3 matters are old. They are there for a very long period of time. But D, E and F were added in the recent times. So that's why this particular point is gaining more significance in the recent times. So what are that matters which are required to be reported under 143 subsection 3 clause J? First one, whether the company has disclosed the impact, if any, of pending litigations. So as an auditor, you are required to comment whether company has disclosed the impact of pending litigations. Are they asking the auditor to disclose the impact of pending litigations? Are they asking the auditor to disclose the impact of pending litigations in his audit report? No. They are asking the auditor to check whether management disclosed the impact of pending litigations in financial statements. They are not asking auditor to give disclosure of pending cases. They are asking auditor to check whether management has given disclosures regarding pending litigations in the financial statements. Number 2, whether the company has made provision for material foreseeable losses. If the company came to know now itself they are going to make a loss on a contract, that contract is going to take place over a span of 5 years. Can they wait for 5 years for recognizing the loss? No, they should have recognized in year one itself. So like that, if the company is going to have material foreseeable losses on long term contracts, whether they have created a provision or not, that also I need to check and give a comment. Third one, whether there has been any delay in transferring the amounts which are required to be transferred to Investor Education Protection Fund. As we all are aware, some amounts are there which are required to be transferred to IEPF. So we need to check whether your client is having any such amounts which are required to be transferred to IEPF. Each amount will have a deadline also, whether amount has been transferred within the deadline or has there been made any delay in transferring the amount to the IEPF. So that we need to check and give a comment. Now comes the D point. So let us try to understand. In the D point also 3 sub points are there. We will try to understand this with the help of example. Okay, fine. So 3 things here. If you read the text, it becomes quite complicated. Let us try to understand. See, you are conducting a audit of the client X Limited, which is a client company. You need to ask the management of your client company. Whom? You should ask the management of your client company to give a representation, to give a written confirmation that they did not involve in certain transactions. They did not involve in certain transactions. Which are transactions? They should not have given funds in the form of loan or in the form of advance to some another entity. Say for example, we call them as Y Limited. For the time being, we call them as intermediary. So your client has given any loan or advance to some entity which we call them as, which that entity to whom the loan or advance or any amount has been given, investment has been made, that entity we call them as intermediary. But there is an understanding between whom and whom? Between the client company and the intermediary, there is an understanding. That understanding could be in written format or otherwise. That could be a written understanding, that could be a oral understanding also. And what is that understanding is, this intermediary should go and give that either amount as a loan, advance or investment, or give a guarantee on behalf of some further entity. Say for example, Z Limited, which we call it as ultimate beneficiary, which we call it as ultimate beneficiary. So if you, whether your client has engaged, they should do these transactions or they should not do these transactions. See, generally, if you look at the entire scenario, what is happening is X Limited, your client company, wants to do some favor to Z Limited, which is an ultimate beneficiary. Either they are prevented from doing it, or if they have done it directly, they might be answerable to many people. They might have to face so many questions. So in order to avoid that questions, what your client company is doing is, instead of transferring the favor, instead of doing the favor directly to ultimate beneficiary, they have created one intermediary. So they are giving loan, advance or investment to Y Limited with the understanding that Y Limited should go and give loan, advance or give a guarantee on behalf of ultimate beneficiary. So what in the back end happening is, X Limited wants to do some favor to Z Limited, but instead of doing it directly, they have created one intermediary. Is it misleading or not? Should they do it or should they not do it? They should not do it. So you should ask your client's management to give a written representation that they did not do these kind of transactions. They have not given any loan or advance to another entity with an understanding where that intermediary should go and further give a loan or advance or give a guarantee on behalf of ultimate beneficiary. They did not indulge in these transactions. Ask the management of your client company to give a written confirmation. That is the first point there. Second point, if you come to the second point, what they say here is, say for example, you are conducting audit of the client X Limited. Once again, this is your client company. Now here also from your client company, you should ask some confirmation that they did not do certain transaction. Which kind of transaction? That your client company has received some loan or advance from another entity. Say for example, A Limited, which we generally call it as funding party. Which we call it as what? Funding party. Here your client has received. So from funding party, and between the funding party and your client company, there is an understanding. That understanding could be in writing or it could be in otherwise. What is that understanding is, whatever money that your client has received, they have to either go and give it as a loan or advance or give a guarantee on behalf of some another entity B Limited, which we here call it as ultimate beneficiary. You tell me, should your client indulge in these kind of transactions? Here what is happening? Some entity wants to do favor to another entity. In our example, funding party wants to do some favor to ultimate beneficiary. But to facilitate the transaction, your client is acting as a mediator. Should they do it or should they not do it? So ask the same from the management, that they did not indulge in these kind of transactions. So first point, they should not have created any intermediary. I'm not visible now. You did not tell me only here. Half of the face is not visible. Right. Yeah. So in the first point, they have told that you should not be creating any intermediary by which you are doing a favor to ultimate beneficiary. Second case, you should not act as a intermediary. So you should not indulge in these kind of transactions. Ask the management to give a confirmation that they have really not done it. So if you go and ask the management, they will give you confirmation, but will you blindly believe it? No. So now what the third point says is, first you go and ask the management to give that written representation. Okay, management will give it. Now what you should do is, you should perform some audit procedures, whatever you find it as reasonable and appropriate, and you should comment nothing has come to your notice that has caused them to believe that representations under clause 1 and clause 2 contain any material misstatement. So if you go and ask the management to give confirmation, they will give confirmation, but you perform some procedures, whatever you feel it as appropriate, and determine whether there is any thing which is coming to your notice which makes you doubt that representation. Understood? So that is what reporting requirements under clause D of 143 subsection 3 clause J. Then two more extra points are there. In case if your client company has declared the dividend, you are required to check whether that dividend has been declared in accordance with the provisions of section 123 of the Companies Act. They can't declare whatever dividend they want. There are certain rules, certain calculations which you are required to follow, so that you need to check. And also one more latest update, your client should be using accounting software. Starting from the 1st of April 2024, they should be using an accounting software which is having a feature of recording of audit trail. So what is basically audit trail? Edit log also you can say that thing, but the background of the transaction. So flow of the transaction, who initiated, who updated, who deleted, that background things also should be there. So that we call it as audit trail. And from 1st April 2024, every company should use only such accounting software which have a feature of recording audit trail. So that they made it mandatory on the companies. Now they put a responsibility on the auditor to check whether really companies have complied with that requirement or not. Understood? So these are the extra reporting requirements under 143 subsection 3 clause J. This also they have asked it and they have a chance of testing it now also. Understood? So we have completed 143 subsection 3, 143 subsection 1. Now we will talk about reporting requirements under 143 subsection 12, which is relating to reporting of fraud. So as an auditor, during the course of your audit, if you come across any fraud, you are required to report it. And how to fulfill that reporting requirements, let us try to have a look at that. So in order to fulfill the reporting requirements, or your reporting requirements is going to depend on what is the amount involved in the fraud. What is the amount involved in the fraud? If the amount involved in the fraud is what? How much? If the amount involved in the fraud is 1 crore or more, then central government reporting will become applicable. If the amount involved in the fraud is less than 1 crore, then central government reporting will not become applicable. So if you are conducting the audit, during the course of the audit, if you come across any fraud, and if you have reason to believe that amount involved in the fraud is 1 crore or more, you are required to report that to the central government. How to report to that central government? What is the manner of reporting? First thing, the moment you came to know about fraud, within 2 days, you are required to report this matter. To whom? So audit committee or board of directors, they say, but here there is one thing which students often get wrong. It is not a choice. It is not a choice. The Act 143 subsection 12 did not give a choice for the auditor to decide to whom to send. If audit committee is there in the client company, you have to report it to audit committee only. If audit committee is not there, then you have to report it to board of directors. So it is not your choice. If audit committee is there, you can't decide, okay, instead of sending audit committee, we'll send it to board of directors. You can't say that. If audit committee is there, only audit committee. If audit committee is not there, then to the board of directors. Within how many days? Within 2 days of knowledge of the fraud. So once you have communicated with them, you should give them 45 days of time. How much time? 45 days of time. For what purpose? To reply. So you have communicated the matter to the management. So you expect some reply from them. So you wait for 45 days for their reply. So within 45 days, two things might have taken place. What two things might have taken place? So you might have received a reply. In case if you have received a reply within 15 days of receiving the reply, within how many days? Within 15 days of receiving the reply, you have to report that matter to central government. So what and all you have to report to the central government? The report which you originally sent to board of directors or audit committee, what reply you have received, on that reply what are your remarks? Three things: report which you have sent to audit committee or board of directors, what reply you have received, on that reply what is your remark. These three things are required to be communicated to central government. And how you have to communicate? In form number ADT4. In which form? Form number ADT4. And this information should be sent on letterhead. It should contain your address, your name of the firm, your membership number, your seal also should be there, your stamp also should be there. And when I say you have to report to the central government, to whom you will report exactly in the central government? Prime Minister of India? No. So when I say Secretary, Ministry of Corporate Affairs, what do you mean by central government here? To the Secretary, Ministry of Corporate Affairs. So if you receive reply within 15 days of receiving the reply, you are required to communicate this matter to central government. So by submitting a form ADT4 within how many days? Within 15 days. Sir, what if within 45 days if I don't get any reply? I intimated the matter to the I intimated the matter to audit committee or board of directors. I gave them 45 days of time, but I did not get any reply from them. Then what I should do? Then what you should do is, in those cases, also you are required to report to the central government. So, but what you will report there? Whatever report you have sent to audit committee or board of directors, along with one fact that you have not received any reply, that information you will send it to central government. But here the act is silent on time limit. They did not mention time limit, but however we can derive the time limit from other scenario. So what is the time limit in other scenario? You are going to get a maximum of 15 days of time from what? From the date of, from the expiry of 45 days. Either you can say that way, or you can say within a time of maximum 60 days from the date of communication with audit committee or board of directors. So within that time limit, you are required to send a report to the central government. Okay. Okay. So if the amount involved in the fraud is 1 CR or more, so this is what you are supposed to do. So what if the amount involved in the fraud is less than 1 crore? Then you are not required to report to central government. But can you ignore that fraud? No. So what you are supposed to do is, in case if you came to know about the fraud where the amount involved is less than 1 crore, you are required to report this matter to audit committee or board of directors. Same, the logic whatever we have applied there, the same logic. If audit committee is there, to the audit committee. If audit committee is not there, then to the board of directors within 2 days. What and all you have to communicate? A brief description of the fraud along with approximate amount involved and who are the parties involved. So three things: nature of the fraud along with the description, who are the parties involved, and what is the approximate amount involved. With that, your responsibility will come to an end. But after this, the management will have one more responsibility. They will give something called board's report. What they will give? They will give something called board's report. So in that board's report, management is required to give disclosure, not auditor. Who? Management is required to give disclosure. What disclosure they are required to give? The same three things along with what remedial actions were taken. The same about three things along with what remedial actions were taken. So that four information they are required to disclose it where in the board's report. Understood? So these are the reporting requirements under 143 subsection 12. Now let us come to the most important part, the reporting requirements under 143 subsection 11. So there is other name for the reporting requirements which we also call it as CARO 2020. How many matters are there? There are a total of 21 matters which are required to be reported. So let us try to revise them quickly. Maintain silence please, focus. Right. First of all, let us talk about applicability. Is auditor of every company required to report on CARO? No. So they initially told that CARO is applicable for all companies including a foreign company. What do you mean by foreign company here? The company which is incorporated outside of India but it is having a place of business in India. Even they are also required to comply with CARO. But however, a few companies are exempted from applicability of CARO. Which are that companies which are exempted from CARO? Banking company, insurance company, section 8 company, one person company, small company, and a private limited company. What is that? And a private limited company subject to fulfillment of four conditions. All four or any four? Any of the four? All four. So if a private limited company, if it fulfills all the four conditions which we are about to discuss now, then for that private limited company also CARO will not become applicable. If CARO is not becoming applicable, who is happy? Both will be happy. Company also will be happy, auditor also will be happy. Why? Because auditor need not put the extra effort, company need not provide extra information to the auditor. Both will be happy. So but what are that conditions which are required to be fulfilled by a private limited company for CARO to not become applicable? Number one, it should not be a subsidiary or holding of a public company. So neither you should have, if you are a private limited company, neither you should have a holding company, which is a public company, neither you should have a subsidiary company, which is a public company. So neither your subsidiary nor your holding should be a public company. Number two, the paid up capital along with reserves and surpluses should not exceed. That means it should be less than or equal to 1 CR as on what date? As on the balance sheet date. Throughout the year, what is the situation doesn't matter. As on the balance sheet date, the total of the cumulative balance of paid up capital and reserves and surpluses shall not exceed 1 CR. Third one, the borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. Not just as on the balance sheet date, throughout the year, at any point of time, what should not have happened? The borrowings from banks and financial institutions should not have exceeded 1 CR. Not on the balance sheet date, guys, at any point of time during the financial year. And last one, total revenue, including revenue from discontinuing operations, shall not exceed 10 crores. As on the balance sheet date or at any point of time. Revenue is a cumulative figure. It is not a one point, it is not a balance, it is a cumulative figure. When I say revenue, that will consider for the entire financial year. So if all these four conditions are satisfied, then for such a private limited company, CARO will not become applicable. Understood? So there are some specific things which you have to keep in mind. I think you all know that. You might have done multiple questions and all. I don't want to go into that applicability and all. We will directly go to the reporting requirements, or should we touch upon it slightly? Okay, so when it comes to paid up capital and reserves and surpluses, all kinds of paid up capital will be included. All kinds of paid up capital will be included. Equity share capital, preference share capital, everything will be included. If there is any calls in arrears or calls in advance, that adjustments you have to do. When I say reserves and surpluses, all kinds of reserves will get covered here. Capital reserve, revenue reserve, will get covered here. If you have any debit balance in the P&L, that you can adjust it against credit balance in the reserves. Even after adjusting against the credit balance of the reserves, if you have any excess debit balance in the P&L account, that you can adjust it against paid up capital. When I say adjust, will you go and adjust in the balance sheet? No, we are adjusting it for the sake of calculation. Okay, next. When I say borrowings, when you are calculating borrowings, all kind of borrowings will get considered. Short term, long term, even credit card outstanding balances also will be considered. Secured, unsecured, everything will be considered. And only borrowings from banks and financial institutions is required to be considered. Other borrowings will not be considered. Okay. And from a bank, if you have a borrowing with the same bank, if you have a fixed deposit also. Say for example, with a bank you are having 50 with a bank we have 1.1 CR of borrowing. With the same bank you have 30 lakh worth of fixed deposit. Should I consider the gross value, or I should take the net value? You have to take the gross value. Don't net off the assets and all. Next, is the limit of 1 CR for each bank separately, or cumulatively for all banks and financial institutions put together? Cumulatively for all banks and financial institutions put together, the borrowings should not have exceeded 1 CR. Finally, total revenue. In the total revenue, this total revenue figure is exclusive of taxes. But you have to be careful. If the given figure is already exclusive of taxes, don't deduct it once again. So the given the figure you should take is exclusive of taxes, and if there is any trade discount, that you can reduce it, right? Then, so this is what the things you need to keep in mind. And one more thing, audit, if you are conducting audit of in case if the company is having branches, so principal auditor is there, branch auditor is also there, separate branch auditor is there. Now for checking, see for example, for principal auditor we will calculate the limits for the entire company. For the branch auditor, to decide whether CARO is applicable or not, should we calculate the limits for branch separately? No. We will calculate the limits for the company as a whole. If once CARO becomes applicable for the company, the principal auditor and all the branch auditors are required to comply with CARO. And in case of holding companies, they prepare two sets of financial statements: standalone financial statements, consolidated financial statements. According to which financial statements we have to calculate the limits? Standalone financial statements. On the basis of standalone financial statements, you have to calculate the limits. And for audit of consolidated financial statements, CARO is not applicable except one clause, clause number 21. Only you are required to report clause number 21. Rest of all the clauses are not required. Right. So these are the things which you need to keep in mind for checking the applicable limits. Now we will talk about the points which are required to be reported. Okay. Right. So what and all are the different matters which are required to be reported? So let us try to pay attention now. First thing which is relating to property, plant and equipment. See, when I say property, plant and equipment, tangible, intangible, work in progress, everything will get covered here. So when it comes to property, plant and equipment, there are 5 things which auditor is required to see and comment. So what is the first one? Maintenance of records. Are they asking auditor to maintain the records? No. They are asking the auditor to check whether management has maintained proper records regarding property, plant and equipment. From that records, we should be able to know quantitative details. What do you mean by quantitative details? Number of the assets, and along with that, from that records, we should be able to understand situation, location of that PPE. So that is first one. We need to check whether proper records are maintained or not. Number 2, physical verification. Are they asking auditor to do physical verification? No. They are asking the auditor to check whether management has done the physical verification at reasonable interval. Now, what could be the reasonable interval? Once in 3 years. Fixed assets are not required to be physically verified every year. The reasonable interval for verification of the for physical verification of fixed assets is once in every 3 years. So you need to check whether these fixed assets are physically verified by the management at reasonable intervals. On that verification, whether any discrepancies. What do you mean by discrepancy? Differences are found out. If yes, whether they have been properly dealt with in the books of accounts or not, we need to comment. Third one, specifically they talk about immovable properties. When I say immovable properties, land and buildings will get covered here. So they say that in respect of any immovable properties, you have to get the title deeds of all the immovable properties. Land and buildings, ask the to take the balance sheet, check all the land and buildings, ask the management to give the property deeds. Check whether the title of the immovable property is in the name of the company. That means in the property title deeds, the property should have been registered in the name of the company. In case the title of the immovable property is not in the name of the company, then you are required to give some details. You are required to report some details. What you are required to report? Description of the property. What is the gross carrying value? It is held in whose name? If not in the company's name, whose name is there? And the person in whose name that property is there, is he a promoter? Is he a director? Is he your employee? And for how long the asset has been held by the company, and what are the reasons why it is not yet transferred in the name of company. So these things are required to be reported. Next, revaluation. Fourth point is regarding revaluation. We need to check whether the management, whether the company has revalued its property, plant and equipment. See, when I say revaluation, revaluation could inflate the figures, or revaluation could even reduce the figures also. So we need to check whether the management has done the revaluation of its PPE. If yes, we need to check on what basis they have done the revaluation. Did they do the revaluation on the basis of a registered valuer? Valuation should be done by registered valuer. According to that, revaluation should happen. Revaluation should not be done according to whatever management thinks. It should be done on the basis of valuation done by a registered valuer. And if the change before and after revaluation, if the change is 10% or more in the aggregate of carrying value of each asset, then even that change also you are required to mention. But here there is one minute thing which we need to pay attention. Say for example, I am verifying land and buildings. In the land and buildings, I have 3 buildings: building 1, building 2, building 3. Before revaluation, after revaluation, I will give you the figures. Building 1, 100. Before revaluation, after revaluation, it is 87. Building 2, 50. After revaluation, it is 57. Building 3, the value is 100, and after revaluation, the building is 108. The building after revaluation, the value of the building is 108. Now you tell me for which asset I am required to report the amount. So for which asset I am required to report the amount. They told if the change is 10% or more. If you see here, for building 1, the change is 13. For building 2, the change is 7. For building 3, the change is 8. Individually, if you compare, here 13% change is there. Here 14% change is there. Here 8% change is there. But you are not required to report any amount. Why? Because they say if the change is 10% or more in aggregate of each class of PP. For the entire PPE, you have to calculate what is the aggregate. So what is the value of entire PPE, entire land and building before revaluation? How much it will come to? 250. What is the value after revaluation? 243 or 2? 242. Sure about it? Okay, I do believe you. But it is wrong. 245, I guess. 245, no? Yeah, whatever year, less than 10% it will be. No? 242 only. Okay, fine. Sorry, my mistake. Calculator told. Good. 242. So here if you see for the entire class of land and buildings, what is the change here? 8 CR only, which is hardly less than 10% of 250. So nothing, no amount is required to be reported. Understood? So that is what the fourth point. Now coming to the fifth point regarding which you are required to report is Binami transactions. You need to check whether any Binami transactions have been initiated. Have they been started freshly or already they are undergoing or pending against the company for holding any Binami properties? If yes, whether the company has appropriately disclosed. Once again, they are not asking auditor to disclose the Binami transaction details. They are asking the auditor to check whether company has disclosed the Binami transactions in their financial statements or not. Clear? So first matter which is required to be reported under CARO. What is that? PPE. Under PPE, 5 things. Number 1, maintenance of proper records. Number 2, physical verification at reasonable intervals. Number 3, titles of immovable properties. Number 4, revaluation. Number 5, Binami transactions. Next. Coming to the next one, second item, inventory. So regarding inventory, what you are required to report. Here also physical verification. So here also I need to check whether management has done physical verification of the inventory at reasonable intervals. What is reasonable interval for inventory physical verification? Once in every year. Here you can't say once in every 3 years. Once in every year, the management should do physical verification of their stock. And on doing that physical verification, you have to comment coverage and procedure is appropriate. Whatever procedure has management has followed, whatever coverage they have done for that physical verification, is it appropriate according to the size of the company? And also, in case if the discrepancy is 10% or more between the stock which is physically lying and between the stock as per the records, if the difference is 10% or more, once again not for each item, once again for aggregate of each class of inventory, then you are even required to report that amount of discrepancy also. Here the classes of inventory, if I say raw material is one clause, work in progress is one clause, finished goods is one clause. So for each class you need to check what is the difference, what is the difference as per books and what is the difference as per physical stock. If that difference is 10% or more, then you are required to report it. Next, second one is regarding working capital loans. This point says that you need to check whether your client company has taken a working capital loan, that too in excess of 5 crores, that too giving your current assets as a security. The second point will become applicable only when your client has taken a working capital loan. If your client has not taken working capital loan, no reporting here. And your client has taken working capital loan, but the amount should be more than 5 CR. If the working capital loan is less than 5 CR, no need to report. And your client has taken working capital loan, amount is more than 5 CR, and for that should be a secured one, for which they should have given their stock current assets as a security. If that is the case, in case if you have taken the working capital loan on the basis of the current assets as security, you are required to submit quarterly stock statements to the bank regarding your stock position. Now they have put a responsibility on the auditor to check whatever stock statements which are getting submitted by the company to the banks, is it matching with the books of accounts? That means, are they submitting genuine stock statements or fake stock statements? That you need to check and give a comment. Understood? Clear and comfortable, everybody? So second point, that will become applicable only when client has taken a working capital loan, that too in excess of 5 crores by giving a security of current assets. Clear? So inventory, 2 points, physical verification and working capital loan, checking of the stock statements. Now, third point talks about investments, guarantee, security, loans or advances, once again, which are given by company, not about accepted. They are talking about receivables given by the company. So when it comes to this, we have 6 points. So what are that 6 points? Number 1, you need to check whether during the year Has your company provided any loans or provided advances in the nature of loans, or they have given any guarantee to any other entity? Basically, I need to check. I need to open their ledgers and check whether the company has given loan, advance, or guarantee to other entities. If yes, I need to do some bifurcation and do the reporting. So, what bifurcation I have to do is, if my client company has given loans to others, say for example, 10 entities they have given the loan. Out of that, I need to identify which entities are subsidiaries, associates, and joint ventures. Say for example, out of these 10 entities to whom my client company has given loan, 2 are subsidiary companies, 1 is associate company, 1 is a joint venture. So 4 such companies are there which are having a relationship of subsidiary, associate, joint venture. And we have remaining 6 companies which are not a subsidiary, not a joint venture, not an associate company. Now I need to identify for these 4 companies put together what is the aggregate amount of loan given during the year, and what is the balance outstanding as on the balance sheet date. The same thing have to calculate here. What is the aggregate amount of loan given for these other entities, and what is the balance outstanding as on the balance sheet date. Simple bifurcation we have to do and report it. However, this point is not applicable for those entities whose principal business is to give loans. Sir, anyhow, for banking company, this banking company CARO itself is not applicable. No, whose principal business is to give loans? Banking company. But for banks, CARO itself is not applicable. No, but NBFCs we have. Yes, NBFCs CARO will become applicable, but this point will not become applicable. Understood? Right. So first point is bifurcate and report. Second point, this is one very much similar to 143 subsection 1 we have seen. On whatever terms and conditions your client has given the loan, are they prejudicial? Are they harmful against the interest of the company? Like giving the loan without interest, or the rate of interest is very less than the market rate, or giving unsecured loan. So these are all terms and conditions which are prejudicial. We need to check it. Repayment. So I need to check the company has not just like that given the loan and ignored it. They need to prepare one schedule of repayment. When interest has to be paid, how much repayment have to do, what is the installment amount they have to calculate. And I need to check whether the payment is received, payment of principal, repayment of principal, payment of interest is getting received within due dates regularly. If not, I need to check whether I need to check yeah, that only. Third point, I need to check whether the receipts are regular. On or before the due dates I am receiving my installments or not, I need to check. So first I need to check, is there a schedule of repayment, and whether the payments are regular. Fourth point, if there is any amount which is overdue, that too which is overdue for more than 90 days, I need to check what steps are taken by the management for recovery of that amount. They are not asking auditor to take any steps for recovery. They are asking to check whether management has taken any steps for recovery of that principal and interest amount, whatever it is. Next, fifth point, rescheduling or extension of the overdue loans. That means this point says that previously company has given loan to somebody. In the current year, that loan has fallen due. 24-25 is the current year. In the current year, loan has fallen due. That means the due date has fallen in the current year. If the due date has fallen in the current year, what they should have done? They should have collected the amount. But instead of collecting the amount, what the company is doing is they are extending. They are extending the due date. They are telling to the people, no need to pay in the current year, pay it in the next year. Or what they are trying to say is they are giving a fresh loan to the same person, and that person is using the fresh loan, repaying the old loan, but new loan will continue once again. Should they do it or should they not do it? They should not have done it. So check whether these kind of transactions are done. Loan has fallen due in the current year, but instead of collecting on the money, they have either renewed it, extended it, or have given the fresh loan to same person. If the answer is yes, we need to check what is the aggregate amount which has been given. What is the aggregate amount of such dues which are renewed, extended, or fresh loans given, and even you have to calculate percentage. Basically, you have to calculate what is the total loans given during the year. Say for example 100 CR. Out of that, 30 CR is in the form of extension or fresh loan to the same person. 30% it will come. That percentage also you have to mention. However, this point is also not applicable if the company's principal business is to give loans. Here also they are talking about NBFCs. Next, demand loans without repayment period. So you need to check whether your client company has given the loan without mentioning any repayment period. We generally call them as demand loans. So is that good thing or bad thing? That is a bad thing. Without mentioning the repayment period, just like that, if they are giving the loans, that is not acceptable. That is against the term. That is against the terms of the. That is prejudicial to the interest of the shareholders. So, in case if your client company has given any loan which is repayable on demand or without mentioning on repayment period, without mentioning any repayment period, we need to specify what is the total amount of such demand loans, and also we have to calculate percentage, like the way we have calculated the total percentage with the total loans, that percentage also we have to calculate, and we need to mention separately what is the amount of such a demand loan given to promoters and related parties. So these are the 6 points which are required to be reported regarding investments, loans and guarantees. What are they? Number 1, first we have to do segregation for related parties for other than related parties. Number 2, we need to check repayment, terms and conditions. Third one, schedule of repayment. Fourth one, overdue for more than 90 days. Fifth one, renewal or extension or giving the fresh loan to the same person. Last one, demand loans are getting given there. Clear? Next. Fourth point is also talking about loans, investments and guarantees made by the company. This is also loans given by the company only. In case if the company has given any loan, they can't give whatever amount they want. There are certain calculations, certain limits which are given under section 185 and 186 of the Companies Act. We need to check whatever loans which are given, those are in accordance with the limits of 185 and 186 or not. Then, in case if your client company has accepted deposits, fifth point is regarding deposits. In case if your client company has accepted the deposits, we need to check provisions of section number 73 to 76 have been complied with or not. With regard to acceptance of deposits, even RBI also will give guidelines. We need to check whether that guidelines of the RBI has been followed or not. In case if there is any guidelines given by company law board or any court or tribunal, even that guidelines are also followed or not. If any kind of non-compliance is there, the nature of that contraventions is also required to be reported. Understood? Next. Sixth point is regarding maintenance of cost records. See, not every company is required to maintain cost records. Only those companies which fulfill the criteria given under section 148, they are required to maintain cost records. You need to check whether your client company is fulfilling the criteria given under section 148. If yes, whether that cost records are maintained or not. Then, seventh point is regarding statutory dues. What do you mean by statutory dues? Those amounts which you are required to pay because of some law, like PF will come there, ESI will come there, GST will come there, income tax will come there. So all these things will come under statutory dues. For the purpose of reporting requirements, statutory dues are divided into two categories: undisputed, disputed. What do you mean by undisputed? There is no differences. Yes, there is no conflict between the departments and authorities or the client. If you receive a notice from the income tax department, will that be considered as dispute? If your client has received income tax notice saying that they are required to pay 1 lakh worth of income tax, can we call that as dispute? No, just receiving the notice is not a dispute. If you are challenging that notice, you received a notice and you say, no, I am not liable to pay, you are challenging, then the dispute will start. Just receiving a notice will not be considered as dispute. Similarly, a mere communication with the tax authorities, you got some doubt whether on this income tax will become, whether on this GST will become applicable or not. You went and consulted respective tax officers. So can that be considered as dispute? No. A mere representation, a mere receipt of notice can't be considered as dispute. In order to consider it as a dispute, there should be conflict. There should be conflict, then only dispute will start. So when there is undisputed dues, that means you are required to pay some amount. You also acknowledge it. You don't have any difference of opinion, but you still did not pay. So regarding that undisputed dues, what you need to check? So I need to check whether company is regular in depositing all the undisputed statutory dues. That means regular in the sense paying on or before the due date. If not, no, your client has not paid any statutory dues. Regarding that, dispute is also not there. Then you need to comment those amounts, those things, those arrears of outstanding statutory dues as at the last day of financial year concerned for a period of more than 6 months. From the date they become payable till the balance sheet date, if they are still not yet paid, and if they have remained overdue for more than 6 months as on the balance sheet date, only those amounts you are required to report. Say for example, 24-25 financial year, what is the balance sheet date? 31st of March 2025. For the month of January 2025, the client is required to pay 5 lakh rupees of GST. He did not pay it till 31st of March 2025. No dispute is also there. Is this amount required to be reported? Is this amount required to be reported? No. Undisputed statutory due, agreed, but it is not outstanding for a period of more than 6 months as on the balance sheet date from the date it becomes payable. Some amount, say for example, this client is required to deposit some TDS for the month of July 2024. But he did not pay it till 31st of March 2025. Amount is 10 lakh rupees. Is this amount required to be required to be reported? Yes. Undisputed statutory dues which remained outstanding for a period of more than 6 months as on the last day of the financial year. Yes, you are required to report it. Understood. So this is regarding undisputed. Sir, what if there is a dispute? I'm not paying some statutory due. Why I am not paying is because there is a dispute. There is some case going on. In respect of disputed dues, you need to comment on two things. You need to mention in your CARO report what is the amount involved in the dispute, the forum where the dispute is pending. What do you mean by forum? Before which authority the case is pending. Like, is it pending before officers? Is it pending before commissioner? Is it pending before tribunal? Is it pending before high court or supreme court? That forum also you are required to mention. So till now, how many reporting requirements we are done? 7 we are done. So first one, PPE. Second one, inventories. Third one, loans, investments, guarantees. Fourth one is also regarding loans and investments. Fifth one, deposits. Sixth one, cost records. Seventh one, statutory dues. Now coming to the eighth one, which is talking about disclosure of undisclosed income. Now what does this point say is, during the financial year, some income tax assessment happened. Your client has undergone some income tax assessment. What do you mean by income tax assessment? Might be your IT return has been taken up for scrutiny, or income tax raid might have taken place. So some kind of assessment has taken place under Income Tax Act. As a part of that assessment, your client has offered some undisclosed income. Previously, he has hidden some income from the taxation. That income he has offered it. He surrendered the income now. Okay. So now what they say here is, if you are disclosing undisclosed income to the tax authorities, that alone will not be enough. This income you might have excluded from your books of accounts also. Whether the same has also been brought into the books of accounts or not, you need to check. So basically, in order to fulfill this reporting requirement under this point, first you need to check whether any tax assessment has taken place. If no tax assessment, no reporting requirement. Yes, tax assessment has taken place. Then you need to check whether your client has surrendered any previously undisclosed income. Yes. Then you need to check, have they brought the same also in the books of accounts. Whether not, if not, then you are required to give a negative comment here. Understood. Next, ninth point. See, till now they have given so many points regarding loans given by the company, but they did not speak about loans which are accepted. So now they have given even regarding loans which are accepted by company. So here also they say 6 things. Number 1, whether your client company has made a default in payment. What do you mean by default? Two things. Not even paying. You did not pay altogether. That is a default. You paid it after due date. That is also default. So you need to check whether your client has made any default in the repayment of the borrowings. If yes, you need to provide the amount of default and the period of default, that to each lender wise. Lender wise, not total amount. For each lender, what is the amount you have made default and how long, for what period you have made the default, lender wise you have to report. Next, willful defaulter. Whether your client has been declared as willful defaulter by any bank or financial institution, you need to comment. How can you get to know? Credit reports, CIBIL scores. If you check that, then you will get to know whether your client has been declared as a willful defaulter. Third one, purpose of term loan. So that means your client will go and tell some convincing purpose to the bank and get the loan. But after getting the loan, instead of using it for long term purposes, he will instead of using it for the set purposes, he will start using it for other purposes. So many companies have gone bankrupt because of these things. So they get the long term loans stating some purpose, but they use it for some other purposes. So as an auditor, because of that, bankers' interests are getting affected. To protect the interest of the banker, they have put a responsibility on the head of the auditor to go and check whether your client has taken any long term loan. For that, they might have set the purpose. For that, you need to go through the loan document and you need to check what, for whatever purpose they have got the term loan, whether they are using it for the same purposes or they are misusing it. Next, usage of short-term loan. This is also more or less same like previous thing. Today, access to short-term loans is very, very easy. Even you also can get the short-term loan by personal loan by showing your PAN card. So getting off short-term loans has become very easier, but whenever you get the short-term loan, that you should use it only for short-term purposes. You should not invest it in long-term purposes. That will result in something called liquidity crunch. Liquidity crisis will be there. So you need to check whether your client has got any short-term loan. In case if they have got the short-term loan, are they using it for short-term purposes or they are using it for long-term purposes? You need to check and give a comment. And loans taken to meet subsidiary company needs. Whether your client company has taken a loan, but not for meeting the expenses or obligations of your client company, but for meeting obligations of subsidiary company. So that you need to check it. And not just that, whether your client company has taken loan for your client's purposes only, but for taking the loan you have to give something as a security, no, have to offer some security. What your client has done is, whatever shares they are holding in the subsidiary company, that they have pledged it and got the loan. For the company's requirements only, they got the loan, but the security what they have offered is they have pledged the shares which they are holding in subsidiary company. What did they say in the previous point? Your client has got a loan not for the client's purposes, but for meeting the obligations of subsidiaries. That also you are required to report. Your client has taken loan for your client's purposes only, but by pledging the shares of subsidiaries. That also you are required to report. Understood? So 6 points regarding repayment of loans. What are they? Number one, default in the repayment, whether your client has been classified as willful defaulter, whether the term loans were used for the intended purposes, whether short term loans are used for long term purposes, in whether your client company has taken any loan to meet the subsidiary company's needs, whether your client company has taken loan by pledging the securities of subsidiaries. Clear? Next. Coming to the next thing, utilization of IPO or FPO. So whether your client has raised any money by way of IPO or FPO. When they are raising the money by way of IPO or FPO, they will mention the purpose. So now I need to check whatever money they have raised by way of IPO or FPO, whether they are using it for intended purposes. How you will get to know about the purpose? Exactly. So you have to go through the prospectus. In that, purpose will be clearly mentioned. You have to get through the prospectus, understand the purpose. Then you need to check whatever money that has been raised, whether it is getting used for stated purposes. If not, you need to report delays, defaults, and even subsequent rectification. What do you mean by subsequent rectification? Initially they have misused it, later they have compensated it. Even that subsequent rectifications are also required to be reported. Under the same point, we have one more thing: preferential allotment or private placement. What is the difference between IPO, FPO, and private placement? IPO is allotted for everybody. Private placement is also a method for raising the funds, but shares will not be allotted to everybody, to only a specified group. So in case if the company is raising the money by way of private placement or preferential allotment, there also I need to check whether the provisions of section number 42 and 62 have been complied with. Whatever money that you are raising for by way of IPO, FPO, there also prospectus will be there. We need to check whether that amount is used for the said purposes. If not, provide the details for what other purposes they have used it, how much amount they have misused it, that you are required to report. So this is what regarding utilization of IPO and FPO. Now, coming to point number 11. So what is that? Reporting of fraud. See, whenever you came across a fraud, you are required to fulfill some reporting requirements already under 143 subsection 12. In some cases, you are required to report to central government. In some cases, you are required to just report to the audit committee or board of directors. In addition to reporting requirements under 143 subsection 12, if you come across any fraud, you are also required to comment under para number 11 of CARO. So what here I have to report? Let us see whether any fraud by the company or on the company has been noticed or reported during the year. If yes, nature and amount involved in the fraud has to be indicated. So is any fraud noticed or reported during the year? If yes, you have to comment under para number 11 of CARO. What is the nature of the fraud? What is the amount involved in the fraud? But there is a difference in reporting requirements under 143 subsection 12 and para number 11. The differences are: under 143 subsection 12, if you read the phrases, they say if you have a reason to believe. What they say? If you have a reason to believe. It need not be a noticed fraud, it need not be a reported fraud. If you have a reason to believe, you are required to report that fraud. But to fulfill the reporting requirements under CARO, they use the phrase the fraud which has been noticed or reported. That means proven fraud. Even if you have a suspicious fraud also, you are required to report it to the central government under 143 subsection 12. But under CARO, you are required to report only noticed or reported frauds. Point number 1. Second point. See, under CARO, under 143 subsection 12, if the amount involved in the fraud is 1 crore or more, you are mandatorily required to report to central government. Whether that 1 CR is material or not, you should not check it. You are conducting audit of a Reliance Industries Limited. You came to know 1 CR amount of fraud. Is that material? But still, are you required to report to the central government? Yes. But while reporting under CARO para number 11, you are required to report only material frauds. Immaterial frauds, you can ignore it. Understood? So two important points of difference. Under 143 subsection 12, it need not be a proven fraud. Even if you have reason to believe also, you are required to report under 143 subsection 12. But only noticed or reported frauds are required to be reported under para number 11 of CARO. And under 143 subsection 12, whether material or immaterial, you have to fulfill your reporting requirements. But under CARO, you are required to report only material frauds. Clear? Next. Whether any reports under 143 subsection 12 has been filed by the auditor in form number ADT4. So whether any of the auditors, see whatever reporting requirements we have seen under 143 subsection 12, they will not just become applicable to company auditor, they will also become applicable for cost auditor, they will also become applicable for secretarial auditor. So I need to comment in my CARO whether any of the auditors have submitted ADT4 under 143 subsection 12. And also whether there are any whistleblower complaints during the year. If yes, whether auditor has considered that whistleblower complaints or not. So these three things are required to be reported under para number 11. Important, many times asked. Next. 12th point is regarding Nidhi company. In case if your client company is a Nidhi company, then you are required to fulfill reporting requirements under para number 12. What if your client is not a Nidhi company? You can simply mention that the client is, we are not a Nidhi company, you can say. But in case if your client company is a Nidhi company, then you are required to report on 3 points. Number one, whether they have a net owned funds to deposits in the ratio of 1:20. That is, for every 1 rupee of net owned funds, they can accept a maximum deposits of 20 only. Next, whether Nidhi company is maintaining 10% unencumbered term deposits of whatever total deposits they have received, 10% they should keep it in unencumbered. That means without any charge, without offering it as security for any loan, they have to keep it in the term deposits. And also whether if there is any default in payment of interest on deposits or repayment thereof any period, if so, the details thereof. Have they made any repayment of interest or repayment? See, in this point here you have to give only comment. You need not mention what is the amount of default, what is the period of default. You need not say, just you have to mention whether any default has taken place. That's all. Why? Because they would have already mentioned, they would have already given the details in point number 9. If you go to point number 9, repayment of loans, first point what they say, whether your client company has made any default in repayment of loans. If yes, what is the nature of, what is the amount and period of default. Lender wise anyhow they will give. So that's why in para number 12, once again, you need not give amount and period details and all. Just you will mention the fact whether default has been made or not. That if you mention, it will be enough. Details anyhow we will give it in para number 9. Understood? Next. Related party transactions. You need to check whether your client has entered into any related party transaction. If yes, we need to check compliance with the provisions of section 177 and 188. And also there are so many disclosure requirements as per accounting standards regarding related party transaction, whether all that disclosure requirements are met or not, that also we need to check it. Next, 14th point, you need to check whether your client is having appropriate internal audit system, and that internal audit system should be commensurate with the size and nature of its business. Even internal audit is also not mandatory for all the companies. It becomes applicable only as per section 138, a few companies which fulfill criteria. If yes, you need to go and check whether your client is having internal audit team, and size of the internal audit team should be matching with the company. Companies Reliance, they have an internal audit team. In the internal audit team 2 people are there. Is it matching with the size of the company? No. Next, whether the reports of internal auditors for the period under review were considered by the statutory auditor. Sometimes as a statutory auditor, you can use the reports of internal auditor for your decision making, for your opinion. Have you used the internal audit reports? That also you need to give a comment. Next, whether your client company has entered into any non-cash transactions, that too with the directors. If yes, you can't do it in whatever manner you want. You should have complied with the provisions of section 192. So you need to check the compliance there. Then coming to the 16th point, NBFC. This point will become applicable if your client is a NBFC. If not, you can mention the fact my client is not a NBFC, reporting requirements under this clause will not become applicable. So when it comes to NBFC, 3 things. You need to check whether your client is required to get registration under 45 IA of Reserve Bank of India Act. If yes, whether they have obtained registration or not. Number 2, whether your client company is conducting any non-banking financial or housing finance activities without obtaining a certificate of registration from RBI. Third one, whether your client company is a core investment company, CIC. After becoming NBFC, if you fulfill some conditions, you will get one status, CIC. So you need to check whether your client company is a CIC. If yes, whatever conditions which are required to be fulfilled to enjoy that CIC status, they should continue to fulfill it. So long it is not just like one time you have complied with the conditions, you got CIC status, then you can't ignore it. So long as you enjoy that CIC status, you have to continuously fulfill that criteria. So whether that criteria is getting fulfilled or not, we need to check. Not just that, see here what they say here is, once you are NBFC, if you fulfill some 10 conditions, you will get the status of CIC. After becoming CIC, if you fulfill some extra 5 conditions, you will get something called exempted CIC status. So if my client is just a CIC, I need to check compliance with that 10 conditions. If my client is a exempted CIC, I need to check 10 plus 5, 15 conditions compliance. And if my client is a very bigger group, so many subsidiary, associate, joint venture, holding companies are there. As a part of that group, is there only one CIC or is there more than one CIC? Like holding company is also a CIC, subsidiary is also CIC, associate is also CIC. If the group contains more than one CIC, we need to mention how many number of such CICs are there in the entire group. So that is what third point is about. So 3 things regarding NBFC: whether they require registration under 45 IA of the Reserve Bank of India Act, whether the client is doing any non-banking financial or housing finance activities without obtaining certificate of registration, whether your client is a CIC or exempted CIC. If yes, they are fulfilling the conditions. And as a part of the group, do you have one CIC or more than one CIC? If you have more than one, mention that figure. Next. 17th one, cash losses. Whether your client has made any cash losses in the current financial year and also in the preceding financial year. When I say cash loss, do I mean loss as per the statement of P&L? That is not loss as per the statement of P&L. You have to take the profit or loss figure from the statement of P&L, add non-cash expenses, reduce non-cash incomes, then you will get a figure called cash loss. They should have made a cash loss in the current year also. They should have made a cash loss in the previous year also. Then you are required to report it. Understood? Clear? Next. Resignation of auditors. You need to check whether any of the statutory auditors have resigned. If yes, you need to consider because of what issues, what objections or what concerns they have resigned. That issues you have to consider once. Then information about financial assets and liabilities. See, this is one such points. Basically, as an auditor, we will express our opinion on historical financial information. But this one point is an exception. So now, because of inserting this point, because of this point number 19 in CARO, we are required to express our opinion on future also in one aspect. So nothing but what they say here is, you need to give your opinion. You need to give your opinion regarding one thing. What is that opinion is? Whatever whatever liabilities are there, liabilities are there as on the balance sheet date which fall due within a period of 1 year. From the balance sheet date, whatever liabilities which fall due within 1 year, basically whatever current liabilities are there, is the company is in a position to pay that current liabilities, or do they have any material uncertainty? You are required to give a comment. Is the company in a position to pay their liabilities which fall due within 1 year from the balance sheet date, or is there any doubt, is there any uncertainty? Sir, and on what basis I have to give this comment, sir? So on the basis of considering various information. What and all information you have to consider? On the basis of considering the ratio analysis, by doing aging and expected dates of realization of financial assets and payment of financial liabilities. Basically, when you will collect from your debtors, when you are required to pay to your creditors, you should do that aging analysis and all other information accompanying the financial statements. So, and also by sitting with the board of directors and getting understanding and knowledge of what are their plans for future. So by on the basis of all this, by doing ratio analysis, by doing aging of financial assets and financial liabilities, by using information accompanying the financial statements, by using all this information, you are required to comment, is the company in a position to pay their liabilities which fall due within 1 year from the balance sheet date, or is there any material uncertainty existing? But however, this is also not a guarantee. This is just an opinion, and this opinion can even go wrong also. Clear? Next. 20th point, unspent CSR expenditure amount. Now, as we all know, a few companies are required to spend 2% of their average net profits of the last 3 years on social welfare. So regarding the social welfare, there are certain things which we need to check and give a comment. So first point they say, whether in respect of other than ongoing projects, the company has transferred unspent amount to a fund which is specified in Schedule 7 to the Companies Act within a period of 6 months of the expiry of the financial year. So what is this is? Say for example, there is one company X Limited. They are required to spend some 2 CR on corporate social responsibility for the financial year 2024-25. So now they need to plan. I'm not telling they have to spend, they have to plan. So they have to plan how they are going to spend this money within 6 months from the end of the financial year. That is on or before 30th of September 2025. They should have plan ready. I'm not telling they should have spent it. They should have projects ready. Say for example, the company has decided out of this 2 crores, 50 lakhs they will give it as a donation to old age home. Some another 50 lakhs they will give it as a donation to orphanage. And using some 80 lakh rupees, they will do a construction of a school in a rural area. These plans they have, these projects they have by 30th of September. But 30th of September is over, balance amount what they have to do, they are not able to determine. Total how much amount they have to spend? 2. How much they have decided for how much amount they have a project? 1.8 CR. Balance of 20 lakh rupees, they are unable to decide a project. So what they should do is they should transfer this amount to a fund which is specified under Schedule 7. Under Schedule 7, they have specified various funds like Prime Minister National Relief Fund, so PM Cares Fund, like that. Some funds they have specified. To that fund, you have to transfer the money. That means if you are unable to decide what you are going to do within 9 months, give that money to the government. Government will take care of it. Once the money goes to the government, there is no coming back. Once you transfer to the fund, there is no coming back. That will be handed over to the government. So you need to check if any such amount is there relating to other than ongoing project, whether that has been transferred to a fund specified in Schedule 7 within 6 months or not. That is the first point. Now in the second point, what they say here is, whether any amount remaining unspent under 135 subsection 5 pursuant to ongoing project, relating to ongoing project. So now we have plans ready for how much amount? 1.8 CR. So out of that, 50 lakhs they want to give a donation. They have written a check, give the donation. 50 lakh rupees they have to give a donation to orphanage. For that also they have written a check and gave it. 80 lakh rupees they want to use it for construction. But construction is not going to happen in a day or two. It is going to take a significant amount of time. So 80 lakhs is there. Yes, I have a project also ready. I'm going to use it for a specified project. But it will take some time for me to spend this amount. Till the time you spend this money, you have to keep it in a separate bank account. You have to keep this money in a separate bank account. You are not required to transfer anybody. Just go to the bank, open a CSR account. In that CSR account, you have to keep the money, and that money will be under the control of company only. Who will spend that money? Company only will spend the money. For what purpose they will spend the money? For that project only they will spend the money. But just they have to segregate that funds from normal funds. That's why they are asking you to keep it in a separate bank account. Whether they have kept it or not, I have to check and give a comment. Clear? So two things regarding CSR expenditure. Number one, if you don't have any project ready within 30 days from the end of the financial year, transfer it to fund. If you have a project ready, but it is taking some time to spend, then you have to transfer it to a separate bank account. Whether these requirements are fulfilled or not, I need to check and give a comment. So these are all the matters which are required to be reported. 20 matters are there. Now we have one more matter, which is 21st matter. This 21st matter will come in the audit report of consolidated financial statements. So basically what they try to say here is, if you are conducting audit of the consolidated financial statements, say for example X Limited, which is a holding company, it is having some 4 subsidiaries, it is having some 2 associates, 1 joint venture. Now this company will prepare consolidated financial statements. For these consolidated financial statements also audit report will be given. In that audit report, CARO heading will be there, but in that only one point will be commented. So what is that is, this auditor, whoever is conducting audit report of the consolidated financial statements, he should go through individual audit reports of the entities whose financial statements are included in the consolidated financial statements. I told 4 subsidiaries are there. These 4 subsidiaries will have their own standalone financial statements and they will have their audit reports. No, go through that audit reports. Check whether in any of their audit reports, in the CARO section, whether any point contains a negative remark. Whether any point contains a negative remark. Say for example, out of 4 subsidiaries, subsidiary number 2, in that, okay, so in that second subsidiary company which is included in the consolidated financial statements. In that audit report, when the auditor has gone through it, he found that in the CARO report, somewhere in the paragraph number 11, there is some negative comment. That respective auditor has given some negative comment regarding fraud. So now what you should do is, in this audit report on the consolidated financial statements, you should say so and so company, say for example Z, so and so company Z, which is a subsidiary. In their audit report, para number 11 contains a negative remark. So that you have to give where in the audit report of consolidated financial statements. So basically you have to go through individual audit reports of those companies which are included in the consolidated financial statements. Check in their CARO reports whether any point contains negative remark. If yes, give that details in the audit report of consolidated financial statements. Understood? Clear and comfortable, everybody? So with this we have completed all the 21 matters which are required to be reported under CARO. Okay, right. And these 21 matters are required to be reported whether you have a positive comment or you have a negative comment, it doesn't matter. So it is mandatory to report all these matters. And in case if you are giving any negative remarks, explain the reasons also. In case if you are unable to comment on any on this of any of this point, even you have to mention the reasons why you are unable to comment on this point. What circumstances led you to not express an opinion on that point, that also you are required to mention. Understood? Right. Next. So this also we are done. Now what else is left out from this chapter? Essay 299. Small standard is there. We will try to complete it. So essay 299, which is going to talk about the concept relating to joint audit of financial statements. So what is the meaning of joint audit? Guys, maintain silence. So what is the meaning of joint audit? So when more than one auditor is conducting an audit of single entity for the same financial year, for this having the same scope of work, and for the same financial year also, for the same duration, for the same entity, and also having the same scope of work. So when more than one auditor has been appointed to conduct audit of the same entity for the same financial year and also having same scope of work, that engagement we call it as audit, so joint audit engagement. So I will give you a few examples. You let me know whether that will fall under joint audit engagement or not. Say for example, there is, I will give simple examples anyhow, I will give you some complicated examples. There is a company X Limited. There is a principal auditor who is conducting audit of the entire company, Mr. A, and there is a branch auditor, Mr. B, who is conducting audit of only one particular branch. Can this be called as joint audit assignment? Why? Because more than one auditor is there for same entity for same financial year, but the scope of work is different. Principal auditor will have its scope as entire company. The branch auditor will have only branch as a part of his scope. So that's why this can't be called as joint audit. So now let us say, for example, for a company for one financial year, there is a person, Mr. A. But this is a company X Limited. For the financial year 25 or 24-25, Mr. A has been appointed as company auditor. For the same financial year, Mr. B is also appointed as a company auditor only. Can we call this assignment as a joint audit assignment? Yes. Why? Because more than one auditor for the same financial year and also having same scope of work. Yes, this will 100% fall under joint audit definition. So there is a firm for the financial year 24-25. There is a firm ABC & Co which has been appointed as a company auditor. For the same financial year, Mr. Z, an individual chartered accountant, has been appointed as a company auditor. Can this also be called as joint audit? Yes. So more than one auditor. Basically, that could be more than one individual person, more than one audit firm, or it could be a combination of individual and an audit firm. So all that assignments we call them as joint audit assignments. Will joint audit assignments really happen? Yes, they do really happen. So Reliance is a joint audit. Auditors, partners from two different firms will sign the audit report of Reliance Industries Limited. So you can find it here also in the audit report. We go at the bottom. See here, two firms are there: DTS and Associates LLP, SRBC and Co LLP. Two different firms, partners from two different firms have signed the audit report. And even banks like this corporation, statutory corporations, SBI is a joint audit. So 14 joint auditors, 14 audit firms would have signed the audit report of SBI. So yes, joint audits do really happen, but it is not a statutory requirement. There is no law, no standard which says so and so company has to undergo joint audit. They did not say that. It is completely the decision of entities. Okay. So now, once again, as I have told, any business will not spend the money unnecessarily unless they find some benefits. If some entity is undergoing joint audit, they will definitely do it only when they find some benefits in it. So, what are the benefits of joint audit? What are the advantages of happening of joint audit? So number one, sharing of expertise. See, work done by one professional, the same work done by two professionals. So more expertise you will have. Work will get completed in less amount of time. Ultimately, the client is going to get a better service, and also it will promote healthy competition between the auditors. Generally, that will not happen. Unhealthy competition will get developed. But yeah, so it is a opportunity for promoting healthy competition and better quality of the service. So all these advantages are there. So that's why the companies are opting for joint audit. But this joint audit will not just come up with advantages, it will also come up with many disadvantages. What are the disadvantages? You have to share your fees. Very good. You're on point. All right. All right. So fees will have to be shared. Nothing but previously last year you have done audit single-handedly. You have got 10 lakh rupees of fees. But this time you are doing, you have to share the audit with another auditor. Will they cut half, 5? No, that's not how the things work out. So last year, if you have got 10, current year you might get 7, 7, 8, 8. That's how you get. But whatever it is, the share is getting reduced, no? So sharing of fees. And also, see, this is the disadvantage from the chartered accountant's perspective. So lack of cooperation. If I have to put it in simple terms, the joint auditors might not cooperate with each other. They have something called superiority complexes, ego complexes they will have. And sometimes you might have to face the consequences because of others' mistake. If other joint auditor has done the mistake, you might be required to face consequences. So like this, joint audits also will come up with disadvantages, but advantages are outnumbering the disadvantages. So that's why the companies are opting for joint audits. Okay, we understood advantages and disadvantages. Now let us try to understand how the work mechanism will be, how the joint auditors will perform the audit. See, when I say joint auditors are appointed, for Reliance, two joint auditors are there. Does that mean both will do two times audit separately? That is not the purpose. So when the joint auditors are appointed, generally how the work will happen is the work will be divided among joint auditors on some suitable basis. On some suitable basis, the work will be divided. On what basis work will be divided? So it could be on the basis of geographical locations. Like one joint auditor is saying, I will look after the northern states. One joint auditor is saying, I will look after the southern states. Or the work could be divided on the basis of period of the financial statements. One joint auditor is saying, I will look after first 6 months. Other joint auditor is saying, I will look after the next 6 months. Or it could be divided on the basis of products. If the company is doing multiple products, on the basis of businesses also they can divide it. Like one person might say, I will look after petroleum and retail segment. Other person can come and say, I will look after telecommunication and fashion segment. And it could also be divided. What else? What did I say? Three things. Identified units, that means businesses only. On the basis of geographical locations, that also we have covered. On the basis of a period, one more thing should be there. Products also have covered. Product or businesses is same. On the basis of elements of financial statements. So basically, you do assets, I do liabilities on the basis of items of the financial statements. Also, you can divide it. So whenever joint auditors are appointed, the first thing what they do is they divide the work among themselves on some suitable basis and get the work done. Now, what about responsibility? What about responsibility? There are two kinds of responsibility. There will be separate responsibility and there will be joint responsibility also. So when there will be separate responsibility, generally you are dividing the work on some suitable basis. Each joint auditor will be made responsible only for the work which was allocated to him. Like the work was divided on the basis of period of the financial statements. Auditor A was doing first 6 months, auditor B was doing next 6 months. That is, A is doing from April to September, auditor B is doing from October to March. They have done the audit, they have given their opinion. They have both of them have given unmodified opinion. Later it was found out that there was one big fraud which has taken place in the month of August, which auditors were not able to identify. So who has to face the consequences? Only A has to face the consequences. So generally, in normal circumstances, whenever the work is getting divided, each joint auditor will be held responsible for work which was allocated to him, work which was divided to him. But however, there are certain circumstances, in certain cases, there will be joint responsibility, which means everyone has to face the consequences. So, what are that circumstances where there will be joint responsibility? Number one, in case of those work which is undivided, if some work is not divided, either they might have forgot or intentionally they did not divide it, whatever could be the reason, if some undivided work is there, if in that work something has gone wrong, who has to face the consequences? Everybody, all the joint auditors have to face the consequences. Number two, decisions taken by all. If some decision has been taken by all the joint auditors collectively and something has gone wrong in that decision only, who has to face the consequences? Everybody, all the joint auditors have to face the consequences. Third one, matters which are brought to the notice of the joint auditors, of all the joint auditors. Like say for example, 14 joint auditors of SBA. They are all conducting the audit. They have divided the work on the basis of states. On the basis of states, they have divided the work. Now these 14 joint auditors have created a WhatsApp group. They have created one WhatsApp group for the purpose of communication. So one of the joint auditor to whom Andhra Pradesh state is allocated, he found out some big fraud in the AP state. So now what he has done is he did not keep that to himself. He has posted in the WhatsApp group. He has posted in the WhatsApp group. And everybody has seen it also. Everybody has seen it, but no one took the action. When they are discussing about the opinion and all, the person to whom that AP location was allocated, he remained silent. He told, I will give unmodified opinion. Since he is only not taking action, rest of the people also told, okay, we are also have no objection, we will also give unmodified opinion. Now everybody gave unmodified opinion. Finally, the fraud was exploded. So now who has to face the consequences? All. Sir, it was allocated to one person, no. But that useless fellow did not keep that mistake to himself, no. He has brought it to the notice of everybody. Since he has brought it to the notice of everybody, who has to face the consequences? We all have to face the consequences. That's what I told, one of the disadvantage. So there will be uncertainty for liability. Because of others' mistake, you should also face consequences. And also one more area where where all the joint auditors will have responsibilities in checking whether the financial statements are prepared as per applicable financial reporting framework or not. So whatever financial statements are there, whether they are presented properly, schedule 3 is fulfilled properly or not, disclosures are given or not, that is a responsibility to check on everybody. Even if you allocate that work to someone, but still some mistake is there, who will be held responsible? Everybody will be held responsible. Finally, whatever audit report you give, whether that audit report is as per relevant statute or not, basically whether your audit report is as per standards on audit or not, checking that is also responsibility of everyone. So if in that matter something wrong happens, everybody will have to face the consequences. So these are the few cases where there will be joint responsibility. Understood? So what are they? Number one, undivided work. Number two, collective decisions. Number three, matters brought to the notice of everyone. Number four, financial statements are as per applicable financial reporting framework. Number five, whether audit report has been given as per the standards, as per the relevant statute or not. So in these cases, there will be joint and collective responsibility. Now, what about opinion? How the opinion will be framed? See, 14 joint auditors are there. Will they give 14 audit reports? Generally, what will happen is once audit has been completed, all the joint auditors will sit together. They will have a mutual discussion. They will arrive at one common conclusion. A kind of voting will happen. So now when they sit for discussion, they will say which opinion you wanted to give. Say for example, all the 14 joint auditors say, I don't have any objection. We all want to give modified opinion. Then what they will do is they will prepare one single audit report. On that audit report, all the 14 auditors will sign and that report will be issued. But sometimes what will happen is there will be conflict. So 13 people out of that 14 people, 13 people are saying unmodified opinion. One person is there who is a freshly qualified chartered accountant. He want to show all his talent in the first audit only. So he found one misstatement that is not material. He also know it, but he, as I've told you, know that urge will be there. So in the initials, yeah, superiority complex will be there. He is going to everybody. He's going to all other auditors and arguing. Hey, I found a misstatement. It is a material misstatement. I will give modified opinion. I will copy from the appendix. I will say, I will show all my caliber and all he's saying. The rest of the 13 people are telling, I know you are a, rest of 13 people are telling, you are a bacha, we know. Just now you came to the industry, but that is not a material misstatement. Don't get so excited. We can give unmodified opinion, they are saying. But this fellow is not agreeing only. So what he should do? Should he go with the majority? No. So here there is no democracy. There is no rule of majority in the case of opinions and all. So what they have told is, in case if there is any difference of opinion, no one is required to go with the majority. Then what he will do, sir? Then what he will do is, those 13 people, they will give one audit report which contains an unmodified opinion. And this one person, what he will do is, he will give a separate report in which he will give a modified opinion. So now there will be two audit reports for the same entity. And whenever they are giving two audit reports, in each audit report, they should give a reference to the other report. Like 13 auditors are giving unmodified opinion. No, in that report, they will say, this is our report of 13 auditors. There is one more audit report which is given by one joint auditor. Similarly, this one joint auditor also will say in his audit report, this is my report. We have 13 other joint auditors. They have given another report. References should be given. So now the management will get two audit reports. Which one they have to circulate? Both they have to circulate. Very good. This will be circulated to every shareholder. Which one shareholder has to rely? Leave it to his headache. That he will decide. See, we will pass on the information to the shareholder. He will read the report. He will read 13 people have told unqualified opinion, one person is telling qualified opinion. He will read the reasons also. Basis for opinion, reasons will be there. So he will decide. If he also feels that is a bullshit reason, he will tear that opinion and throw it in the dustbin. Rely on the 13%, that rely on the opinion of the 13 people only. So let the shareholder decide what he wants to rely. But the company will have a responsibility to share the audit report of both. Okay, so let the shareholder decide which information he wants to rely. So this is what regarding opinion, and this is what regarding circulation. Now one more last thing which we need to understand is special considerations. There are some special things which you have to keep in mind when you are conducting the joint audit. There is no such special thing as such. Whatever normal things which you do individually, that you have to do collectively in the case of joint audit. See, when we are doing normal audit, if we are the only auditor, we are doing the audit, we develop a audit strategy, audit plan, audit program and all. If joint auditors are doing, what they should do? Everybody should participate. Engagement team and engagement partners and key engagement team members from all the joint auditors should participate. They should have one collective audit strategy. They should have one collective audit plan, and they should have collective audit program. Now, as we have seen, auditor is required to prepare engagement letter and share it with the client. Do you think all the 14 auditors will give separate engagement letters? No, all of them will collectively prepare one engagement letter and give it to the client. And also, there are various matters on which management is required to give written representation. Do you think management will give written representation separately for all the 14 joint auditors? No, they will address all the joint auditors collectively and give one single written representation. And also, these people are dividing the work among themselves. No, they have to document it on what basis they have divided the work, which person has taken care of which work. If there is any undivided work, what common audit procedures they have done in that undivided work that you need to do. And there should be one proper work allocation document. That work allocation document should be signed by all the joint auditors. One copy should be even given to those charged with governance also. Clear? So that is what some special things. Basically, whatever things you do independently, that you have to do collectively if you are doing a joint audit. Like as you see, the engagement partner and other key members of the engagement team from each of the joint auditors should be involved in the planning. They should establish one joint overall audit strategy, and they should discuss and develop one joint audit plan. So while developing that audit plan, they need to consider these areas. This is a repetition from audit strategy planning and program. The same points will be there in the audit strategy planning and program. There I will try to link it if the time permits. But anyhow, this is same thing will be there. There you will find, while establishing overall audit strategy, there are 5 things which you need to consider. The same 5 things we will consider while establishing audit strategy in the case of joint audit also. But we do it collectively. That's the only point of difference. Then each of the joint auditor should consider and assess the risk of material misstatement. Everybody should do risk assessment and communicate what risk they have assessed with others. And they should discuss and document nature, timing and extent of audit procedures for common and specific allocated areas. They should get one common engagement letter. They should get common management representation letter, and the work allocation document should be signed by all the joint auditors, and it has to be communicated to those charged with governance. Understood? That's all. This is what regarding essay 299. With this, we have completed audit reporting chapter. Okay, right. So we'll do one small chapter now, so which is audit documentation and audit evidence. This we will try to do. So small chapter, hardly it will take somewhere around 40 to 45 minutes to complete this chapter. So let us try to do it. So this chapter is going to talk about 2 concepts. One is regarding audit documentation, and the other one is regarding audit evidence. So first we will try to focus on audit evidence. So audit documentation related discussion has been taken from SA 230, whereas audit evidence related discussion we have taken it from SA 500. So we are going to cover two standards here, SA 500 and SA 230. So first we will try to talk about audit evidence, SA 500 related discussion we will say. Now, if you remember, I have already told you the entire process of audit. So what is the entire process of audit? It starts with auditor's appointment. Then he will perform audit procedures. From that, he will get audit evidence. And on the basis of that evidence, auditor is going to express an opinion. Now, what is the meaning of audit evidence? The information which supports or which forms the basis for auditor's conclusion. So basically, if I have to put it in simple terms, whatever information which auditor is using for expression of opinion, that information we call it as audit evidence. So this chapter mainly we are going to concentrate on the audit evidence. But before we can understand audit evidence, it becomes necessary for us to understand audit procedures, because audit procedure is the source from which we are getting the evidence from. So it becomes very much necessary to understand what are audit procedures. Tell me, what is the meaning of audit procedures? The term audit procedures is a very broad term. It includes everything. It includes all the procedure whatever auditor does to obtain the audit evidence. So all that procedures, all that efforts which auditor is putting for the purpose of obtaining evidence, that we call them as audit procedures. Now these audit procedures will be divided into two broad categories. One is risk assessment procedures and the other one is further audit procedures. Now, under further audit procedures, we have further divided them into two categories. One is compliance procedures and the other one is substantive audit procedures. Now, let us try to understand what happens in each of this procedure. So first we talk about risk assessment procedure. So let us just imagine a typical scenario where you are appointed as an auditor of a company. So one fine day you have to go to the client's premises and start doing the audit. No, just no. Then who will give you the fee? Right. So you have been appointed as an auditor. One fine day you have to go to the client's premises and you have to start doing the audit, or else client will not pay you the fees. So that day has come. So you have been appointed as an auditor. Assume you are an article assistant. The next step is that only, no? No, you want to imagine bigger. Okay. So assume you are that chartered accountant itself. So you have a team, you have an office, you have a staff. One fine day, you have to take your staff to the client's premises to do the audit. So what you will do? You will take your team, book a auto, not auto, cab. Okay, yeah, flight. No, too much of manifestation. Fine. Okay, not auto. So you will book a cab. So you book a cab, all your staff well dressed for Mills IT company audit is going on. So all your staff well dressed and all in complete formals and all, you arrive at the client's premises. Then what will happen? They will not allow you inside. They will not allow you inside. Why they will not allow you? Security guard will stop you at the entry gate only. You're all looking something different. Uh, so our regular employees will come in jeans, t-shirt and all, because IT companies culture has changed, right? So you are all coming in formals. This you are looking a bit out. So he will stop you. Looking at you, he will stop. But the intention is not that. Why he will stop is, as I have told you earlier, in the case of a IT company, the people will not allow you inside just like that. You need biometric access and all. So that's why he will stop. So now someone you have to call from the management. So they will come and escort you and they will take you inside. Okay. So the moment you have entered inside the company, what you will do? Why you have gone there? Why you have gone there? For conducting audit. So you will directly rush to the accounts department and ask the books of accounts and start doing the verification. No. Then what you will do? So first what we do is we have some formal communication with the finance head. Yeah. Slowly. So we So what we do is we just have some formal communication with the finance head. If the C, and also the CFO, if he is not free like us, generally he will be busy. So we meet with We meet with some finance head and we have some conversation. Okay, some half an hour you will spend with for discussion with the finance head and all. Then what you will do? Drink tea, right? Okay, drink tea. Have breakfast also here. So whatever it is to do. After that, what you will do? Then where is audit, man? So you told breakfast. You told immediately lunch. Then you will say dinner. Huh? Huh? Snacks also in between. Right. Okay. At some point of time, you have to do the work also, no? Right. While eating, you will work. So whatever it is, after that, come on, come on. So what are, after all that things, you have to start doing the audit. So how you will start doing the audit? Will you go to the accounts department and start verifying the books of accounts? No. See, first you should try to understand what your client's business is. You should try to understand about the client's entity. Basically, what business they do. Are they service entity? Are they a manufacturing entity? Are they into selling of the goods? Are they providing into services? So that we need to understand. And also I need to understand about the environment in which the client is operating, to which industry they belong, what is their applicable financial reporting framework, what are the macroeconomic factors, what is the laws and regulations which are applicable for them. You will try to understand the environment. Along with that, we should also try to understand their internal controls. So the first procedure which you are going to do once you go to the client's premises is you try to perform some procedures by way of understanding an entity. You will try to understand your client's entity. You will try to understand the client's environment. You will also try to understand the internal controls. Basically, you do something called a plant visit. So you take some knowledgeable person within the company, you take him around the company, and you will try to observe. You will go to the manufacturing section, you will go to, if it is a service company, you will go to the workstations and all. So you will see production activities, you will see, you will visit the accounting department, you will visit the HR department. So you will basically walk around all the company. So why you are walking around the company? You ate, no? For the purpose of digestion you are walking. Yeah, that is one hidden purpose, but the main purpose why you are doing that plant visit and all is to get this understanding only. So basically, as a part of that plant visit, you try to obtain an understanding of entity, environment and its internal controls. And why understanding of the entity, environment and internal controls is important? Because if you don't understand what is your nature of your client's business, in which environment it operates, what kind of internal controls you are having, your audit will be meaningless. Your audit will be meaningless. So if you have to judge, say for example, you are conducting audit. Assume you skip this step. Directly you went to the financial statements, directly you went to the accounts department, took the books of accounts, started verifying. So you found some expenses in the books of accounts. You need to judge whether this is a genuine expense or a fake expense. So for deciding that, you should know, is that expense they purchased some product, whether that purchase is required for this entity or not, you need to judge it. When you will come to know whether that expense is required for this business or not? Only when you understand about entity and its environment. So if you are not understanding entity, environment and its internal control, if you are directly jumping into the accounts department and if you are directly starting to verify the books of accounts and all, you are not at all going to do an effective audit. Your audit will be a complete waste of time there. So you need to first understand entity, environment and its internal control, and by understanding the entity, environment and its internal control, you will identify something called risk of material misstatement. So the purpose of understanding the entity, environment and its internal control is to identify and to also assess risk of material misstatement. Basically, you are trying to identify where there is a chance of happening of material misstatements in the organization. Material misstatement, we know. What is risk of material misstatement? The chance, the probability in this organization where there is a probability of happening of misstatement. So say for example, I came, when I'm doing the plant visit, I came to know in the revenue department the people are not having the knowledge of the accounting standards. So immediately I should find that yes, since these people don't know the accounting standards relating to revenue recognition. Recently some new Ind AS have come. Ind AS 115 has come. So that is a new Ind AS which gives some new rules regarding accounting revenue recognition. But I came to know the staff doesn't know that. So this will immediately give me a doubt that yes, in the area of revenue there is a chance of happening of misstatement. So I will become very careful when verifying revenue. So I went to the warehouse where the stock is getting kept, where the stores and when the stores and raw material are getting stored. So at that place there is no security guard, there is no CCTV camera, nothing is there. There is a chance of theft there. There is a risk of happening of misstatement in the stores. So like that, why I will do the understanding, why I will spend the time in understanding the entity, environment and its internal control is to identify, to find out and also to assess, that is to analyze what risk of material misstatement in this organization, in which area there is a chance of happening of misstatement. I want to identify that. So that procedures we are going to call it as risk assessment procedures. The name itself says you are assessing risk, you are analyzing the risk. For that you are performing procedures, that we call it as what? Risk assessment procedures. Okay, in the name of risk assessment procedure, some 1-2 days you will waste. In the sense, you go speak with the different people and also you try to understand entity, environment and its internal control. Yeah, you have to do it. Minimum 1 day you have to spend. If you are doing it more than 2 days, then definitely you are wasting the time. So whatever it is, you spend some 1 or 2 days of time in understanding the entity and its environment and internal control. You identified, you listed out the areas where there is the risk, where there is no risk. You have listed out the areas. Next, what you should do? 2 days over. Next, now you have to go to the accounts department and start verifying books of accounts. Wrong. So you should do one more thing before you go and start verifying the books of accounts. You should do one more thing. What you should do is you should verify internal controls. You should perform audit procedures to obtain audit evidence regarding operating effectiveness of internal controls. You should perform some audit procedures to obtain audit evidence regarding operating effectiveness of internal controls. Sir, what internal controls? I have already understood. No, in the risk assessment procedures, 2 days you told me to waste the time. I have wasted. I understood internal control. But once again, you are telling internal control. No, guys. In the risk, this difference you have to understand. In the risk assessment procedures, you will understand what controls are there. Just because you came to know that there is an internal control, that doesn't mean it is working effectively. I'm conducting audit of a supermarket. I went to the supermarket. I found many controls are there. CCTV camera is there. Security guard is there. That barcode scanning is there. When the customer is going out, security guard is also checking. Yes, I came to know, okay, these controls are there. Just because CCTV camera is there, that doesn't mean that is getting monitoring. So wires have been eaten up by rats. Just a CCTV camera is there. But whether that internal control, whether really that CCTV footage is getting captured, is someone monitoring that CCTV footage? So when that internal control will be effective, there should be continuous recording and someone should be monitoring. Then only the control is working effectively. Just for namesake, you have installed a CCTV camera, that doesn't mean controls are working effectively. So in the risk assessment procedures, you found that there is a camera, but whether that is working or not, you have to find it out. That you will get to know by performing compliance procedures. So whatever internal controls that you have understood as a part of risk assessment procedures, whether those controls are working effectively or not, I need to obtain audit evidence. For that, I will perform some procedures. That procedures I call it as what? Compliance procedures. There is other name for this procedure. We also call it as test of controls. What do we call it? Test of controls we call it. Okay, another 2-3 days we will spend it in the name of compliance procedures. If you pay close attention, till now I did not visit the accounting department. My ultimate objective is to express opinion on financial statements or financial information, but I did not touch it till now. 2 days risk assessment procedures gone, 2 days compliance procedures gone. Now what you will do? Now will you go to accounts department and start verifying books of accounts? Now you have to go. Time pass is over. Time pass is over. Now you have to go to accounts department and start verifying the books of accounts. So once you are done with the compliance procedures, you visit the accounts department now. Ask the management, ask the concerned person to share with you the copies of the books of accounts, to share with you the copies of the financial statements, to share with you the copies of all the supporting documents like bills, invoices, vouchers, contracts, agreements, everything you will get it. Now you will start verifying. So that procedures where you are actually verifying the books of accounts, where you are checking the reliability of the financial statements and books of accounts. That procedures we call them as substantive audit procedures. So till the stage of substantive audit procedures, you did not check a single invoice, single transaction. All that verification happens as a part of substantive audit procedures. And this verification, whether the entries in the books of accounts, whether the financial information is correct or not, so that substantive audit procedures, you can do it in 2 ways. You can do it in 2 ways. Just Ignore all the technical terminology. I will ask you one simple question. You are required to check whether the entries in the books of accounts and financial statements are correct or not. What you will do if you are in a position of an auditor? First thing, what you will do? Check the supporting documents, basically, which we technically call it as OCHing. So whatever in transactions are there in the books of accounts, whether they are genuine or not, I will check the supporting documents. So if you are trying to obtain evidence by way of checking the supporting documents, that we call it as test of details. In the test of details, also two categories: test of transactions, test of balances. Basically, if you are checking the supporting documents of incomes and expenses, that we call it as test of transactions. If you are checking the supporting documents of assets and liabilities, that we call it as test of balances. So that is one way. There is one more way. See, this is the labor work, test of details, routine work, no analytical things. Anybody can do it. But in order to see here, where our expertise actually comes is, in order to know whether the financial information is correct or not, even without checking the supporting documents, I should be able to say that. I should be able to say that. So how can I say that is by studying the relationship between financial and non-financial information. What I will do, I will try to study the relationship between financial and non-financial information. I will try to calculate some ratios like gross profit ratio. I will compare it with the last year. When compared with the last year to current year, what is the gross profit ratio? How much increase or decrease has taken place? If there is any huge increase or decrease, because of which reasons the increase or decrease has taken place. So I will dig deeper into the ratios and find out whether there is any misstatement or the entries are genuine or not. So these procedures I call them as analytical procedures. So when I say analytical procedures, what do I mean by that is, it is evaluating the relationship between financial and non-financial information and thereby ensuring whether the financial information is correct or not. Able to understand? So we try to study the relationship between financial and non-financial items. On the basis of studying of that relationship, we will determine whether financial information is correct or not in the financial statements. So that procedures we call it as analytical procedures. So basically this is what we do in the audit. These are the different types of audit procedures: risk assessment, compliance, and substantive audit procedures. So by performing these procedures, depending on the time and all, we get the audit evidence. But one thing you have to pay close attention. Do you think just by performing risk assessment procedures, will I get all the evidence required for expression of opinion? Frankly speaking, by performing risk assessment procedures, you are not at all getting any evidence. Zero evidence you are getting. You are only identifying what is the risk of material misstatement. You did not identify single mistake also, you are just identifying a chance. By performing compliance procedures also, you are not finding out any misstatement, you are just finding out whether internal controls are working effectively or not. Actual evidence you will get it only by performing substantive audit procedures. The evidence which you require for expression of opinion, that you will get it only by performing substantive audit procedures. And see, this compliance procedures and substantive audit procedures both are related with each other. Depending on one, other outcome will be decided. On the basis of one, others outcome will be decided. So let me put it very straightforward here. On the basis of results of compliance procedures, we are going to determine nature, timing, and extent of substantive audit procedures. On the basis of compliance procedures, we are going to determine nature, timing, and extent of substantive audit procedures. What do I mean by that? In the compliance procedures, what I'm trying to do? I'm trying to verify internal controls. So by performing compliance procedures, two outcomes could be possible. I can say internal controls are effective. Internal controls are all working effectively. Or I might get an outcome, internal controls are not working effectively. So if I came to know, see, basically when I have to verify the transactions and entries in the books of accounts, I will not do 100% verification. What I do? Sampling I will do. If I came to know that internal controls are all working effectively, will I verify large number of transactions or small number of transactions? Since I have a comfort zone here, I will try to verify less number of substantive audit procedures. On the other hand, if I came to know that internal controls are not at all working effectively, there what I will try to do, I will try to go for bigger samples, I will try to perform more substantive audit procedures. So on the basis of outcome of compliance procedures, I am going to determine nature, timing, and extent of substantive audit procedures. Both are closely interrelated with each other. Clear? Right. So why we understood about audit procedures? What is our main topic here for discussion? Audit evidence. So we are supposed to discuss regarding audit evidence, but in order to understand that, first we have got comfortable with what is the meaning of Audit procedures. Okay, so we understood audit procedures. Now we will try to understand what is audit evidence. So as I have told, what do you mean by audit evidence? The information which forms the basis or which supports the auditor's conclusion, that I am going to call it as audit evidence. From where you are going to get the audit evidence from? Okay, by performing audit procedures, but what I'm asking is source. What is the source from which you are going to get the audit evidence from? See, majority of the audit evidence you are going to get it from the accounting records. From where you are going to get the majority of information? Accounting records. What do you mean by accounting records? Simply books of accounts, those journal entries, ledgers, supporting documents, contracts, agreements, all that we call it as accounting records. Majority of the audit evidence is going to come from accounting records. But do you think accounting records are only the source of evidence? No. So some evidence we are going to get it from other information also. So what is other information? External confirmation, MOUs, MOA, MOA, and also communicating with the external parties. So even from other information also we are going to get some evidence. Next, on the basis of nature or purpose, on the basis of nature or form, evidence is divided into various categories. On the basis of form or nature, evidence is divided into three categories: oral, visual, what other is that? Documentary. So on the basis of form or nature, evidence is divided into three categories: oral, visual, and documentary. What is oral evidence? The evidence which you are getting by way of words spoken, like you do the inquiries, you get the responses, that is a oral evidence. What do you mean by visual evidence? By looking at something which we are getting the evidence, that we call it as visual evidence, like physical examination of an asset or physical verification of inventory. And what do you mean by documentary evidences? The evidence which is there in the written format, either in paper or electronic form, that we call it as documentary evidences. Between all these three, which one is more reliable? Documentary evidences is much reliable. Then on the basis of source, evidence is divided into two categories: internal evidences and external evidences. What is internal evidence? Those evidences which are originated within the organization. Within whose organization? Within the client's organization. Whatever evidence is getting originated, that we call it as internal evidence. Then what is external evidence? The evidence which is getting originated outside of the client's organization, that we call it as external evidence. And sales invoice is an example of purchase invoice. External, because when you buy, the buyer will give the invoice, right? Between internal versus external, which one is more reliable? External is more reliable. Why? What is the logic? Since it is getting originated outside of the client's organizations, client's management and client's staff will not have control over it, so less chances for manipulation. That's why when we do a comparative study, external evidence is more reliable. Am I saying internal evidence you have to throw away? Internal evidence is also reliable, but comparatively, which one is more reliable? External evidence is more reliable. Good. Now, few more things which we need to understand. See, whenever the term audit evidence is used, whenever the term audit evidence is used throughout the audit, it is always preceded by two terms. They always say sufficient and appropriate audit evidence. Like you might have paid attention in the audit reporting chapter also, everywhere we are saying sufficient and appropriate audit evidence available or not available. So sufficient and appropriate audit evidence, they say. The standards will not just say obtain audit evidence, the standard will say obtain sufficient and appropriate audit evidence. What is the meaning of sufficiency? It is a measure of quantity of audit evidence. What do you mean by appropriateness? Appropriateness is a measure of quality of audit evidence. They said only the meaning, but what amounts to sufficiency, what amounts to appropriateness, they did not define it. There is no hard and fast rule which says how much quantity will be considered as sufficient, what quality will be considered as appropriate. They did not mention it anywhere. So it purely depends on professional judgment of the auditor. It purely depends on what? Professional judgment of the auditor. But however, there are some factors which will affect that decision. Purely you have to decide based on your professional judgment, but there are some factors which will help the auditor in deciding whether the evidence is sufficient, whether he has appropriate audit evidence or not. So sufficiency depends on some factors, like it depends on, like if you see here, it depends on materiality. It depends on what? Materiality. So if the items are more material, When you are trying to obtain evidence regarding more material transactions, you need to obtain more evidence. So you have a direct relationship between materiality and sufficiency of audit evidence. It also depends on risk of material misstatement. Higher the risk of material misstatement, higher the audit evidence you want. Lower the risk of material misstatement, lower the audit evidence you want. It also depends on size and characteristics of the population. One doubt here, you are responding very quickly. Do you want me to close the class early and leave, or me to encourage me? Thank you. Thanks a lot. No, for a moment I got a doubt actually. These people all of a sudden they have become hyperactive and all. I am listening. I am hearing many voices. So just wanted to confirm. Uh, because I said examples and all, so it boosted you up. Okay, fine. So next, one more factor on which we will decide whether evidence is sufficient or not is on the basis of size of the population and also characteristics of population. Like if the population is small, in smaller populations we need smaller sample sizes. In larger populations we need no small percentage only we take, but quantity will become big. Sample percentage will be small only, but since the sample size is a bigger number, a simple logic here. We have two populations, 1000, 10,000. I have a 10% sample. If I apply 10% here, I will get 100. If I apply 10% here, I will get 1000. So bigger the samples, with the same percentage also you get bigger sample size. And also it depends on characteristics of the population. If it is homogeneous population which is having similar characteristics, less sample size. If it is heterogeneous population, more sample size, more audit evidence you will require. So these are the few factors. So it depends on materiality, it depends on risk of material misstatement, it also depends on size and characteristics of the population. So we have seen factors which affect sufficiency. Now let us talk about factors which affect appropriateness. Appropriateness depends on two things. One is relevance and the other one is reliability. Relevance means logical connection. How logically the evidence is connected with the given item of the financial statement. More the connection, more the logical connection, more relevant it will be. More the relevance, more appropriate it will be. On the other hand, reliability. Higher, more the reliability of the audit evidence, more will be the appropriateness. Like reliability will be influenced. Reliability further depends on nature or form and source. Appropriateness depends on reliability. Reliability further depends on source and nature. Like between internal versus external, which one is more reliable? Between oral, visual, documentary, which one is more reliable? Documentary. So like that, it depends. It further depends on that thing. Then, and one more thing here, reliability. We have to talk more about reliability. See, reliability depends on facts and circumstances, but there are some generalizations about reliability. What are they? Generalizations. That means there are some general principles which we can use to determine whether evidence is reliable or not. Very common general principles we have. Like between internal, external, which one is more reliable? Oral, visual, documentary. Original versus photocopies. Internal evidence will become more reliable when controls are effective or controls are not effective. Controls are more effective. When you have evidence from multiple sources, when they match with each other, they are more reliable. When they don't match with each other, more reliable. When they match with each other, more reliable. So these are some general principles. We also call them as what are the, they might ask a question, what are the generalizations regarding reliability of audit evidence? So then you are required to write this general points. So this is what regarding reliability of audit evidence. Now let us talk about audit procedures to obtain audit evidence. Audit procedures to obtain audit evidence in the sense audit methods, tools, techniques which we are supposed to follow to obtain audit evidence. See, the audit subject is a universal subject. Country to country, we have different accounting policies, different presentation, but country to country audit will remain the same. So if we are doing audit in India, we are required to independently examine the financial information. If you do audit of a US company, there also you will do the same thing. So across the world, to perform audit, we have only 7 methods available. How many we have? 7 methods we have. So what are that 7 methods? Number 1 is inspection. We have something called inspection. Then we have inquiry. Then we have observation. Then we have recalculation, reperformance, external confirmation, and analytical procedures. Across the world, we have only this 7 methods or techniques. So what happens in the inspection? What do you mean by inspection? Inspection involves documentary examination it also involves a physical examination of asset. So when you are doing either documentary examination or you are doing a physical examination, so that we call it as inspection. Does inspection give evidence? Yes, inspection will give evidence. Majority of the work in the audit we do in the form of inspection. Then we have inquiry. So what is inquiry? Seeking information from knowledgeable person. Basically, you are asking the questions from the knowledgeable person and getting the replies. By that way, you are getting evidence. That method we call it as inquiry. And that inquiry can be a informal oral inquiry, or it could be a formal written inquiry. So anything you could be. But which one do you think will give better evidence? No, informal will give you a lot of information. Why? Because when you are asking the questions in a written format, you are giving the other party the time to think and respond. They will not discuss. They will not disclose the information to you. But if you are conducting informal oral inquiry, you are not getting that option. So this is where you have to become smart. You have to lay the traps for them. So you should look friendly, but you have to extract the information. So informal oral inquiries will give information. See, by conducting inquiry, you can get two kinds of information. Not just in audit, any inquiry you conduct, by doing that, two kinds of information you will get. Not two, three information you will get. Number one, information which supports the information which you already know. Number two, information which contradicts with the information already you know. Number three, altogether a new information. Not just in audit, anywhere you go and do the inquiry, this is what the three things you get. Either you get additional information, altogether new information, or information which is supporting what you already know, or information which is contradicting with what you already know. So any of these three things you are going to get. So even in audit also same thing happens. See, but the problem with the inquiry is you can't rely only on inquiry. In audit, inquiry should always be used in combination with other audit methods. Inquiry alone you cannot rely, because we can't expect everybody to voluntarily come forward and disclose to us what mistakes they have committed. So that's why you can't completely rely only on inquiry. You have to use the combination. You have to use inquiry in combination with other methods. Now let us talk about observation. What do you mean by observation? So someone else is performing the procedure, you are sitting and observing, looking at the process being performed by others. Like management is doing inventory counting, you are sitting and observing. That evidence we call it as observation. That method we call it as observation. Do you think observation is reliable? Observation is reliable, but that reliability is restricted only till the point of time when such observation takes place. See, when I am observing you, you will do the task with caution. You will do the task carefully. What is the guarantee? When I am not observing, you will do the same task in the same manner. There is no such guarantee. So that's why observation will give evidence, but the reliability is restricted only till the point of time when such observation takes place. When you are not doing the observation, what is the guarantee? The same activity will happen in the same manner. Understood? Next. And then comes external confirmation. First, we will cover external confirmation. So what is external confirmation? Getting a direct written response from a third party. It's from an entity which is outside of the client's organization. From the third party, if you are getting a direct written response, that we are going to call it as an external confirmation. And more about external confirmation, we have a dedicated standard SA 505. There we will try to understand. Then recalculation. What do you mean by recalculation? Checking of the arithmetical accuracy. This is irrelevant today. You need not worry about it. Why? Because math and all, who is doing, software is doing it. You need not do that recalculation, but checking arithmetical accuracy, we call it as recalculation. Then we have reperformance. What is reperformance? So reperformance means the management has already performed some task, but you are independently executing on your own to get the evidence. So like management has already prepared a BRS, you don't want to use it. You are saying I have also learned the BRS as a part of my class 12 and foundation. I will prepare the BRS on my own. And you are comparing your BRS with the management's BRS. That we call it as what? Reperformance. And then we have finally analytical procedures. Analytical procedures I have already told you. What we do in analytical procedures? We try to study the relationship between financial and non-financial information, and on the basis of that we evaluate whether the financial information is correct or not. So universally, wherever you go, these are all the only 7 methods which are available for obtaining audit evidence. Now, question for you: out of all these 7 methods, which one is most efficient? Okay, efficient and effective, do you know the difference between the two? Efficient, if you are able to complete the task in less time. Effective, if we are doing the task in a best manner, best output, that we call it as effective. So since you got the meaning of efficient and effective, now you tell me out of the 7 methods, which is most efficient? Most efficient in the sense less time consuming. Which one is less time consuming? Very good. Inquiry is the most efficient method. But the problem is least effective method. Why least effective? As I have told, the same logic, you can't expect any person to come forward and voluntarily disclose the mistakes, whatever he has committed. So, no. Then, which one is most effective? Which one will give best evidence? But the problem is it is least efficient. Why it is least efficient? It is very much time consuming. Why? Because first you have to learn the process, you have to do it on your own once again, then compare it with the management's things. So a lot of time consuming. So inquiry is most effective but most efficient but least effective, but reperformance is most effective but least efficient. So you have to choose the audit method in such a manner that you are compromising, you are balancing both efficiency and effectiveness. So which combination? Not exactly. Any method you can use depending on your professional judgment. There is no hard and fast rule. It is completely your choice. Whatever combination you want, you use, but strike the balance between efficiency and effectiveness. Clear? So these are all the 7 methods. Now talking about a few more things. Talking about few more things. Electronic data and all. Okay. Assertions. What we shall do? We will do assertions. We will do now. So what do you mean by assertion? This is also one more term which we often come across. The term assertion also very often at various instances we come across this term. So what is the meaning of the term assertion? So if you look at the definition, they have told that assertion means representations which are made by management that are embodied in the financial statements. So whatever representations which are made by management, so whatever statements, whatever conveyance of the information which the management is doing in the financial statements, which are incorporated in the financial statements, that we call it as assertions. See, management is conveying a lot of information, not explicitly, but implicitly they are conveying a lot of information. If they have showed in the balance sheet, the management has prepared the balance sheet. In the balance sheet, they have shown fixed assets. They have shown fixed assets as 100 CR. By showing that fixed assets as 100 CR, they are going to make various representations, not explicitly. They don't say this explicitly anywhere, but all these assertions, all these representations are implied. So by showing the fixed assets as 100 crore rupees, they are trying to convey that fixed assets worth 100 crores are in existence with the company as on the balance sheet date. They are there with the company as on the balance sheet date. And they have completely recorded all the fixed assets. They did not miss out anything from the balance sheet. So every asset has been recorded. So then the value has come, then the assets value has come to 100 CR. Then we have rights. They're trying to convey that rights or ownership also, you can say. They're trying to impliedly convey that we are the owners of that 100 CR worth of assets. And also they're trying to give you a representation regarding valuation. They are trying to convey that they have done the valuation correctly, then the value came to 100 CR. Similarly, when you are verifying liabilities, when your management has conveyed liabilities, say for example liabilities 50 CR, regarding that also so much of implicit representations they have made. They are trying to convey that liabilities worth this much amount are in existence. They have completely recorded all that liabilities. They have obligation to make the payment of that liabilities, and they have valued it. If you take any P&L items, for P&L items we have different representations. Like for example, if I take revenue, they say that revenue transactions have occurred, they have taken place, and they have completely recorded that revenue transactions. They have measured it properly, and they have classified it properly. You can even say classification and all, and even you can say cutoff. These 100, this whatever revenue figure they have shown, that belongs only to the current year. None of the previous year's revenue, none of the future month, future year's revenue has been included there. So all this one. So all these representations are made by management, not explicitly, implicitly. All this we call it as assertions. And frankly speaking, as an auditor, what we do when we are conducting audit, what we try to do is we try to obtain evidence regarding these assertions only. If we are checking fixed assets, what I am checking for fixed assets? Whether really they are in existence, whether they are completely recorded, whether the company is a owner, whether they have been valued properly. If I'm verifying revenue, what I will verify? Have they occurred properly? Are they completely recorded? Are they measured properly? Are they classified properly? Are they belonging to current year? Understood? If it is a disclosure, if it is notes to accounts, then it is a combination actually. Why? Because disclosure can be related to a P&L item, disclosure can be related to a balance sheet item. So there they give combined. So occurrence or existence, depending on whether it is related to P&L or balance sheet. Completeness anyhow will remain common. Valuation or measurement. So accordingly we will decide it. So these are all assertions. See, till now whatever I have told, what happened? I'm going aside. So till now whatever I have told, these are all positive assertions. Management is trying to say this is there, this is there. When they show fixed assets, they are trying to say fixed assets worth 100 crores are in existence. They have valued properly. We have done this properly. So that are positive assertions. Sometimes assertions could be negative also. Sometimes assertions could be negative. And those negative assertions also could be either explicit or implied. Say, for example, in the notes to accounts, management has told there are no contingent liabilities for us. They have told there are no contingent liabilities for us. That is a negative assertion. Implicit or explicit? Explicit. They have stated it. Or the management, while explaining the balance sheet, while preparing the balance sheet, they did not show trade receivables. Trade receivables item itself is not there. What they are trying to convey there? They don't have any debtors. This is also a negative assertion. Implicit or explicit? Implicit. They did not state, no, that is implied. By not telling, by not mentioning the trade receivables, they are indirectly trying to convey that we don't have any debtors. That is an implicit assertion. So assertion could be either a positive assertion or even it could be a negative assertion. They could be explicit, they could be implicit. And as an auditor, my ultimate purpose is to obtain evidence supporting that assertions only. Clear? So this is what the concept of assertion is. Next. So audit trail, we have already seen what is the meaning of the audit trail and all. It is a documented flow of transaction. Basically, how the transaction, how a source document has been translated into an accounting entry. See, when you do a sale invoice will be there. That sale invoice will actually get converted into an entry in the books of accounts. What has happened from that document till the time it has been converted into entry? What and all happened? Who created that entry? Who approved it? What changes were made? If deleted, when it was deleted? So how a source document was translated into accounting entry, that flow of the transaction, we call it as audit trail. And it is very much important, not just entry, even the audit trail for that is very important to establish authenticity and integrity. And it is audit trail helps in maintaining records of system and user activity. Who logged in which system, at which time he has logged in, when he logged out, did he try to gain access to unauthorized systems? That also can be tracked using this audit trail. So and all the things are same. It is a step-by-step record, basically from the beginning till the ending, what and all steps which have taken place. Step-by-step record will be maintained, and they also act as record keepers that document evidence of certain events, basically whether a transaction has really taken place or not. So that also you can establish by doing the back end work of audit trail. And if you maintain this audit trail, it will enhance your internal controls, and also it will protect your data. Security of the data also will get improved, and you can exactly find out what is the main reason of the problem, at which point of time, where that fraud has taken place, where exactly pinpointedly you can find out if you have audit trail, where the transaction has gone wrong. Gone. Last point. So, and if and just maintaining audit trail is not going to be easy. It is going to be a costly affair. You have to spend the time we have to incur cost in both financial terms and also in time terms. Also, you have to spend the money. So this is what regarding the meaning of the audit trail. So few more things we will try to cover in SA 500. So we will try to see this. What are the matters which affect the nature, timing, and extent of audit procedures when information to be used as audit evidence has been obtained by using the help of management expert? See, sometimes you need to obtain audit evidence, but all that evidence you will not be able to obtain on your own. You might be required to get the help of management expert. So basically, what is an expert? Who is an expert actually? Who is having an expertise in areas other than accounts and audit. From the auditing perspective, when I say I have to go and consult an expert, if I say I'm an auditor, I will go and consult an expert. Which expert I am referring to? That person who will have expertise in areas other than accounts and audit. Why? Because the expert who is having an expertise in the areas of accounts and audit is you only. So you have to go and consult an expert in those areas other than accounts and audit. So in some cases, in order to obtain evidence, we might require the help of management expert. Now, who is this management expert? See, experts will be of two categories: auditors expert, management expert. So when I say management expert, what do I mean by that is, say for example, I'm conducting audit of the client X Limited. This X Limited is required to create a provision for gratuity. They don't know how to calculate the provision for gratuity. What they have done is they have appointed one actuary. That actuary has calculated the gratuity provision, and that amount they have created as a provision in their financial statements. Now I wanted to obtain audit evidence whether that gratuity provision is correct or not. What management has done is they have given that actuary is working. Management has recruited an expert for the purpose of preparation of financial statements. So when I asked, sir, what is the basis for this provision for gratuity? Management told, sir, we have approached a gratuity. That gratuity has that we have approached an actuary. That actuary did the valuation and did this valuation sheet to me, and they are telling on that basis we have created that provision. So now I am going through that valuation which has been done by the actuary to know whether that provision is correct or not. So here, for the purpose of obtaining evidence, I am using the work of expert. That is not my expert. That is an expert who has been appointed by management for the preparation of financial statements. So if you want to make the use of expert, management expert, for the purpose of obtaining audit evidence, what things you have to keep in mind? What extra things you have to consider? So what things you have to consider is you have to pay attention to nature and complexity of the matter to which the expert relates. So what is the nature of the matter regarding which you are approaching an expert? What is the complexity of the matter regarding which you are approaching an expert? You should also consider risk of material misstatement. In that area where you have taken the help of management expert, what is the risk there? Is the risk is high or the risk is low? Is there any alternative sources of evidences available? Apart from going to the management expert, do you have any alternative sources of evidences available? And nature, scope and objectives of management experts work. Basically, you need to have a brief idea about what is his scope, what is his nature, what is the objectives of the expert. And also whether management expert is employed. This is we are checking for the purpose of independence. Is he a consultant or is he an employee of the client? And also the extent to which management can exercise control or influence. Once again, independence. Is the management able to control more that expert or less that expert? And also whether management expert is subject to technical performance standards. Is that expert doing the work as per some professional standards, like the way we have standards on audit? Even actuaries also will have their standards. Did he follow that technical standards while doing that work? And also the nature and extent of any controls within the entity or the management expert. So whether any controls are imposed by the management on the work performed by the expert. And also you should obtain some basic knowledge and experience of that expert as a part of your past experiences. If you have any past work experience with him, you should even use that experience. So these factors you have to consider when you have decided to use the work of management experts work. Then we have few more questions, like we have this question, selecting items for testing. This will anyhow cover it as a part of our audit sampling chapter, where there we have various methods for sampling, statistical, non-statistical, all that we will have a discussion at that point of time. So what else we have? So if you have any doubts or inconsistency of audit evidence, what you should do? You should first increase your audit procedures. If you find any irrelevant inconsistency between audit evidence, first you should perform more audit procedures. Check whether is there any requirement to perform additional audit procedures, and even if required, you have to consider modifying your opinion. That's what we will do if there is any inconsistency or doubts or reliability of audit evidence. This is more or less the same what responsibilities you are required to fulfill when you are relying on the work of management expert. More or less the things will look like the previous case only, whatever we have seen. And evaluation of audit evidence. Just obtaining the evidence will not be enough. Whatever evidence that you have obtained, that you have to evaluate. You have to analyze that evidence, whether it is giving you suitable evidence. Are you required to obtain any extra evidence? So all that things you need to check. Basically, you need to evaluate whether evidence you have obtained is sufficient and appropriate, and whatever evidence you have obtained, is it helping you to reduce an audit risk to an acceptably low level? You can't eliminate it, that you anyhow know, but you have to check whether you are, depending on that evidence, were you able to reduce that audit risk to an acceptably low level. So that from that perspectives you have to evaluate. Okay, so we'll stop our discussion here because tomorrow also we need to have a session. So tomorrow we'll continue our discussion. So you need not worry, as I've already told, if at all any things are getting not covered in the lectures and all, by Tuesday I will upload the part 3. No need to worry at all. Okay, so we'll try to take the things in a easy manner. I hope you are all able to enjoy the today's session. You might have found the value addition in the today's session. Were you able to revise the contents in a proper way? Perfect. So with the same energy, with the same enthusiasm, please be here tomorrow morning sharp 9 o'clock. Okay, right. Bye. Good night.